Hey, good morning. Good morning. Jason with Tactical Data Desk LLC. It is Monday, the 13th of April, I think. We are 2 minutes away from market. We are now live streaming the GEX dashboard. And I made some updates to the dashboard. So as you can see, I stacked it vertically left and right to get out of the way of the price action. And that way I can set the price to just go. See how the F is not up there? I make this adjustment, watch the F will come up. So click that, then the price can just go. Move this out of the way. This QR code is if you don't have NinjaTrader, you can click the link and the code to get Ninja. Then I'll also move myself out because I am see me. Good morning, everyone. Welcome to the live stream. It is a great day. I had a great weekend. I hope you did too. Had a birthday party, take the kids to. Fantastic. Uh, Kinda live in a city where it's kinda at the Great Smoke. Is that what you call it? But oh, there's hardly any flat. Oh, looks like we're open. There it goes. Look at that candle. We're positive Gex. Look at that candle. Look at that candle. Rocking and rolling. This candle's up. Volume pro. We are at the top. Morning to morning and popping. Popping. Okay, Gex at 57 million. Shift is negative. So Gex at 16 billion. That's your delta exposure. Your Vega negative 500 shift is plus. IV is OPEX call 60 SPX. Ball 6750. Oh, we had this zero DTE. See that shit. Right. How we looking? It's a good day. This is down. Now, last night when futures down, opened down 68, was down 77. Now we're only check that spread. Six. Wow, SPX has been 60. Let's update this here. I had such a busy weekend that so many. You think my mic is not working? Probably is. I had such a busy day. Hear me now? Really low. Yeah. Trying out a new mic. I'm not gonna lie to you, I don't like it. Probably gonna return this. How about now? You're the second person that told me that the mic volume's really low. How's this? Yeah, How about now? Is it getting better, 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 better? That's better. Thanks. So when I made a video, oh man, right at that call wall and right off it. How accurate is that? Right at that call wall, couldn't get above it and then below. So if you were checking that out, that's 68.36, 68.32. You could have got 4 points right there. Thanks, guys, for the feedback on the mic. When I posted them first, but we are above the operational moving average here. We are above the zero gamma line. The GEX shift a few minutes ago, remember, was negative 122. Now it's only negative 10. So the GEX weight is lifting. Market is rising. I'm not telling you to go short. I don't give trade advice. That's not my style. But this is a great trading day so far. Oh, that Vanda magnet's up there, so I got to bring that screen down. Active magnet on the buy pressure. These up here, these are some fair value gaps. I'll turn that off. I was playing with something. Oh, actually, no, that's not. That's we drew those over the weekend on a video when I was talking about order flow volume profile. I'll just pop those off. Thanks, Takoa. So when I posted a video, first of all, Jason with Tactical Data Desk LLC. So I'm not a professional YouTuber. I'm not a professional anything. I'm just a veteran that loves to give back to the trading community with some data-driven analytics and trying to provide some free gamma exposure to everyone so you don't got to pay. I saw one site selling it for $700 a month. That's the highest I've ever seen. But anyway, I made my first video, put it on YouTube. Absolutely awful. Don't go look at it. But the feedback I got was, hey, great video. If you can figure out your mic, more people might watch this without wanting to, gouge their ears out. Because I just used whatever microphone my computer had. And yeah, it was absolutely awful. So they were right. So I ordered one on Amazon and made a huge difference. But it was a mic stand, where the mic just sits on top of just a little stand. So it was right in the way of my keyboard and my hands. So then I switched to this other one where it has a boom arm and it's a different brand. And it has this, I don't even know what this thing is called, the pad that it goes through, got buttons on it and things on it. And it goes to my computer. And I don't like this. I don't think it works very well. So I'm going to return this and try something else. But here we are in a second call wall rejection right off the call wall. And this is the power of the call wall. But look at the volume profile. Here it is, thin area right here on this volume profile. Thick area here, thin area here. If you didn't check out my 2 videos on volume profile, I'll throw them in the chat. Check them out later to bore you to death. We're probably going to come down to this operational moving average. We'll watch that and then watch the zero gamma, the flip line, see what happens. Good morning, Bray. Good morning, everyone. Right. What a great day. So I'm not trying to promote my videos. I just want to share in case you didn't see. Here's the volume profile video I did for Thinkorswim. And then here's one I did for the Ninja Trader one. If you're interested in any way whatsoever. I just threw those in the chat. Oh, guess what? You want to hear something interesting? I had to make a new Twitter account. Morning, Stemmen. New Twitter account or new X account, whatever it's called. I have to put that in the chat too. Because someone reported my account as being inauthentic. And I don't know if you are familiar with the rules about X.com, but if someone does that, they just cancel your account. I don't know why. I mean, I registered with all real data, my LLC, my name, all that stuff. I guess I'm not very popular because I provide free gamma exposure instead of charging $700 a month for it. So that's probably why. So lesson learned. I will see. Yeah, we absolutely hit that operational moving average, which is a special moving average I custom wrote for Ninja Trader. Hit that. That's your bounce on the way back up, probably to the call wall, because we're above the zero gamma line, and that makes a big difference. And the shift was only down 11. It's down 14. Not a huge change. and Vanna's moving up, and Vex is positive. So your Vanna exposure is positive, your Vanna is positive. And if you look at the tactical advice, it says buy the dips. So there was a dip, and then you can see, I need to figure out how to get my cursor to highlight instead of have just be this candle. I'll work on that. But see, this is what we called a failed breakout pattern. See how the wick dipped below this low of the red candle, but then this candle closed above the close of that low. Or was the open, I'm sorry. This is where it opened, and then the wick dipped below, and then it came up below that close. And then typically that's a sign of the next candle be bullish, and it sure was. And that's like 3 or 4 points on the 1 minute. Could have scalped that if you're into scalping, as we are above the 0 gamma line, above the flip line with positive GEX. Buy the dips. There you go. Yeah, I got kicked off X. So, did I put that link in the chat? Yeah, there's my new X.com. If you want to, I don't do a lot on X. I just post like, hey, we're live and here's a video. And honestly, what I use it for is like if you guys make a trade from this and say, hey, I just made a trade and it was great. I take that picture and put it on there and say, hey, Takoa just made a trade and he enjoyed it. So go say congratulations to him. That's what I use it for. But if you want to follow me, go ahead. I'm not big onto social media, and I'm not trying to be the Twitter king or X king. But this is an exciting morning here on ES. Now, I do have super busy day today with my real job, FYI. So I'm gonna fire this live stream up. And then I'm gonna have to get over and do some work, but I'll leave this up. And then I think what I'm gonna start doing is I'll probably turn the live stream off at like noon during the lunch period when not much is happening. And then that'll allow me to go take a walk. 'Cause sitting down here in the basement all day is pretty rough on me. And then start it back up around 1 or 1:30. Mm. All right. Coming up against that call wall again. So right now, morning, Leo. Welcome to the chat. Welcome to the channel. Right now, I am doing another compliance update for Ninja Trader, the company. I just cannot seem to. It's a lot. Touch that wall again. Almost touched that wall again. Hugging that operational moving average. All right. So I'm also working on a video for delta exposure. Almost done. And the reason why we're coming up on that operational moving average here. The reason why it's taken so long is because I'm trying to make it actually informative instead of just say delta exposure. What is delta exposure? That's where delta is exposed. I'm trying to make it actually informative, and I don't want to tell you it's hard. It's not hard. It just takes a while to make sure that the information I'm providing is actionable and insightful. Now keep in mind here, we're at thin volume on the volume profile. I'll zoom out so you can see. Now I've got the profile shrunk a little bit just so it fits on the screen. But here we are, thin area here. So if there's a breakdown, it could slide. Your next big volume node, I guess I could make that darker so we can see it better. I guess I can make the width a little bit higher too. I'll change that opacity to 30 if you're good with that. I'll make them, and I'll make the value area, that's the outside. I'll make the value area, which is inside value area high, value area low. Make that 40. If that's too dark, let me know. But here we are. You can see there's some thin trading. There's a, whoops. A pretty big node here at 68.26. And you can see that aligns with, uh, a spot of resistance and then a spot of support right here. So we'll see if that 68.27, 68.27.25 holds as support again. What we do is a pretty big spot coming up. It's 68.27. So thick volume node here at 68.27 could be a potential support, or we could go right through it with the thin trading. So Bray, I see your comment here. So in this video, you will explain everything related to GEX. So the only thing we use here is the volume and the GEX. Do you mean, which video are you specifically talking about? Are you, in this, are you talking about the video I made about GEX or the video I'm going to make about delta exposure? Yes, I will create a tutorial how to use GEX. And I'm also going to be creating a focused video on how my guys, look at this GEX shift. I wasn't watching, but the GEX shift, the GEX is now negative 70 million. The shift is down 235 million. That's a pretty, good morning, Ashley. That's a pretty big move. Yeah, so I'm going to make a full video on how this HUD works. Because this heads up display, what you see, Perth, Australia? You're coming from Australia? Holy cow. Welcome to the channel. What time is it there in Australia? Huge candle. Remember, We are above the gamma flip line. This is a huge candle. Above the gamma flip line, we are positive GEX. That shift just jumped to 695. Something's happening. Did you see that shift jump? Oh, there must be news or something. We got to get some news channels on here. It's rocking. There must be some announcement. Wow. And then the shift is back down. Crazy. But it's positive gamma, so price is pinning. VEX is positive. The market makers are short volatility. So what happens when volatility compresses? It's almost 10 o'clock. Wow. Well, thanks for staying up and watching with us. When volatility compresses, their delta of the positions lower. Look at this. Look at this volume profile grow real time. That's massive buying. There must be some type of news. Yeah, it was choppy, but something just changed in the market. Huge news. We're going to watch the profile shift. It is rocking. Right at the 9:49 hour. This is incredible. Look at that. This is why you got to have order flow volume profile. Also, I'm working on something very specific for NinjaTrader that's going to improve NinjaTrader's order flow volume profile. Look at this. This is awesome to see. This is why you got to have order flow volume profile up. You could have volume down at the bottom, but then you got to look down at the bottom. If you're looking right at price, you can watch the volume grow, and you can see the green. The green is the order flow cumulative volume buys at the ask, and the red is the order flow cumulative volume. No, I'm sorry. Yeah, buys at the ask and sells at the bid. So you can see the green significantly outpacing the red. So it's buy, 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 buy. Buy, 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 buy. Crazy. Okay, I gotta finish this. Wow. Rocking. Who's watching the news? Got a wall here at 68. It looks like 61. So now we blew right through this wall. Blew right through it. But we are starting to come down a little bit now. Let me check the 39 now. Update in real time. Wow. Then coming back down on one big candle. Did I mistype that? Nope, there they are. Um, I'm paying attention, but I'm also updating something for NinjaTrader company. Up and then back down. Okay. Okay. Sorry. I'm back. Okay, once you do the videos, the GEX and volume profile with order flow, can you make sure to make it practical in the chart, like really adding it from zero in the chart? When you say from zero, what do you mean? Like 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 having it from like having the chart completely blank and going from there? Actually, the offset values are taken literally from the difference between the ES spot price and the SPX spot price. So I make it super simple. Right now, I just look in Thinkorswim and I take ES at 68.48 and I subtract SPX at 68.10, and that spot price changes day to day because ES is the sixth month of the year, and you guys are gonna laugh. I can never remember what the sixth month is. January, February, March, April, May, June. June. We're trading the June contract on ES, but today is April 13th. So the ES and SPX are going to be off because there's much more time in the ES contract expiration. So when the ES rolled from March to June, that spot price difference was like 60. And well, how many 3 months away? So 60, and then it dropped 55, 40, et cetera. Now we're down to 39. And there's a whole bunch of other things that go into that. What is the risk-free rate of return, interest rates, volatility, et cetera. I have other heads up displays that I'm working on that I watch real time that I'll be making available. Like this heads up display that I have, this specific heads up display that I have has this one automatically does the raw SPX spot price to ES spot price basis. This is 36.9 because this does change by a point or two throughout the day. This one does synthetic GEX walls for purely zero DTE trading. And this one is highly accurate if you like to trade pure zero DTE activities. And this one actually has the walls weighted by percentage. And I'll get into that when I'm ready to release that. And that's how I do it for this. This weekend, I meant to update the code for this so it does it automatically. Didn't get a chance to do it. I got kids. They had birthday parties. They had friends over here on Saturday, which was awesome. I love having all the kids over here. It's fantastic. But someone's got to watch them so that they don't get in trouble. And that someone is me because I love my kids. Okay. That's where I get the offset, Ashley. And then Bray, it's like sometimes you get into someone's speed and they explain how you do things, but you don't know where they got it from. Yep, I got you, man. Totally. I will make sure I do it from the ground up because you're right. There are so many times I've watched something or jumped into something like, I don't get it. How'd you get there? Where did you miss the step? So I'll totally do that. All right, give me a second. I got to go over here to my other computer and log into something. Hey, Ashley, you're welcome. So I know you were here last week, but again, my name is Jason. I run Tactical Data Desk LLC, and I'm literally just here to enable traders. Like I'm not an entertainment channel. I'm not trying to lie to you guys or put up fake charts or charts that happened last week and say, well, if you would have done this, you would have made this much money. Or no spoofing, no marketing, no hype, just pure data uh, that you can watch and see and learn, and no scams either. Like I'm not trying to give you this and then say, well, if you want the rest of it, you got to pay $10,000 to get something else. Funny story. When we went to this, hold on. Went to there was a there's awesome little towns around here. They're actually kind of big now. We went to a park with our friends and their friends. So there's a whole bunch of people, a whole bunch of kids at this park, and there was a festival next to it, live music, which I love live music. Long story short, because I have a terrible habit of making short stories long. Talking to this guy, and he said, "Yeah, my friend bought a house flipping course, week long seminar for $1,000." And we were both amped about it because we really were into flipping houses. So we went to the seminar and we learned a little bit. But towards the end of it, they said, well, this is just phase one. If you want to learn the rest of it, you got to buy the next seminar, and it's $20,000 and it's 2 weeks here. Here's the sign up. It's like, oh, here we go. Yep. Yeah. So none of that here. Now, once I do get my vendor license approved, I do have a website. I'll be making all this stuff available. Plus, I got something else that's super awesome for gamma exposure, delta exposure, van exposure that you won't need NinjaTrader, and you won't need an API for real time data flow because you'll have real time data flow, and this will be sweet, and it's gonna be awesome. So I just got to get that going. I have so many things to offer. It's gonna hopefully enable your trading. Okay. Have you guys ever tried to walk and chew bubble gum? It's very hard. We got 17 people here in the chat. This is fantastic. This is a great trading day. Watch look at the profile. We're thin here. See that thin area? So typically we'll retrace down to that. Now we're in some thick area with lots of buyers. So look for some, and then the magnet just moved down. Look for some type of, this would be a point where if you wanted to get long the market in the positive GEX environment, with GEX being at 48 million, the shift being at 32 million from the 930 open, this would where you'd want to be. I'm not telling you this is the time. I'm saying, well, we just traded through that thick area with some selling, and here's the next thin area. Okay, Ashley, what's your background? Good question. I'm going to make a video about my background, but essentially, I'm a 27 plus year Air Force veteran. Spent a significant amount of time on active duty in quite a few operational and combat environments. I have my application in for my service disabled certified small business veteran owned company. I forget what that full acronym is. I'm bad with acronyms. I'm bad with everything. And then when that time was over, I've been in very, very high level finance in the highest levels of government across the Department of Defense, headquarters, Air Force, Army, Navy, etc. So I've been doing finance stuff for a long time, and then I taught at I taught high level graduate school in downtown Chicago at a prestigious technical university, and then took some finance courses at their school, where, believe it or not, I met some market makers, and that's how I got into this. And then I've been trading on my own for, gosh, I don't know how long. Got into options before options got super popular. Back when there used to be a thing called Options House. You guys remember Options House? That got bought 15 different times, and then I think it rolled into E-Trade eventually. I mean, so long ago that my option commissions are 10 cents per contract. So I've been doing this for a while. And so, yeah, I have some technical background, a lot of finance, like specific finance background, not accounting background. And this all came about because I've I never I never understood. Like, I always looking for an edge, right? Always looking for an edge, and I never understood videos I watched on YouTube. Meaning, people would put a video up, and I was like, I don't get what you're saying." And it turns out it's because a lot of them they're cherry picking their charts. They're only using, they're using, what's it called? Uh, the prior, market replay, so they know what they're doing is gonna work, and then like, "Oh, look, it works." Like, "Yeah, well, you knew it was gonna work." And so when you try to apply that to real time, it's like, "I don't get it, I don't get it, I don't get it." So I was always looking for an edge, and then I stumbled upon gamma exposure. I'm like, "Gosh darn, man, this gamma exposure stuff is kind of the real deal." And then you look around, it's like everyone's charging, so much money to get it. And I was like, "I don't understand why it's so expensive, and you gotta go to all these different places for it," when the reality of it is literally mathematics. That's all. I'm like, there's gotta be a better way to do this. So, that's how I got here today. Talking to a friend of mine, he's like, "I bet other people would like that." I'm like, "Yeah, you're probably right." Yep, buy the dips, and there's plenty of dips to be bought, and look where those dips are, lining up to the thin areas. Legend? No, I I am not a legend and do not think I am. I am literally just a middle-aged guy losing his hair who loves more than anything his wife and kids and clang and bang in the morning. I love to exercise, love to work out. All jokes aside, I also believe in integrity, service, and excellence in treating everybody with dignity and respect. And that includes people I've never met before, like you guys watching a live stream. I've never met you, but you are part of the family now because you come here every day and we're all together. And so I want to give back. And if any of this helps you become a better trader, or if it just helps you get through the day, perfect. That's all I'm looking for. I don't want anything more than to know that maybe you got a smile out of it, or maybe it helped you make a trade, or maybe it gives you something to talk about when you meet your friends, or I don't know. If it helps, great. That's all I want. I got to I have a this is a side hobby for me. I do it for fun, and I mean, look at me. Look, my hair is gone. I'm old. My face is wrinkly. But check me out. I'm talking in this microphone. I got these cheap headphones on that I bought my daughter from Goodwill for $4, and now I took and she can't find, and hope she doesn't come down here and see them. This is the most fun I've ever had. It's Monday at 10 o'clock. I'm talking to people from Australia, from Vienna. This is awesome. We're rocking and rolling. And we're positive gex. What more could you ask for? All right. But in all seriousness, I have got to hit the mute button. I got to go over to my other job. Thanks, Bray. But I'll leave my camera on. It's a 10:09. I'm gonna put this in the chat. So if someone comes in just let them know that I'm here, but I do got to get to my other job. So here, I'm going to try something out also. Let's just try this. I'm going to, just so it's not boring, I'm going to turn on my computer speakers. Now bear with me on this. This is the first time I've done this. I'm going to go to Trader TV. I'm going to click play.
The Russia-Ukraine conflict, where India actually did it imported, and India is not an energy producer at all. So the numbers.
Can you guys hear that?
That's because they were obviously moving that to the international markets. That probably will happen in this type of.
And I'll put that Schwab News.
Well. I think the last thing that we have to also keep in mind here is the fact that we are seeing the cooking oil aspect within India is really impacting their economy. And a lot of that LPG, or a lot of the tankers have been actually moving LPG.
You guys let me know if you can still hear that
really
Schwab News
so
person
that will
talking.
actually put a little bit more pressure on their economy as well. So a lot of dynamics taking place here. We'll see how everything kind of shakes out. Market's trying to be as optimistic as possible. If you're looking at these red lines between the U.S. and Iran, it's not only just the enriched uranium, it's the ballistic missile program. A lot of different items that probably did not get resolved over the weekend. And I think that probably gives
what
us
happened
a
to
little
that?
more heightened.
Oh, you know what happened to the delta meter?
Volatility here in the back end.
When I put it on, I didn't save. This is my custom delta speedometer that tells the 1 tick. I'm sorry, 1 second average. So now I will save it. If you don't go into Ninja Trader, here, let me show you guys this. If you don't go, every time you make a change to Ninja Trader, this is the toolbar. You have to go to workspaces, and whatever workspace you have, this one was just called Jason 1. You have to click save. If you don't, what I just did here, by adding that delta speedometer, when you close Ninja Trader, it'll go away. It won't save. But just FYI. And I can't tell you how many times I've got bit by not hitting that save button. Just like when you're writing a term paper, man, you don't hit save on that, your next weekend's taken.
I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
Intern, this place is incredible.
It's where I get all your office supplies.
Your golf balls,
Your fancy coffee, your giant TV.
it's everything in one place. It's like
Schwab. Everything investors need, all in one place.
Come again?
Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between.
Think I'm gonna be sick.
We have to buy that now.
Schwab.
Invest your way with Schwab.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
We're back on Morning Trade Live. Goldman Sachs double downgraded shares of Best Buy to sell from buy with a price target of $59. The firm cited a risk to margins as higher memory costs lead consumers to potentially trading down and volume declines as manufacturers prioritize fewer consumer electronic shipments. So we are down almost 3% on that name this morning, $60 and change on Best Buy. Let's take a look at some of the other movers and shakers on the session so far for us this morning. We've got the leaders board here as we can see a number of these software names, as KG and I were talking about, getting a little bit of a look in today off the back of being pretty much beaten down last week. ServiceNow up 5.5. You've got Workday up Oracle up 5.5% right now, and Albemarle in the business of materials is up 6.5% right now. So there's some of the winners on the session. Let's take a look at the laggards board. Some of the losers. Momentum is
Them and
lower.
that is correct.
Sienna is down. Conagra down.
That is exactly what
4.5%,
that
and
means.
Goldman Sachs down 4%. Even though
Wow.
we got a beat recently, of course.
There are my
a
other
record
dashboards.
equities trading revenue number, and of course we did see revenue and fixed income coming off, so it was a bit of a mixed quarter. All in all, it was a beat across the top and bottom line for Goldman Sachs, but we are trading lower this morning on that name. All right, joining us now is Michael.
Oh, that's
Charles, who's the portfolio manager at
687,000,
Ion Macro
not
Fund.
million.
Michael, it's always nice to check in with you. Thanks
Just
so
so
much
you
for
know,
joining
this
us.
is
So obviously we continue
what
to
the
monitor these headlines
dashboard,
from the
other
Iran
dashboard
conflict.
looks
The
like.
markets seem to suggest, given this
Turn that off.
performance
Here's
this
your
morning,
intraday GEX
that
shift, so you can see we
the
opened
fragile
up
ceasefire,
down.
while
Then this
somewhat
is about when that
confusing, is at
candle
least
was
holding for now.
9:48ish.
Right, we got
Huge
failed
shift
talks,
up.
but Trump seems to think the meeting went well.
That's
We
what
need a bit of
the
an update on
exposure
what
looks
this
like right
blockade
now.
actually looks like. But how are you thinking about it from a macro perspective?
All right.
Well, as you said, it is a ceasefire.
Can you guys hear
It's
this
something of a
Schwab Trader
ceasefire within
TV?
the market as well.
I have my
I think we had a lot of de-risking
computer
between
microphones
March
that
1st
are
and the first
sending
week of April.
volume to
And
me
I think people are
muted,
sort of
so there's
hardly
not
engaged with the
feedback
market, and
going.
I think
But
it's
hopefully
going
you
to be
can hear
difficult
that.
to shake them out of their new positions unless there's an obvious deterioration of what is happening out there.
Do you think the market is adequately reflecting the macro impact? I mean, is this a good or bad indicator right now?
I think it's doing the best it can with, very imperfect information and a very fluid situation. I think to me, the very big question going forward, and I'll tell you right now, I don't know the answer to it, is are we just in a period of sustained high energy prices, which I think can be managed by the sort of global economy and by the global equity market, or do we actually run into
And we are making lower
shortages
lows
of
here, so
energy,
keep that in mind
at which point,
as we come back to that operational moving
at
average.
which point you may
This is a
see
pretty big line in the
industrial
sand here.
activity really shut down in different
We're near a
parts.
wall
As I say,
and
the
making
first one
lower
I think
lows,
is
about
fine.
at the
The
operational
second one was
average.
like
So
really a
let's
problem.
watch and see what happens.
In theory, over the next couple of weeks, we should start to see the effects of this conflict turn up in the physical market. All that oil which was on its way from the Gulf to the Far East, leaving at the beginning of March, that is now arriving. And so we should start to have sort of rolling shortages from this point on. So I think it's a tense few weeks. I think it's helpful to some extent that we'll have the distraction of corporate earnings, which means that the headlines out of Iran won't be the only thing that the market has to react. As I say, on balance, I still think we end up in a sustained period of quite high energy prices. And the nice surprise is that the global economy seems to be more able to keep on moving with high energy prices than people would have expected 2 or 3 months ago.
How much do you think, as far as those higher energy prices, and then obviously we need the duration on that, can the markets, I should say the economy, Michael, withstand right now, given where it was at?
Yeah, there's a lot to love. We did come through that wall. We are below the operational moving average. And you can see there's long wicks on the top. See the volume, order flow volume profile, point of control.
Somewhere between $90 and $100 a barrel is quite
just changed. That point of control just changed. So now we're at, actually this candle's below point of control. That candle's below point of control. All right, guys. I literally got to get to my other job for a little while. So I'm going to turn that Schwab Trader TV back on. I'm going to hit the mute on the mic.
Going from $3 to $5.
And I'll be back when I can. I got to update some charts. We have a big briefing day, pre-brief today, then another brief on Thursday, I think. And oh, by the way, Thursday there won't be an afternoon live stream because I have a doctor's appointment I got to drive to. So just FYI, I'll remind everyone as we get closer to that. So, all right. Happy trading. It's 10:20. If someone comes in and asks, "Where's this guy that's losing his hair?" you can let them know I'm at my other computer working on some stuff. Check out that shift. It's down 22 right now, by the way.
Growth, kind of mediocre real growth, and what that really means, as far as the U.S. equity market's concerned, is that you shift, a whole bunch of, you shift a whole bunch of earnings capacity away from non-energy towards energy. I think energy just very straightforwardly ends up being a big winner out of this.
Okay, we'll be watching. Michael, always appreciate it and your insights today. Michael Shaul, Portfolio Manager at Ion Macro Fund. Thank you so much. Coming up, we will get a closer look at the big picture with the team from Charles Schwab. Morning Trade Live will be right back.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
How's it going?
First day, so.
Sometimes,
Next.
Try it again?
you could have done better.
Please?
Same goes for where you invest. Level up and invest smarter with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
We're back on Morning Trade Live. CoreWeave is up this morning again after Macquarie upgraded the company to outperform with a price target of $125, up from $90. The firm pointed to CoreWeave's recent deals with Meta and Anthropic as strengthening its role in the ecosystem, to the point of becoming structural instead of a stopgap and validating a differentiated platform now. So this has been up about 30% in the last 5 trading sessions, putting on another 8% this morning for us, trading at 110 and change for CoreWeave. So it's having a really nice run here. So that is the price action off the back of the Macquarie upgrade. Welcome back to Morning Trade Live. It's time for the big picture. Let's welcome in Colin Martin, Head of Fixed Income Research and Strategy, Schwab Center for Financial Research. Very good morning to you, Colin. Thanks so much for joining us. As you write, new week, same uncertainty. So how are you and the team thinking about things this morning?
Hey, Sam, thanks for having me as always. We're looking at it based on the headlines with the conflict in Iran and what's going on with the price of oil. I mean, we have plenty of economic data that comes in each week, but it seems like the markets, whether it's the bond market or the stock markets, they're being driven mostly by headlines in the Middle East. And that's kind of driving our view right now. It all comes down to the price of oil and how long it stays elevated or how long of a pass through that will have into inflation. And again, that seems to be the key driver. I mean, if we go back a week ago or a little bit less than a week ago, we got some good news with the announcement of a 2-week ceasefire. So that pulled Treasury yields down a little bit. It lowered expectations about the path of Fed policy, where potential rate hikes switched to rate cuts again. But now we're back where we started, and Treasury yields are back up again as the price of oil has increased. So we're using that as our guidepost right now, but we're trying to take a step back and have a more of a long-term view. So even though we see Fed rate cut expectations or even rate hike expectations shift by the minute or the day, our view is that we expect the Fed to remain on hold for several meetings. So that is mostly unchanged. And when we look at longer term Treasury yields, like the 10-year Treasury yield, we think it'll probably stay in the 4% to 4.5% range. There'll be some volatility in there. It'll bounce around in the range, likely given on news and headlines of the direction of the price of oil and a potential end or no end of the conflict. But we expect it to trade in that wide range for now. So even though there's a lot of moving parts each day, a lot of new headlines, our views haven't changed too much from where we were coming into the start of the year.
Okay, yeah, I mean, this 10-year note, the bond yield has done quite the short-term round trip as we've seen just in recent sessions or so. I'm just wondering then, there seems to be a debate going on about the stag versus deflation. I just had my previous guest more sort of focused on the latter part of that, but then I had another guest on last week who was more concerned around the stag part of the equation. And, you know, she was saying that there's a serious problem with the integrity of the data coming out of the government, and even said that 80% of economists in the US are in agreement with her. So I'm just wondering where you guys sit on that debate right now, as we've started to see tinges of it coming through in the data.
Yeah, well, it would be a concern if that were to come to fruition. I'm not saying it won't, but it's a concern of ours because we know that the longer that the price of oil stays elevated, we do see risks to the economy and to the consumer and to consumer spending. So if we look at the stag part of the inflation, that part always gets me. Stag, I guess we're talking about growth there, right? So on the growth side, growth is still okay. And that's been our case coming into the year. We've seen the economy growing at or above trend for a number of quarters now. And we thought 2026 would actually be pretty strong given the tailwinds we'd see with tax refunds and the stimulus from the One Big Beautiful Bill Act. So that was pretty good. And I think it'll take time for the potential negative consequences of a rise in oil and gas prices to filter through to the economy. And I think we're generally seeing that so far. The labor market, yes, there's some cracks forming, but we got some good news with that March non-farm payrolls report. The unemployment rate remains relatively stable. So I think that's good, but the longer the conflict goes on, it poses a risk there. But for now, it appears to be holding up. On the inflation front, I think fears of stagflation usually go back to the 70s and 80s, and we're nowhere near those inflationary numbers. You know, inflation by whichever reading you want to use, say in the 2.5% to 3%, maybe a little bit more than 3%. Yes, it's above the Fed's 2% target, but it's well below levels we saw just a few years ago. So we think that those fears are probably a little bit overblown for now, but it is a risk the longer that this conflict goes on, because so far everyone's talking about inflation, but there can be negative consequences. And that's something that investors need to consider. If that flows through to the economy, that should flow through to businesses. And that can have an impact on stocks. It can have an impact on corporate bonds. And there's a lot of flow through there.
Right, and at least we're starting to get some corporate reads this week on how some of these companies are actually thinking about this. But I guess it's no surprise then, Colin, given everything you've just highlighted, as to why TIPS, which are obviously the government bonds which protect against inflation, have been outperforming across fixed income. Can you explain just by how much as far as that relative performance is concerned?
Yeah, we think TIPS would be a pretty good investment to consider if you are worried about stagflation, because in a stagflationary environment, you have slow growth, but high inflation. And that's a conundrum for traditional treasuries, because which will be the key driver there? Will it be inflation that pulls yields higher and prices lower? Or will it be the slower growth aspect where investors want safety and they go to perceived safety of U.S. treasuries? It's an unanswered question. If you look at TIPS, though, they have inflation protection because they're indexed to the CPI, but they're still considered safe. They're backed by the full faith and credit of the U.S. government. Now, there can be price fluctuations. We always like to say that TIPS can offer protection over the long run. They're not necessarily short-term hedges, because we saw that in 2022. But if you're worried about inflation and you're worried about slower economic growth, we think TIPS are pretty attractive right now, especially given their positive real yields.
Okay, then, Colin, what's the next catalyst you're looking out for as far as moves in these markets, given we get back to fundamentals this week, but no doubt keeping an eye on the macro picture as well?
Well, I think we're focusing most on the conflict. Good news, bad news, that's the key driver. But we're going to be looking to see, are there potential
Connection
spillovers
lost.
to the economy? And that's when we'll get a little bit more nervous if we start to see that, because right now, if we look at the Fed, for example, inflation and oil prices are the key driver there. If we start to see the spillover and we start to see consumer spending decline or retail sales decline or more cracks forming in the labor market, that puts the Fed in a more difficult situation where their mandates could be back in tension. And again, it's not really the case right now. Now, it usually takes time to see this flow through to the economic data, but that's really what we're looking for. So cracks in the labor market, but again, they've been okay so far. And I'd say cracks in consumer spending. If the high price of gas is taking away spending from elsewhere, that would be a cause for concern. Again, so far things have been holding up relatively well, but if we start to see a slowdown in other parts of the spending markets, then we'd start to get a little bit more concerned.
Great stuff, Colin. Really appreciate it. Thanks so much for joining us today. As always, Colin Martin, their head of fixed income research and strategy, Schwab Center for Financial Research. Coming up, it's time for the morning trade, and we will take a closer look at Nike after another downgrade. Can't catch a break, this one. Morning Trade Live. We'll be right back.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
We're back on Morning Trade. The focus on Nike now. The athletic footwear and apparel company is down over 30% this year and down over 20% in the last 20 trading days alone. Here's a look at the charts. It's uncomfortable. It's down 0.4% right now, trading at $42 and change. But as you can see, it's come a long way off those highs that we saw. So it is very much on a downward trajectory here off the back of course, its earnings, some of the downgrades we've been talking about as well. So that very much is the focus of the morning trade. So joining us now for a closer look, I'm very pleased to say, is Marley Caden, who's back in the hot seat. It's so nice to see you, Marley. Hope you had a nice week off. So Nike just can't do it. What's happening?
Yeah, just can't do it, Sam. And it's not just coming from HSBC. This is just the most recent one, and it's great to be back with you as well. HSBC downgrading Nike this morning to hold They've got a new price target of $48. That's down from $90. Right now, trading below that range at about $42.39 for Nike. They cited a few specific things, but the overarching theme of the note from the analyst is that they have limited visibility on the company's business recovery. They just don't feel like it's moving fast enough. They said that the turnaround thesis has shifted from what they called a not if but when thesis to now a show me story with no short-term catalysts. As we know, Nike CEO Elliott Hill, who took the helm back again in 2024, has made a lot of restructuring decisions from people to processes to products, but is still showing weakness in Converse brands in China, in Europe, in the Middle East, in Africa, and sportswear continues to weigh on the company's recovery. So in addition to the downgrade and the price target adjustment, HSBC also cut its fiscal 26 and through 28 EBIT estimates by about 35% for Nike. That's a huge reduction. Also got a note from Piper Sandler on Friday downloading Nike. They downloaded them to neutral from overweight. They cited saturation concerns in the athleisure segment, aka sportswear. They made their price target $50, so just barely higher than HSBC's. RBC Capital still somewhat bullish. They have their price target at $70, down from $78, but also cited these prolonged recovery challenges, particularly mentioning Greater China and other segments. That China story, as we know, Sam, we covered the earnings live together, was a big miss for the company. And I think that that's where there was some optimism coming into earnings this quarter. And it just didn't hit for Nike. So, I mean, just in the last month alone, we're seeing them down more than 20%.
Yeah, it's that turnaround story that's just not convincing at the moment, and it's really about the timing, isn't it? It just hasn't proven itself at this point, and you say the China story is such a big part of it, but the last time I was looking at an overall chart, it was trading down in the low 40s, was back in like 20. So it's a tough chart as we had up on the screen earlier. But thanks so much for getting us across the details of this latest downgrade, Marley. Let's trade this name now with Mike Shaw, Director of Trading Education, Prosper Trading Academy. Mike, so nice to have you on the program. Thanks for joining us. Walk us through an example trade for Nike, because as I said, it's a bit of a tough chart.
Yeah, it's a really tough chart. And, if I had to make, a trade in Nike right now, it just doesn't make a whole lot of sense selling it on the lows if you don't have, a position that you're just like, well, I'm just done with this. And so looking at it from the outside, that you're looking at it from an inside out type of way that you probably have more room to the upside than the downside. It's not like Nike's going to zero. It certainly feels like it. But if we're bottom picking here, then, and I was looking, my initial thought was, well, implied volatility should be high. It is. It's up in the 73%, but actually the put skew is not really all of that steep, meaning that I think that we're probably bottoming out here. So I think that if you're going to do something, that you would take a shot to the upside. So I'd want to give myself a little bit of time and go with the May 45, 47 half call spread. You should be able to buy that for around 40 cents. And, that's obviously a pretty good reward to risk ratio, probably, in the upper threes there. So it's just very hard to initiate a short position here, even though the chart doesn't look all that good. We're still holding that 42 level. And so if we can get any sort of good news, I think that we have a little bit of bump in this stock.
Okay, we'll certainly be watching. I mean, as we mentioned, it seemed to be the cadence of that turnaround story that's just not doing it for the markets and the street right now. Thoughts on the overall performance of the market? I mean, a bit directionless today, Mike.
Yeah, I'm surprised we're not down a little bit more today, or at least exploring the downside and see if the buyers are going to come in. But at least, early on, we're seeing a little bit of support here, which I'm frankly kind of surprised about. I think that, I thought they'd let it run a little bit, and I thought that the buyers would come in a little bit lower, but not here.
Yeah, I think some are surprised by the moves in the market this morning and the lack of, because of course we do have oil back over $100, but I think everyone's just waiting for the contours of, what's going to happen next, what's going to happen with this block as well. looks like the ceasefire is holding. So I think markets taking some comfort in that. Mike, always
Holding for
appreciate
now.
it. Thanks so much. Yeah, that's it. Mike Shaw, Director of Trading Education, Prosper Trading Academy. Always appreciate it. Coming up, we will take a closer look at the sectors on the move this morning and international headlines impacting global markets too. Morning Trade Live. We'll be right back.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Welcome back to Morning Trade Live. I'm Sam Vardas coming to you from the New York Stock Exchange. It's time now to take a look at the sectors that are moving markets this morning. So I'm joined by Alex Coffey. Very good morning to you, Alex. Happy Monday. So we've got a flat performance for the S&P 500. It looks like some push and pull beneath the surface. Walk us through what you're seeing there.
Hey, all in all, Sam, good morning to you. Happy Monday. It's kind of a, relatively strong start, I would say, for equities. We opened last night in the futures market, so quite the comeback. That said, this is about as unique of a breakdown sector-wise as I can recall since the onset of this particular conflict. So really what you've seen is a push-pull between energy and utilities and consumer staples on one end, and then everything else led by kind of high beta technology on the other. Now, embedded within all of this has been the software weakness, but what you have today uniquely is a little bit of relative strength out of the energy sector. Not surprising. Crude oil back over 100 both in Brent and in the May WTI contract. You have financials a little bit higher here alongside earnings kicking off. And then you have IT higher. So first I was like, okay, that must mean that some of these more memory-centric chip names are leading. Well, no. You look over and NVIDIA is a little bit lower on this. So as you look at the heat map of the S&P 500, you're going to see a big green area. And it's the software stocks, Sam. They're making a comeback today, and it's a much-needed one.
Yeah, and do we know exactly what the catalyst is here, or is it just this sort of short-term money that just keeps bouncing around in this never-ending kind of ping-pong match we're seeing between hardwares versus softwares?
Well, because it's a general move as a sector, there's clearly relief. That said, Oracle is up 7%, almost 8% today, Sam. So I look over at Oracle to begin, and they did unveil a few AI updates at particularly for utilities at an industry event. Now, I'm not going to say specifically that this is the driver, but it does highlight that these companies are still working to solve, market needs, and they're doing so with AI technology that is seen as sort of disrupting their spot in the marketplace. So I don't know that it's exactly the catalyst, but it's something that's sticking out to me, and it seems to be the market mover within that sector today. So it's something that has my attention for sure. You do see a bounce back in some of the cybersecurity names as well. So that's certainly something to monitor after the weakness that they saw last week as well.
Yeah, and as I mentioned, you had Dan Ives out with a note overnight talking about, there's going to be another turbulent week ahead for technology stocks, saying that the big tech winners are on sale now. And he called out a couple of those cybersecurity names, actually. And as I mentioned earlier today, Microsoft, Salesforce, now as well in his note. I mean, he thinks this whole thing has been a bit overblown with respect to the SaaS apocalypse. But that's Dan Ives, obviously, for you. But just walk us through anything else that stands out. I mean, Mag 7 related. I know you highlighted Microsoft, NVIDIA, but anything else that sort of catches your attention today, Alex?
Yeah, what really stands out is just how fought to a draw Mag 7 is as well. You don't see a lot of bright colors. It's pretty mixed in terms of performance. You got Apple, Amazon, Meta, NVIDIA all lower. You have Tesla, Microsoft, Alphabet higher. So about as unchanged this would be if you were to index it. It's almost perfectly unchanged. It's 1/100th of 1 percentage point lower on the session. So a little bit of a drag today, Sam, on the overall index, but all in all, I think it's really symbolic of the performance you're seeing, which is a very mixed market today that has about 50-50 breakdown up versus down, depending on the index that you're looking at.
Yeah, it's a tug of war, it seems. Alex, really appreciate it. Thanks so much for highlighting what's happening beneath the surface for us today. Turning to the price action overseas now. Regional equities kicking off the week mostly lower as oil was back above $100. Stocks in Hong Kong, South Korea and Japan all tumbling as risk softened on the news of the blockade. And we're seeing follow through in Europe right now. The German DAX and Spanish IBEX seeing the deepest losses, although off the session's lows now. The DAX just down 0.3%. A big story in that patch was Hungarian Prime Minister Viktor Orban's election defeat, helping the local currency hit a 4-year high and stocks jumping to a record. But the strengthening dollar today is weighing on other major currencies as traders seek relative safe haven. The euro, sterling, the Aussie and the yen coming under some pressure. The Japanese currency once again nearing the 160 mark right now. So keeping an eye on that. It's economically and politically sensitive. The recent yen weakness is fueling inflation concerns in Japan as it raises import costs. Japan's 10-year government bond yield hitting its highest overnight in nearly 30 years. Now, one bright spot in the market today, Chinese stocks over in the mainland, which ended the day higher. Chinese A shares have shown notable resilience thanks in part to China's energy strategy and AI strides. And shares in Chinese EV makers bucking the trend in Hong Kong today after some solid export numbers. So seeing BYD up right now in these ADR trades. All right, coming up, it's time for Inside Out, and we'll take a closer look at Citigroup and the beginning of bank earnings season and bring you an example trade when Morning Trade Live returns.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to Morning Trade Live. This week is the start of bank earnings season with big names like JP Morgan Chase, Morgan Stanley, Bank of America and Citigroup prepared to report. So let's go inside out on bank earnings season. Joining us now is McCrae Sykes, portfolio manager of the Gabelli Financial Services Opportunities ETF at Gabelli Funds. McCrae, thanks so much for joining us. So Goldman first cab off the rank. We're seeing a negative reaction, even though it was a top and bottom line beat. We've got JP Morgan, Wells Fargo, Citigroup up next, and then on Wednesday, Bank of America, Morgan Stanley. What are your expectations and anything we heard from Goldman that's giving you some clues?
Yeah, I'm a little surprised in the Goldman reaction. I guess people are just sharpening their pencils around some of the expectations of the numbers. But when you go to 30,000 feet, they did a 21% ROTE. They beat estimates. They had a record backlog at the end of December, but that's still very strong today. You have the IPO issuance, record levels in a number of their businesses, and then their M&A, which is a huge part of their franchise, just continues to be very strong. So a great outlook from the CEO this morning. And I think that sets the tone for the other investment banking franchises on the street. So we'll hear more from them as the week progresses.
Okay, so obviously that is if you do have more of that exposure to the equities trading as well. I'm just wondering if you're more sort of consumer facing, also thinking about some of the regional players as well. How are you thinking about those?
Right, so I mean, we know that this is pretty significant cycle coming in investment banking and M&A, and we had a delay as Solomon talked about a little bit, just given some of the macro events. But if we can move ahead on some of that stuff, the pent-up issuance, so that's a really nice hotspot for the overall market. But on the consumer side, I expect pretty good, commentary from the banks in terms of, I think the retail spending's been good. We know that there's been solid refunds, so the average refund up $300 year over year. We did have a decline in consumer confidence, but unemployment has been relatively stable. And credit also at the consumer level has been stable as well. So you put it all together, I think, slow to modest loan growth, and, capitalizing on some of the balance sheets, et cetera, and NIMs have been pretty stable. So a pretty good quarter set up and kind of within the expectations for the full year for the banks.
Private credit, what do you expect they're going to say about that?
So we heard from Goldman Sachs, which is a big player in private credit, over a 30-year history. They actually had net inflows into their private BDC, and they deal mostly on the institutional side. So I think that's kind of the evolution of the space. So as we've seen some stress here, widening of spreads, et cetera, they're seeing institutions that are looking to commit more to this space, in contrary to some of the issues related to fraud we've seen in some of the wealth management platforms and more dedicated private equity firms that service those. So look, I mean, it's going to be a challenging part of the market. There's lots of skepticism, certainly the headlines from the media as well. But, for somebody like Goldman Sachs and the way they explained it, this is another cyclical component to credit. They look forward to taking opportunity from it, taking share. And even though they acknowledge that there will be some challenges, they're well positioned.
Right, I haven't had a chance to look through Goldman's call yet, but I'm just wondering if they did touch on anything to do with artificial intelligence, given some of the banks that we're going to be hearing from this week did have their CEOs meet with Powell and Bessent in DC last week over some of the fears regarding Anthropic and obviously, just how powerful some of that technology is, scary enough to get at least a lot of them in the room together.
Yeah, so there were a couple of comments related to that. I would just say that first, this was not the first meeting that they've had as bank CEOs. It's been an ongoing process. So this one was more noted, I think, in the media, but this has been a continuous component for the bank CEOs, just talking about cyber risk, AI innovation, et cetera. So they continue to monitor it. Goldman Sachs is spending a lot of money on cyber. They're constantly at the head of some of this innovation as well. They're working with partners in the AI space. They highlighted Anthropic, et cetera. So they're at the cutting edge of this stuff, and they're doing it both defensively for their own businesses and understanding the disruption, as well as advising clients about it as well. And so the engagement around AI and understanding some of the disruptions is a boost to their overall banking franchise as they provide that advice. So there's a number of puts and takes that are going on. But again, Goldman well positioned to understand the changing landscape as well as take advantage of the advice for clients.
Great stuff, McRae. Thanks so much for joining us and giving us a little bit of a preview of what's to come this week. McRae Sykes there, who's the portfolio manager over at Gabelli Funds. Let's trade Citigroup now with Tom White, host of Fast Market. Very good morning to you, Tom. Happy Monday to you. Just walk us through an example trade for this particular name.
Yeah, typically going into earnings, we see implied volatility levels elevated. Doesn't really happen as much for the banks, right? And that's one of the concerns here. The option market's only pricing in about a plus or minus 3% move either way in the stock, about $3.70 in either direction. And remember, Citigroup just hit 17-year highs late last week. We're just down barely from those levels. So I looked at a strategy that takes advantage of some movement. This is a type of position where you want the stock to move more than that one standard deviation. So I looked at a long iron condor where I'm going to buy an out-of-the-money put vertical. I'm going to buy the 121 put, sell the 118 put, $3 wide bearish put vertical. And then on the upside, on the call side in the April 17th monthly options, I'm going to buy the 127 call, sell the 130 call, $3 wide bullish call vertical. So in essence, the strategy is you're buying a bullish call vertical and buying a bearish put vertical as a combination package of four-legged long iron condor. You're going to pay roughly about $1.30 debit for this position, and it's $3 wide. So that's your risk, the debit you pay on this this position. With if the stock goes below 118 or above 130, maybe you get that outsized move. It expands to $3. So you have potential to profit $1.70. So you're taking probably lower than should be implied volatility levels in Citigroup going into this report with the expectations, hey, it's going to move below that break even of 119.70 to the downside or above the break even of 128.30 to the upside. So looking for an outsized move here. You got 4 days until expiration. So even if you don't get the move right after earnings, you still have a few days left until expiration on this one. But yeah, just taking advantage, thinking that, hey, this stock's had a great 100% run over the last 12 months, and maybe it's due for an outsized move here post-earnings.
All right, and this one's set to report before the bell tomorrow. We will be watching. Tom, thanks so much for the example trade. And we do have markets trading pretty range-bound right now. We are 55 minutes or so into this blockade, so we will continue to monitor headlines throughout the course of the day for you. The Dow Jones down 200 points right now, getting dragged down by Goldman off the back of this beat on earnings. Thanks so much for joining us here live. You've got Trading 360 with Marley next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. Schwab.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it. To leave everything behind, literally come across the entire world, I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Good morning. We're 90 minutes into the trading day. Welcome to Trading 360. I'm Marley Caden coming to you live from our Chicago headquarters. Here's what we have coming up on today's show. Amid the excitement around the Artemis II mission and the anticipation for a SpaceX IPO, our 360 Spotlight will take a closer look at the UFO ETF and how space stocks are being impacted right now. Also, Kevin Green will be joining us today for our Disruptor to discuss a price target adjustment at Jefferies and how the adjustment reflects a healthier CPU demand. Also, Goldman Sachs reported earnings this morning, and it's trading lower despite a beat. Our 360 round will walk you through the report and what it could mean for the rest of the financial institutions reporting later this week. Lots to get to, but let's take a look at how the markets are faring as we open a new trading week here. The S&P trading slightly higher. We're up almost 0.2 at 68.2866. On the NASDAQ, we're up about 0.25%, 25,186. The Dow lower, weighed down by Goldman today. We are down about 0.4% right now at 47,720. And the Russell 2000 trading more than 0.4 higher at 2642.05. For the 10-year, we are moving higher. We're at 433 on the dollar, mostly level. We're at 98.55. For gold, down 1% at 47.3950 a troy ounce. Crude oil over the $100 mark. We're at 102.48 a barrel. That is up 6%. And Bitcoin still within that same range. It's for weeks. We're down about 1.33% right now at 72,520. But I do want to bring in our first guest, Alex Coffey, joining us as usual to take a look at one of the top movers today. Today we're going to take a look at a double downgrade here, though, on Best Buy, Alex.
Yeah, shares down 3-4% after Goldman downgraded, as you mentioned, this stock not only from buy to hold, but buy all the way to sell as they're flipping the cards over here. They do see the first quarter continuing to be supported by pull forward PC demand as well as higher tax refunds, but they feel that the risk shifts beyond the first quarter with higher memory costs likely pushing laptop prices up. And then margin pressure risk as consumers continue to trade down to lower priced items. They also talk about potential unit volume declines as manufacturers prioritize fewer consumer electronic shipments and leads to continued ongoing weakness in that consumer electronics business for Best Buy as well as their appliance business. And they expect that to continue to drag on sales. They also expect negative earnings revisions in the back half of this year. And as a result, they're cutting their price target from 76 to 59. Well, the stock, as you can see down about 3.25%, is trading at 60. So they see not only no upside, but a little bit of downside. They are a little bit bucking the consensus, although sentiment is relatively cautious with the majority of analysts in the hold camp. There is still more buys than sells with an average price target of $73. So analysts as a whole either slow to react, maybe waiting for those new numbers to get an idea of where they want to shift this. But for now, looking for 73, Goldman looking for 59.
Yeah, and you bring up a good point there, because this is one of the first notes that we've really seen. We've been talking about this memory shortage and it's coming and the impact, but this is one of the first ones we're really seeing where it's citing how consumer behavior is expected to react to that. And also even mentioning that they think manufacturers are going to deprioritize some consumer electronics as well. So, as far as any other analyst calls, this is the first note sort of this kind that we've encountered, right?
Yeah, so not any more analyst calls, but I do have something for you that I think you might find interesting, Marley. So it's alternative second measure data. So it's 3 different sources. Kind of gives you an idea of how Best Buy is shaping up using some of these different measurements versus its peers within the industry. Broadly within retail, Bloomberg does a second measure data looking at U.S. transactions or observed transactions. Observed sales are down by their calculations of 8.5% for Best Buy, but for the industry, they're up 14.6%. So that's meaningful underperformance. As far as Placer AI, we've had members of their team across our programming before. They like to look at foot traffic. Estimated visits to Best Buy by their calculation are down 1.1% year over year as of the end of February. And then SimilarWeb, they check web traffic. Web traffic for this company is expected to be up about 2.7% year over year as of the end of March, but it still lags industry growth of closer to 6.1%. So 3 for 3 disappointments when it comes to Best Buy.
Well, Alex, thanks for pointing out those trends for us, too. Always second market data can be very useful in sort of anticipating what's coming next. Thanks to Alex Coffey, co-host of Next Gen Investing, for a closer look at Best Buy, down about 3% today. Do want to broaden things out, though. Welcome a guest who's not new to the show, Patrick Mueller, our friend RFC and president at Bella Advisors. Patrick, great to have you back. It's been a few weeks since we'd last talked, so I'd love to start by just getting your thoughts on the market action we're seeing as we continue to get developments, or a lack thereof, perhaps, with the conflict in Iran.
Great to be with you, Marley. And yeah, we've seen a little bit of a downturn here in the first part of the year, and a lot of that has to do with the Iran conflict. And I don't know that we're going to see any short-term solutions to that. It looks like it's going to be dragging on for quite a while here, so it'll be interesting to see how things play out. But April tends to be a really good month in the market, so it wasn't surprising to me to see a bounce back up here. And I don't think it's going to be for a long time here, but I think for the next week or two, we could see a rally back up once we start reaching back up to those highs. And once we get there, though, I think we're going to see a big pullback. I think you're going to see a lot of institutional money starting to raise cash and take profits. And so I think we could start taking another dip down. So I don't think we're out of the waters here yet.
All right, so if we're not out of the waters, Patrick, what's your expectations for earnings season then? Because we're now really about to get into the thick of things here, and we've got a great, I know we've been saying uncertainty now for months, but we have a great deal more than we were dealing with at the start of our last earnings season.
Absolutely. There's so many things that have been heating up here, and so I think there's going to be some type of catalyst here in the near future. Hopefully earnings come out very strong as they're projected to. And but we saw different components of that, like late last year with Oracle, but I think especially on the tech front, when we start looking longer term, if somebody big not meeting expectations, especially when it comes to the AI projections, because there's just been so much money that's been poured into that, and a rising tide raises all boats. So when we have some type of catalyst where earnings, whatever is going to set that off, whether it be the Iran war or earnings season, whatever that's going to be, we've been due for a pullback here and for things to start rechanging. So I would just caution people who are too overweighted in tech right now to be pulling some of those chips off of the table, as we have been for several months now, just kind of waiting for this to cycle through.
So, Patrick, as you're pulling some of the chips off the table, are you reallocating them into other sectors, or are you holding and waiting for more certainty in the market?
Well, some of the things that we're going into, I like ACYN by First Trust. So that's an ETF that's a structured notes where it's currently paying a 12% yield. So I like that cash flow right now. With all the uncertainty and everything that's going on, I love that cash flow that we can depend on throughout the course of the year. And we don't really have to worry about these ups and downs of the markets. And the other things that I like paying attention to right now is all the reshoring That's been happening with countries coming back from overseas, people starting to do manufacturing back in the U.S., making those pro-U.S. moves because of all the tariffs that's been happening. So we're seeing those sectors really taking off, and longer term, as that's a big push for this administration, that's going to be a longer term trend that I think people can start moving into.
And also with this reshoring conversation now, with some of the damage done to some of the facilities in the Middle East, we're having a bigger conversation about the energy play here at home, particularly as it relates to LNG. Are you looking at anything in the energy space domestically right now?
Yeah, I think it's hard to dismiss. And when it comes to energy here in the U.S., things that I like is taking a look at more so where things are going to be driven with AI moving forward. So there's a fund that I like called Grid that has been performing really well, and looking at all the infrastructure and everything that needs to be put in place. And, as far as your national companies for oil and gas, then, I think you're always going to look at the big players in the market, right? Whether, be Exxon, companies like that are really going to be profiting from this. And we'll see how things go longer term, but shorter term with gas prices and oil prices going up, and us being such a big proponent now of oil exports, I think that's going to be really good for a lot of U.S. companies.
And as we look at AI, you're certainly not the first person to mention the infrastructure play here, but energy, a huge component of whether or not this AI data center build out really plays out to be as big as it is expected to be here. What do you think some of the market is missing that I'm not on a daily basis, at least, having a conversation about utilities potentially being the major winner in this AI rat race?
I think it's going to be such a huge winner. We see that here in Atlanta. We're the Silicon Valley of the South here. So you have all your big tech companies that have big facilities here. And we're seeing these big data centers just popping up everywhere. Actually, we get our internet from a data center right next door to us here, which is a nice little perk. But the amount of energy that's going to be needed is just astronomical. And as we're seeing more and more money going to this AI sector, you got to have the energy to be backing that stuff up. And so I think it's a good play longer term until things start maybe souring on the AI side of things, that it's going to be more hype than what is priced for in the markets right now, which is also a big thing to think about, because you had your top 10 companies and 40% of the growth of the S&P last year that basically all came from tech, and you had 40% of the S&P 500 that finished negative last year, and we're seeing that disparity as we've been going through a little bit of this turmoil the first part of this year so far. And it's really interesting to see how this is going to be played out, because things are so overvalued and so overweighted towards that. Then I like moving towards those different sectors, Marley, and moving into utilities.
And Patrick, I'm glad you mentioned the hype, because we've been talking about how we've seen this great rotation and this rotation away from tech. Still not happening, but certainly a lot of churn under the surface here, some high expectations for earnings as we come into some of those big tech names. How are you working to protect portfolios right now with that as the backdrop? We've got this churn, the rotation, the uncertainty in the markets, plus we've got a new Fed chair coming and uncertainty around that. I mean, uncertainty is just sort of the word of 26 right now.
It sure is. It's going to be an interesting year for sure. And especially as you see oil become, oil prices going up so much, that's going to put a lot of pressure on the Fed, whether they lower rates, do they need to raise rates? So that'll be very interesting. But something we do, which is a great question, Marley, how do you allocate stuff? And we use something called the rule of 100. So take your age, and that should be the percentage of your money that's safe and protected from market losses. We don't want to be taking all that direct market risk. And then the remaining percentage, it's okay to take risk with. So if somebody's 50 years old, you should have 50% protected. Doesn't mean we can't get good earnings on it, just like I was talking about the ACYN ETF, right? We can get 12% yield on that stuff, right, while keeping it protected. So that's just a good rule, because it's not if it's going to happen, it's just when we're going to happen. And you just want to make sure that you don't have all your eggs in one basket, in that tech basket. So when things do pop, that we're not getting caught off guard by that.
Patrick, always great to have you on this show. Great insight there. Patrick Mueller, RFC and president over at Bell Advisors. Thanks for being here today. We've got a lot more for you on Trading 360, so make sure you stay with us. We've got the big three coming your way next. We've got 3 stocks, 3 charts, 3 trades for you. Rick Ducat will take us through the technicals, and Achilles Larea Jr. is joining us to take us through his trades for CubeSmart, Firefly Aerospace, and Intel. That's next on Trading 360 on Schwab Network.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
She looks like you, Dad.
Aw, she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
And Schwab helps me generate retirement income.
All this Schwab as everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. We've got 3 stocks for you, 3 charts. Rick Ducat will be taking us through the charts as always. Here to take us through the trades today, Achilles Larea Jr., the founder and CEO over at Larea Wealth Management. Great to have you both with us. Achilles, Monday to you. Would love to start with your thoughts on how we're starting a fresh trading week here. You know, a little bit of uncertainty, Dow a little bit lower thanks to Goldman. What are some of your takeaways so far?
Well, inflation seems to be the big problem here, Marty. Thank you for having me, by the way. We're starting to see, as far as inflation, we're seeing that perennial increases in wages and pricing. We're also seeing housing, which was half of the CPI, affecting it. We're also seeing, as far as tariffs, deportations made this situation even worse. And now with the war, we're coming upon even more challenges because it's disrupting the petrochemical industry as a whole. So gas, diesel, jet fuel, and helium. And I say helium, well, you need helium in order to make chips. So this is driving up prices at an unprecedented scale. The longer this persists, we're going to see even more problems towards that end. The other thing I would watch as we're going along is inflation is going to be driven up to about 4%, in my opinion. It could go as high as 4.2%, the analysts have been saying, but that's the number we're looking at currently. And also, you want to say to yourself, well, if these prices and inflation are going up, how can we cut rates? As a matter of fact, we're going to have to actually do the opposite. We're going to have to start raising rates if this continues. You know, so once again, wages are not keeping up with the pricing. So imagine you have, home prices starting to go up because it takes fuel to build, get these components to the actual home site. It takes fuel to get goods to supermarkets. So these are things that seem to be raising everything up. We are keeping watch. We also think, with what right now, there's plenty of room to make money, but you can't be timid. And here we are with our 3 picks.
All right, well, I'm glad you got there. We've got to have you back on, though, to talk more about that inflation stuff. But since we have you for Big 3 right now, let's talk about your first one. You picked CubeSmart here. They're a storage REIT. So are you bullish or bearish on the storage space?
We like the storage space. If you think about it, the model is incredible. You have a storage space, and every single year, your rent is going to go up 7 to 9%. So you have a nice revenue to begin with because a lot of people keep their storage spaces. They don't get rid of them that easily. So you could be making anywhere between 7 and 10% per annum on a stock like CubeSmart. We feel that CubeSmart tends to be a name that is not mentioned as much as, say, a public storage per se, but there's a lot of opportunity there in terms of valuation versus the sector. They're going to face some near-term resistance and consolidation because as the market does, so will the storage spaces, but not as much as per se a technology. And they're not in the AI space per se right now. Everybody's loving this AI thing right now. And that's cool. We love it too. But we're looking at about 10 to 12% in an 18-month time period, but not without strife. We're going to see some problems in every name. I would not be surprised, but we're right now, I think, in an oversold condition. So in terms of the near-term resistance and consolidation, yeah, we're going to face some, but not as long. And once again, depends on how long and protracted this conflict is.
All right, Rick. So as we look at the technicals here, are you seeing oversold for Cube or potential near-term resistance?
Well, we have seen a nice bounce so far. And, this is a REIT type of name, not really known for big swings. So maybe these may look more severe than they actually are. We're only up about 4.1% on the year here, down about 12%, 13% off those highs. So what we had here was a bit of an establishment of a supportive level near the 36 level. From there, we have traveled upward, topped out near 39.21 so far during our most recent rally, which really was a nice string of green days that we saw here. 40.19, another high water mark, but really up here 42. Backtrack a little bit. Highs around where we had some more highs here in terms of our closes, but then we had a pretty big drop off after earnings. Then once again, that's where we stalled out. So when we look at our moving averages that we follow, we have seen price cross above most of them in pretty quick succession here. You can see that our 5-day in blue, our 21-day in teal, our 63-day in gold, all of those come together very close to the 38 level. So that gives us a notable bunch of confluence points to watch out for here. Lines up fairly closely with our trend line as well. Meanwhile, our 251-day EMA in orange, our long-term yearly EMA, comes in near 39.60. RSI trending upward here. We are on the verge of perhaps breaking through this trend line here, so watch to see if we slip below the 50 midline. So finally, our volume profile study, not really a lot of clear, distinct small nodes here, more general areas of heavy trading activity. Most notably here, our point of control coming in just shy of 40, so that could be a potential slowdown area to watch out for, a bit of a gulf between 41 to 42 as well.
All right, and CubeSmart right now just trading marginally lower on the day, down about 0.8%, but like Rick mentioned, up about 5% so far year to date. Let's take a look at your next one here. It's actually a good setup for our next guest here. You're looking at Firefly Aerospace. Take me through why this is the second pick in your Big 3.
Yeah, we actually missed the boat on this about a year ago. I was looking at this a year ago. I held off on it, and I usually don't hold off on these type names, but we feel that there's plenty of inherent value in the stock. We're looking at a 12% move to the upside in the next 18 months. We feel that versus the sector, there's a lot of potentiality in terms of the stock. could make you some decent money in a short period of time. Maybe that 18-month is being super conservative. Maybe it's not. But compared to its peers, unless there's some big pullback in the sector, which we don't see currently, we're going to make some decent money. We also think that just like its peers, good, high quality company to be added to the portfolio long term, and you should do well with this. The last thing is that there may be a correction in the sector as a whole, or some sort of consolidation, but we're not high on that at this particular point. But we have to point it out. We think that there's still plenty of room to run on this. We're not backing up the truck yet. We are accumulating the stock.
All right, and Firefly, a really interesting right now in terms of talking about Artemis 2, and they have lunar launch and orbital vehicles here. So as we look at Firefly in terms of a technical setup, Rick, and obviously a lot of hype in this space with the SpaceX IPO being mentioned as well, what are we seeing here?
Yes, exactly. I was kind of thinking the same thing. Very much renewed interest in just space exploration in general. One of those charts where we look back at gaps and notable horizontal levels. First, we saw some highs here and corresponding lows here. That matches up with 49.25 and 41.50. You can see 41.50 is where we topped out recently. To backtrack once more, another gap here, a low point that we saw came in at 34.50. That was another high point there. So these levels could stand out going forward here in the shorter term, but for now, an upward sloping channel type shape between our two white lines is the prevailing theme. So not quite a full year of trading activity to go with yet. So in this case, I'm pivoting to our simple moving averages here. You can see that our shorter term 20-day simple moving average are pretty notably below current price activity, only coming in around the 29 level. RSI remains overbought here, above the 70 threshold here, but our green trend line seems to have been broken. Look for if we do get a crossover below our 70 threshold and also below our trend line kind of at the same time here to show a bit more of a bearish type of signal here. If you did have a bullish outlook still, that would when you would be starting to look for a point to buy in during the pullback. So when we look at our volume profile study, a couple of smaller nodes to consider here. One between 37 and 41 is where we find ourselves right now. Not a ton of trading activity then. Things really start to pick up around 30 then as well. We have our point of control near about 24. To the upside, 45 to 46 or so. That's where the most other notable pocket of trading activity is to the upside.
All right, Fly, you mentioned doesn't have a year of trading under its belt, but just in the last month, up 64% as the markets are definitely taking a closer look at this space sector. But let's move to your next one, Achilles. I'm going to talk to Kevin Green about them in a little bit in this show. They're a disruptor today. We're talking about Intel here. Got an upgrade this morning, trading more than 3% higher right now. What's your take on Intel?
Well, Intel's always been interesting to us, but lately it was kind of boring. So we've seen U.S. government investment and more interest, more institutional interest year over year in the stock. We think that the stock could easily go to 11 to 12% in an 18-month time period, although we feel that is conservative. The big thing here with Intel is that you want to own this as a complement to your NVIDIAs and your other, and it's kind of funny to say that considering that it was the dominator quite some years ago, and all of a sudden they're becoming relevant again. And we feel that's a super positive, and there's still money to be made. A lot of inherent value in the stock. We don't see any big things in terms of consolidation or near-term resistance to stop this from going up in the short term. But this should be, like the other names we mentioned in the chip sector, should be part of your overall strategy. So just like your NVIDIAs and Taiwan Semiconductors, Intel has to be part of a high quality portfolio. You don't have to own more than a certain percentage. You just keep it within reason. And that doesn't mean 20%, by the way.
Good point. And Rick, as we look at Intel, Achilles doesn't see any potential for near-term resistance coming up here. But as you look at the technicals here, are you seeing any levels that you're keeping an eye on?
But yeah, mostly to the downside here. The gap right here is where I would highlight to the downside, matching up with first our old high point here near the 54.60 level. Then our gap began around 53.27. Very steep trend line here in white still in play here, continuing to make new highs. Our old channel type shape here between our two blue lines has been long ago broken with that big gap to the upside. So now we can see as well that our 5-day EMA in blue, 60 roughly is where that one comes in here. So that could be a short-term breakdown point to watch out for. We can also see that RSI, while still oversold, much like our last chart, has pushed beyond our green trend line here. So look for that to also coincide with a break below our trend line if we do slip out of that overbought area. Finally, our volume profile study shows most of the recent trading activity lines up with this range-bound period between about 49 or so. Not really a lot of significant volume beyond that level to the upside here. So a pullback to that level would be notable because that's where many established positions could reside already.
All right, and as we take a look at Intel, as Achilles mentioned, was a bit of a quiet name for a bit there, but no longer year-to-date up 75% for Intel. Achilles, thanks for being with us today for the Big Three. We'll definitely have to have you back to have a broader conversation, but we appreciate your picks today. Achilles Larea Jr., the founder and CEO at Larea Wealth Management, and of course, Rick Ducat, our lead market technician, for always being with us. Coming up next, we are going to spotlight the latest in space explorations as Artemis II returned home this weekend and how that's impacting space stocks. Next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Schwab coaching is concepts brought to life in the real world.
It's absolutely world class.
We have coaches who have been in the industry and around the industry for a long time.
We have different formats because people learn differently at different times.
We have webcasts running through YouTube all day, every trading day.
We've got events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
How incredible is that? And it's free.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Welcome back to Trading 360. I'm Marley Caden, live in our Chicago headquarters. It's time to spotlight space stocks. Artemis II returning to Earth this weekend. Lots of excitement around a potential SpaceX IPO and how the market is responding. Joining us now to take a closer look, Andrew Chanin, the CEO and co-founder at Procure AM. Andrew, thank you for being with us today. You know, a lot of hype around space right now, space exploration, and all of the companies tied to it. You know, as we talk about SpaceX, I think that's a primary driver here and a good place for us to start. It could be one of the biggest IPOs we've ever seen. How transformational do you think that could be for the overall market, not just for these space and aero defense names?
So we've been hearing from index providers around the world, which is in many cases how a lot of investments tick. and they're looking at potentially rewriting their index methodology guides to handle potentially an earlier entry of a potentially newly IPO'd company into their indexes. Many times you have a waiting period and a look and see, and we're hearing companies from around the world that develop these various indexes, including technology-focused ones as well as broad-based ones, are looking at finding ways of potentially including a company like this earlier than normal. So that alone shows how important such an event as an IPO of SpaceX could be.
So if we're looking at rewriting the rule book just to get in early for SpaceX for some of these investors, do you then say that there is an expectation that this will become the largest pure play space company nearly immediately? I mean, potentially overnight? Or are we getting a little bit ahead of our skis here?
I mean, this is a company that we're talking about, potentially being over $1.5 trillion in market cap. Although the float offered at IPO might be significantly lower than the overall market cap expectation. This is a company whose market cap at those levels would be larger than the annual global space economy at today's levels. So we're talking about a major impact. But this is a company that many people have been inquiring about investing in. It's been very difficult to get pure play direct exposure to it. Many people looking to utilize potentially costly SPVs or other ways of getting some exposure to it. And this would be a way for retail investors to get truly direct exposure. So to the extent that there was a large buildup of demand for many players, this might be their first way to get that exposure. So I think a lot of people are looking at this from the media perspective, from the investment perspective, and what this could do for the overall space industry as far as bringing more investment forward, which could be one of those uses of that capital raised at IPO.
And so how does that then reshape the competitive landscape in this space? If its market cap is going to be bigger than the whole of the industry as we know it right now, how does that affect the other companies and the inflows we see into the space?
So that will certainly be determined in the future, but this is something that, if you have such a large company, it could be a major competitor, but it already is, even as a private company. That said, there had been talks towards the end of last year that Sam Altman was looking to create a rival to SpaceX, and he said that he would do so by either building, partnering with, or acquiring existing space companies. To the extent that SpaceX says, hey, we have more cash and the ability to acquire those companies to block out a potential emerging threat, that could be one use case, or pulling forward investment in certain areas like orbiting data centers or other areas that we're starting to see some significant investment interest in. These could all be uses of proceeds. Now, for other companies, what we've noticed is that for some, just because SpaceX is doing well doesn't necessarily mean that it hurts those companies. SpaceX, you have to remember, is the pioneer of reusable rockets. So the significant amount of reduction of cost to access space is something that SpaceX helped provide. And for companies that need launch services, their ability to continuously reduce the cost of accessing space could be a driver for other companies. So it's not necessarily a one company wins all. In many cases, what we've seen is we have companies that build out infrastructure for space that can benefit that company, but also in many other cases benefit other end clients.
So we've been talking a lot about investor demand in there and it moving into the space. So I want to talk about your ETF, your space ETF. UFO is the ticker here. I was just talking to my last guest about Firefly Aerospace, which I think is still a part of your ETF here, and just the massive move we've seen into this sector. As far as that surge in investor demand that we're seeing, how much of that is tied to the SpaceX IPO versus Artemis II launching and the excitement around that? Or is it more just broadly tied to space still being the new frontier, even though that's been a line for decades now?
So it's difficult to tell exact percentages of where the interest is coming from. But for us, we've been seeing inquiries from investors, small and large, as well as even foreign companies and foreign investors looking to get exposure to the global space economy. And UFO is a global fund. So we have roughly 50 publicly traded companies from around the world. And space is also a truly collaborative and global industry too. So it's an interesting representation that our index providers have been able to capture. But this is something that is drawing interest, I think, from all pockets of investors, of space enthusiasts. And it's something that, we had seen, maybe several years during the pandemic, where there were a lot of retail investors starting to look at different momentum stocks, and space had been a hot area. It also was one of those heavily invested in SPAC target areas. And we saw, some kind of post-SPAC, areas where people didn't want to necessarily touch those de-SPACed names. I think a lot of that, kind of SPAC contagion has worn off, and we're starting to see companies, get priced based on their own merits as opposed to what the broader SPAC economy was doing. And so, hopefully we've built out a more fertile kind of foundation for the space economy to grow. But we've also seen, many different drivers out there, including the militarization of space, which has been now deemed by all global superpowers as the strategic high ground for military conflict going forward. So space is already a vital area of our economy, as well as national defense and security. So it's something that deserves to be in people's minds.
Sadly, we have to leave it there, Andrew, but definitely going to have you back on because there's lots more to cover in space. And of course, with the SpaceX IPO impending, you'll definitely come back to the show, I hope. Thank you so much for your insight today. Andrew Chanin, CEO and co-founder over at Procure AM, their ticker UFO, up 141% in the last 52 weeks. Coming up next, we've got the disruptors. We'll be taking a closer look at Intel after getting a price target hike over at Jefferies.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com
and on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Marley Caden here in our Chicago headquarters. Let's head out to the New York Stock Exchange for a check on the markets. Welcome in Nicole Petalides, host of Opening Bell and the Watch List. Good morning to you, Nicole. Nice to see you. We're about 2 hours into the trading day today. Only the Dow slightly lower thanks to Goldman. What's sticking out to you so far in trading this week?
Yeah, hi, Marley. Welcome back. I was on the show between 9 and 10 a.m. And just before 10 a.m., we started to see the markets come up off the bottom. And that was on the reports from the New York Post that now Iran may be willing to talk about stepping away from uranium enrichment. We still have, obviously, the blockade now going underway in the Strait of Hormuz with U.S. Navy and saying if any Iranian ships come too close, that's the end of the ship. So tough talk there, obviously in Iran and what's going on with the geopolitical turmoil. That's the usual here. We've come to know that to be true. Oil, both Brent and crude are above $100. So let me get to some of the other things here that we are looking here across the board. We got the Goldman Sachs numbers in, and really they saw record revenues when it came to banking and trading, and that's some good news there. And David Solomon, the CEO, has talked on the conference call, and he was saying, look, with the IPO market, we're going to see conditions stabilize, and then there's going to be more activity. And so he was feeling pretty good about the long term and opportunities in general. And we'll hear from JP Morgan, Wells Fargo, Citi. That's Tuesday. Wednesday will be Morgan Stanley, Bank of America, and more. You'll have Netflix this week. You'll have Taiwan Semi this week, ASML. So the Netflix earnings will be key. Nike got another downgrade. Also, CoreWeave has just been an incredible name with more and more deals, is up about 32% this month. So that is the big picture. The home sales came in. And Marley, I'm sure you weren't surprised to see that, that number dropped 3.6%. The forecast was just for minus 0.7%. So the number of homes sold was fewer than expected because the housing market is still struggling in the big picture. Marley?
Yeah, certainly the housing market continues to struggle without any sort of fix to the affordability crisis. But I want to talk about Starbucks here and pivot and take a closer look at one of the upgrades we got today. We got several notes today, but Starbucks got a nice upgrade, not seeing a move to the upside too much. But can you take us through the note?
You know, it was interesting. Over at Jefferies, they put a $92 target up from 86. Look, that's still lower than where we are. But some of the language was some good news. It was just talking about the big picture here, less exposure to China. I know they recently made a deal with Boyu to have some more capital holdings. Boyu now has 60% of the China business, and Starbucks has 40%. So really now surging here in the United States, also having 90 initiatives to try to cut costs overall, maybe cut $2 billion in costs. So they put now a hold from an underperform. The company has invested $500 million in labor, and the vision maybe is a little more clear when it comes to how they're going to execute things. They've also doing things like expanding tipping and bonuses for barista pay, so people are maybe seeing some of the same faces. They're getting rid of some other less performing stores. They also continue to expand in cold brew and protein, things like that. What I did think was interesting was RBC last month did talk about the young folks and the competition from the likes of Dutch Brothers. Will all the investments that Starbucks is making in hopes for a turnaround, will that really still hit the young folks, which are much more online oriented, which do drive-throughs like Dutch Brothers? And so RBC was a little more hesitant, and they had a hold rating. Marley.
Yeah, and right now seeing Starbucks down about 0.5% at 96.08. Nicole, thanks for breaking down that note for us. Nicole Petalides, great to have you on the show. Now it is time for our disruptors. Kevin Green, our senior markets correspondent, here to talk about Intel today. We had Intel in our big three today, KG. We've got Intel. They also got an upgrade today from Jefferies. Jefferies released a lot of notes today. To start, can you just take us through some of the sentiment around Intel right now?
Well, we are seeing the shares up almost 3.5% for today's session. It's going for 9 consecutive days in the green here. So some buyers have really stepped in on a lot of optimism when it comes to the CPU business. And that's why we are seeing Jefferies raising their price target on the shares to $60. And that's up from $45. Now, they still have their hold rating on the shares, but they do see a healthier server CPU market here in the near term, which is going to be a tailwind for Intel. They also mentioned the fact that they have pricing power and the ability to expand margins here because of the high demand, as well as the lack of supply when it comes to certain memory chips, which they are able to kind of pad that supply shortage, if you will. They're able to pass that off to their potential customers, and that's what's also going to be able to backfill their business. Now, we kind of talk about this artificial intelligence space, and obviously when it kicked off, we were looking at NVIDIA, and it's the GPUs, but the CPU market is actually a little bit larger if you're looking at the tangible addressable market. But it's just been a little bit slower in order for it to actually catch a little bit more traction. Intel's trying to really capture that market. It seems like they are getting a little bit more enthusiasm here for today in the last couple of trading sessions. And we also know that they have the tailwind of the administration at their back as well, which has been supportive for them and really gave them the initial boost or shock to the upside when we saw the U.S. government invest in the company last year.
Yeah, certainly. I mean, and then they've got their expanded Google partnership announcement, involvement in TerraFab. Those are just recent headlines. Shares up more than 40% just in the last month. And we are only 10 days away from their next earnings. So, KG, as you're looking at Intel and all of its consecutive days in positive territory, year to date really outperforming the market overall, how might you structure an example trade here?
Well, if you are a shareholder and you're concerned about maybe a pullback to the downside, or if you're taking a little bit more of a bearish stance, and maybe this, this run that we've had, maybe we do see a little bit of a pullback, especially for the fact that we do have a gap between this $53 level and $55 level. Actually, have a little bit more of a hedge trade or a bearish trade. The long put vertical going out to the May monthly expiration, buying the $55 put, selling the $50 put, doing this all for a debit of $1. So the max loss on this trade is going to be $100 with a max profit potential up to $400 and a break even point of $54. Now, obviously, you would need the stock to move, and it would have to move below that $54 level in order for you to start seeing a profit. But this could be, once again, a little bit more of a hedge if you're long the shares and you're concerned about a small pullback. Or if you are looking for that reversal, this is a trade that's going to pay out around 4-to-1 reward to risk ratio here if you aren't able to see those shares go below that $50 level at the time of expiration, Marla.
All right, and right now, as we're looking at Intel, we're at 64.70, but again, a more than 3.5% move to the upside, thanks to that note and some of those tailwinds that you mentioned. Kevin, thanks for being with us for Disruptors today. I'll talk to you again later today. That's Kevin Green. Coming up next, it is time for our 360 round. We'll be taking a closer look at all the financial earnings coming our way, as well as Goldman Sachs, which we got this morning. Stay with us.
Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren, planning for their college educations. Someday it'll be their turn.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Welcome back to Trading 360. I'm Marley Caden. It's time now for our 360 round. For that, let's bring in our panel to take a look at bank earnings kicking off this week. Joining us now, Pierre Boulay, the managing director at global consulting firm SSA Company, and Stephen Bigger, the director of financial services research at Argus Research. Great to have you both on this show. Pierre, let's start with you. We got Goldman this morning. They had a beat on the top and bottom line, but I was just looking at them. We're down about 3.25% right now. Can you take me through some of your takeaways from the report here and why you think we're seeing this move to the downside?
It's interesting. I mean, for Goldman and I think for all the banks this week, we will see very good results, record results in many ways. At the same time, we have a lot of dark clouds that are in front of us. Specifically, there are risks around potential stagflation, 25%. The market doesn't feel 100% comfortable at this stage about the long-term performance of those banks. They could be greatly affected on their earnings in the coming periods.
And Stephen, as you take a look at Goldman too, I mean, is this a case of good but not good enough? Why are we seeing this reaction?
Well, I think a couple of reasons. Yeah, there is some concern. Obviously, the longer this the conflict goes on in Iran, the more corporate boards will be hesitant to make big moves. So there is that. I do think the results were pretty strong. Also keep in mind, I mean, Goldman Sachs is up 80-something% in the past year. It's actually done very well over the past 4 weeks when the market has not. So I think there was a good head of steam coming into these results, and the expectations, at least, that at least on the volatility side, what helps trading volumes. On the fixed income issuance side, was very strong. Even investment banking at large was pretty healthy here. So So I'm not reading too much into today's bit of weakness in a down market.
All right, and Pierre, as you look at this space on the whole, what are your expectations for the earnings we're going to get this week?
So the earnings will be good this week. There is no question about that. I mean, if you take JP Morgan Chase will come with no surprise, I think, this week. CD and Wells Fargo continue to operate and recover very well. Bank of America as well as Morgan Stanley, I think, will have very positive results. Wells Fargo is continuing to do well as well. So overall, the earnings should be very healthy this week.
And Stephen, are you in agreement with that? Are we going to get healthy earnings across the board this week?
I expect so, yeah. We look at bank earnings up probably 15 to 20% year over year, and still favorable trends. The loan growth should be helped by the Fed's recent lowering of interest rates that has lit a fire under some lending categories. The prime rate down. Corporates have gotten more interested in debt issuance at these levels, so that helps. Net interest margins also benefiting here. We've had a bit of a steeper yield curve in the last 6 months. That's beneficial. So the lending businesses are in a good position, and no surprises on loss provisions either. I think credit quality is going into the quarter pretty strong here. We've got pretty stable unemployment trends. That's a big influence on net charge-offs and therefore credit loss provisions. So probably no surprises there. And again, this capital markets cycle continues on the upswing. So I think we'll see good results not only this quarter but going forward.
And Pierre, Stephen just highlighted, credit looks stable on the surface here. What are your thoughts there, especially as we're seeing, banks like JP Morgan Chase and Wells Fargo building their reserves?
No, that's exactly the point. I mean, clearly they are very well positioned on the current level of reserves, and they are building reserves, which means they are expecting effectively a downgrade or some worsening with regard to credit worthiness in the coming few months. They tend to be very conservative in their approach, and therefore they are beginning to provision, which tells us, again, as I mentioned before, there could be some clouds on the horizon.
And Stephen, with Goldman today, we saw equities trading as a big standout in terms of the numbers here, and the expectation seems to be pretty heavily across the board that there will be strong trading and investment banking numbers. But my question is, how sustainable is that beyond this quarter if we start to see some of this volatility cool down in the markets?
Sure. Well, these investment banks and the global banks can live and die by trading in a certain quarter. So it does feel unsustainably volatile here. So I don't think these results are necessarily what I would book into the second, third, and fourth quarters here. So I think we will get some calming down. But at the same time, banks being as well hedged as they are, when that does pull back a little bit, then the investment banking will likely pick up, because the may not be the all clear signal, but it will be at least corporates and institutions saying, okay, now is the time. Maybe we're backing off this volatility, and let's get to work on financing and more deal activity.
All right, and Pierre, we're starting to run low on time here, so I want to make sure I get both of your thoughts on who's the best positioned coming into earnings right now. Who are your expectations the highest for?
Clearly, Goldman and JPM continue to be the fortress banks. The other ones will surprise us nonetheless. I mean, if you see CD will go up significantly. I mean, a lot of them will do well, but the strongest ones remain JP Morgan Chase and Goldman Sachs.
And Stephen, same question to you. Who's best positioned right now? What are your expectations for this week in terms of who the best performer will be?
Well, I think likewise, we're looking at the Goldman results here. Will probably show that the Morgan Stanley results are going to be pretty strong. JP Morgan Chase as well, and I would expect even a Citigroup to do a bit better in this environment also. So really the large global banks have the upper hand here. We've been looking for and waiting for some recovery in regional banks, and I think the lending environment is there, but they just don't have the kind of leverage from the capital markets that these large global banks do. So I think that's where the excitement this quarter is going to remain.
Well, it will be an exciting week as we kick off earnings with the banks, but want to thank you both for taking a closer look with us and previewing them. Pierre Boulay, the managing director at global consulting firm SSA & Company, and Stephen Bicker from Argus Research. Also want to thank all of you for being with us today on Trading 360. I'm Marley Caden. You can download the free Schwab Network app in the Apple App Store. You can also tune in 24/7 on schwabnetwork.com. Stay with us. Fast Market is coming up next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Schwab coaching is concepts brought to life in the real world.
Schwab coaching is learning constantly.
It's relatable, it's practical, clear, understandable, and hopefully entertaining.
Take it for what it's worth, but I think it's absolutely world class.
Schwab coaching is actionable, individualized, community, growth, and empowering.
It's really a human touch with your investing.
We have coaches who have been in the industry and around the industry for a long time.
So the nice thing about Schwab coaching is that clients get access to 9 different sets of expertise.
We want to engage with you in chat on the shows we host. We want to engage with you outside of the classes we host.
A consolidation that could add to this trade. So we shall see.
We have different formats because people learn differently at different times.
If somebody's a real bookworm, we've got courses for you to learn from. They can dig in, go at their own pace.
We have webcasts running through YouTube all day, every trading day.
We've got this ongoing 24, 25 times a year events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
They're kind of helping each other learn step by step along with the education that we provide them as well.
We're going to be able to help you regardless of where you are on that path of education.
It's really not just that it exists, but that you can tap into 30 some hours worth of it each and every week. How incredible is that? And it's free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Welcome to Fast Market here on Schwab Network. Hall coming up on noon Eastern here at the New York Stock Exchange, and trading activity has been range bound today as investors monitor ongoing tensions between the U.S. and Iran. Let's get into a check of your scorecard as we hit the lunch hour on Wall Street. The S&P 500 just above the flat line right now. At the top of the leaderboard, no surprise here, is energy. It is followed, though, by information technology. Energy, we're continuing to watch crude oil prices tick higher. We're sitting above $102 a barrel right now. The Dow's taking a step back, off by 0.5%. NASDAQ 100 better by a little bit more than 0.1%. Russell 2000 has a gain of a little bit more than 0.25%. Here's the roadmap for today's show. It's a big week for the banks. We'll look at example option strategies for JP Morgan Chase. It's got earnings due tomorrow. Plus, the team from Likefolio will be along with new sentiment data on Best Buy. And Citigroup is also on our radar today ahead of its earnings. It's been an outperformer year to date. Now that we've got the roadmap for trading action, it's time to bring in my co-host. You've got Tom White in our Chicago studio and Kevin Hinks joining us live from the SIBO. As you know, we've got you covered from exchange to exchange and beyond. All right, oil still in triple-digit territory, you guys. Although we're kind of off the highs of the session, Wall Street trading in this narrow range today. It seems like investors are trying to read the tea leaves in the aftermath of these broken peace talks between the U.S. and Iran. You've got President Trump posting on Truth Social about, kind of, it seems like what has happened, what comes next. Tom, your thoughts when you look broad strokes across the market today?
Yeah, pretty powerful comeback from, we were down over 1% when futures opened up on Sunday night with this, the fact that J.D. Vance and his team left Islamabad and basically didn't have anything set in stone. Now there were some conjectures in there basically that they weren't willing to give up uranium enrichment, but then the New York Post comes out today and says that Iran's willing to give up that enrichment. So it's headline-driven moves that we've seen in the equity market. This comes off the back of the best week for the major indices since November. So we've had a little bit of a reprieve from the downturn here, but to see the market kind of claw its way back to basically unchanged at this point, pretty spectacular. I think the market should be thanking those software stocks that took it on the chin last week, down more than double digits as far as a percentage basis in CRM, Palantir, ServiceNow, Snowflake, and others. Those are all the winners here today. And that's probably, lending a little bit of credence to this rally that we've seen. But we're still going to be driven by headline risks at this point. China's just come out recently with stating that, hey, they have a trade deal with Iran for their oil. Nobody better stop our crude oil from getting through the Straits of Hormuz. So, yeah, there's he said, she said rhetoric on both sides here, Diane. And hopefully we'll get some type of resolutions. Right now, the ceasefire still in place, but will that change? It seems like crude oil's ready for the worst, but equities are a little bit more optimistic at this point.
It does seem like that, right? When we look at crude oil prices, that's telling one story. On the flip side, equities are telling a different story. Kevin, your thoughts?
I think the market, that Tom's right. I saw it down 1.2% early evening last night on the E-mini futures. They've come back, I think, because I think the market is starting to interpret several things. And one of them is there's less and less impact from these headlines. I mean, think about it. The headlines of a breakdown over talks over the weekend, and the VIX currently sits right at 20. It was 31 ago. So you're getting less and less impact from these headlines. Also, I think the Trump administration has found something that they can really pressure Iran on, and that is the Strait of Hormuz and this blockade. Why? What Tom mentioned, it brings China in. China buys 90% of the Iranian oil. And by the way, they buy it under market value. They buy it at a pretty good discount. So if they've got to go to the market and buy fair valued oil, that brings China as a big player in this. And they could pressure Iran. So without any boots on the ground, just through pressure in the Strait of Hormuz, they could put pressure on Iran. I think that's why the headline that Tom talked about of them willing to give up enrichment, that's the key thing here. And I think that overall tension coming down, not showing up in short prices yet, but the stock market is starting to look past this. Why? Because I think the Magnificent Seven stocks are all so beat up that they're all starting to become, the bar is going to be low going into the end of this month. I think people are making some moves here to buy this dip ahead of first quarter earnings season. I think it's fascinating what's happened since the market opened, Diane, Tom.
Yeah, I guess some investors don't want to get caught flat-footed if this is like April of last year. Tom, let's talk Goldman. Those shares are under pressure. That hasn't changed. They did beat expectations on both the top and bottom line, but you flagged one segment in particular earlier. What's your take when you look across Goldman?
Yeah, pretty good report across the board, beat on top and bottom lines here. And then if you look at the growth rate that they had within specific segments of their industry, their profit climbed 19%. You look at investment banking fees up 48%. They expected that to be pretty robust. Remember that wealth effect was built into the first couple of months of 2026 where they expected those numbers to be good. Fixed income operations revenue fell 10% to just over $4 billion. That came in light by about $900 million. But I think one of the keys here that you look at the different segments that are doing well, besides investment banking fees, equity trading rose 27% to just over $5.3 billion. That was about $400 million more than anticipated. But if you look at their asset and wealth management, those grew 10% to just over $4 billion. So good segments within this report. That one, the one fixed income kind of weighing down on the stock. But remember this, guys, the stock was already up pretty significantly over the last 12 months. Maybe this is just a little bit of selling pressure on maybe taking at this point. And remember, this quarter, most of the quarter that was just reported was built in before this conflict started. What is that going to do moving forward from some of these segments that had pretty good numbers? But it sets up well for earnings season so far as the financials go moving forward, whether it's the investment banks like Goldman, Morgan Stanley, or the money center banks like JP Morgan, Bank of America, and Citigroup and Wells Fargo. So, yeah, setting up pretty well. But I think this was expected, maybe just some profit taking here out of Goldman Sachs, just because of the run-up that we've seen over the last 12 months.
Yeah, and then the CEO, David Solomon, kind of, it seems like flagging the macro picture as well and being a little bit more cautious, maybe not as downbeat as how Jamie Dimon can sometimes be, even when they have strong results for JP Morgan Chase. But Kevin, what's your take when you look across Goldman Sachs?
This was the first bank to come out with earnings, and fixed income, currencies, commodities. That was the miss. The question now is, as we get into JP Morgan, Citi, and Wells Fargo, is that going to be similar to what Goldman does? Usually, Morgan Stanley is the one that shows the most comparison with Goldman. Wells Fargo, Bank of America, JP Morgan, all a little bit different. But we'll see if fixed income, if that's part of this, weighs on all these earnings. Remember, they usually move in a group. Citigroup might be a little bit different because they're coming out of a restructuring, but not a great start to earnings season. If you want to know why the Dow is down with the other markets higher, it's the Goldman Sachs effect on the Dow. But Tom's right. Stocks had a great historic move up. So when the bar's high, any one weakness like FICC did there can hurt the stock, and it did.
All right, guys, let's talk home builders. Evercore ISI turning more constructive on housing. They're upgrading Pulte, Toll Brothers, and Masco, saying the bad news is likely priced in and the home builders have hit a historic buy signal. But it doesn't seem like the market is buying it when you look at Pulte, Toll Brothers. Tom, your take.
Yeah, they said they don't see any near-term catalyst to help out this sector, and maybe the downside's limited here. I mean, we've had pretty significant pullbacks from 52-week highs in a lot of these home builders. And if you look at, maybe a 1 or 2 year chart on a lot of these names, it's been a roller coaster. And this is probably due to the fact that, hey, interest rates are still elevated. You got that 10-year yield. It's not the 30-year mortgage rate. Remember that, but it's tied into it. 30-year yield, 4.33%. Until we get back down to maybe 4% in the 10-year, you get that 30-year fixed mortgage rate back under 6% at this point. We've been in like a rolling kind of roller coaster recession in the home builders, and maybe they should be. They've had to give incentives on some of their sales. You still have that affordability issue at this point. If wages start to crack here a little bit, we've seen pretty good wage numbers over the last couple of years. If that starts to crack a little bit, maybe you look at the jobs market. If that starts to show cracks, even though that's kind of consolidated at about 4.3% for the unemployment rate, it seems like it'd probably be a good idea to, say, hey, maybe the bottom's in a lot of these names. But at the same time, we all know this is going to be based on where interest rates are, and it's going to be based on affordability, consumer spending, and savings rates. So you have to take a look at all these different silos when you're kind of assessing them. Now, we all know the valuations on these home builders are low, right? Historically, they're typically low just due to the cyclicality within this sector. So you got to take that into consideration also. But I've been pounding the table on it, guys, and I'll say it again until we see those 30-year fixed mortgage rates getting under maybe 5.5. It's going to be probably fits and starts for the home builders.
You have, and listen, that's what some of the economists that we've talked to have said about this year, that this year you would start to see some incremental improvement. Kevin, what's your take when you look across the home builders?
I think for Evercore, this is a great second half of the year bet to put on because interest rates, 30-year mortgage was below 6%. Now disruptions and everything going on has raised the 10-year yield, which has then raised mortgage rates up. I think last week was 6.57 for a 30-year mortgage. That has halted all housing, and it's basically hit these home builder stocks. Now, if that is short term, then these are going to turn out to be a great buy. Kevin Warsh coming on in May as the Fed chair, he's targeting interest rates lower. And so if those interest rates start coming down, housing is going to be maybe a good place to be in the second half of the year, because remember, that is a big goal of the Trump administration. Get interest rates lower, make housing more affordable, and get that part of the economy moving that has been dead for quite a while. So I think it's a fair bet for the second half of the year.
All right, let's talk Nike. Another day, another downgrade there. HSBC reducing its view on the athletic wear maker to a hold rating with a $48 price target. To put that in perspective, that is all the way down from $90. Tom, your take?
Yeah, not surprising. This turnaround story out of the CEO, Elliott Hill, is taking a lot longer than maybe Wall Street. The stock today in today's session hit 12-year lows. It's not good for investors in this name. It's been a falling knife for the last couple of years. They've got some segments within their business that are picking up, maybe North America sales, but you look at China, you look at their Converse brand, those have been lacking and actually losing market share to some of their competitors. And we've mentioned this in these discussions about Nike. This isn't just a macro theme where maybe tariffs are hurting them. It's competition also that's come into this space over the last several years that's taking market share. Their innovation's been lacking. I mean, these are all the things that Elliott Hill continues to kind of pound the table on, that, hey, this is taking longer than we thought, but we're on the path to correcting a lot of the issues. Well, the stock is telling a different story over the last couple of years. And, you wonder after the downgrades post-earnings, and Piper Sandler downgraded them last week, others have been cutting price targets here. Valuation's really getting inexpensive, right, compared to the historicals on Nike, but is the bottom in? And I think that's what a lot of investors are questioning right now because the stock has just been pummeled.
Kevin, your take.
Excuse me while I rant here, but this is why we don't trust analysts. Think about what just happened. Friday, with Nike down, close to where it is right now, the stock's barely moved today. They had a buy rating and a $90 price target. And today, after this big move that Nike, you look at the chart, now they lower it to a hold and a $48 price target. This is why you shouldn't listen to analysts very much, because that is probably a recommendation or a downgrade that will look good in a couple months if this turnaround starts to happen. And Rory McIlroy won the Masters. He was Nike from head to toe yesterday, and he won the Masters. And today you downgrade it. This might not look good in a couple months, guys.
All right, we shall see. Right now, it doesn't look like investors are in on this one. We'll put a pin in it. We've got bull versus bear coming up. The guys will get their example trades put together for JP Morgan Chase ahead of tomorrow's earnings report. We'll have more Fast Market after this break.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. On the earnings front, the banks take center stage this week, and JP Morgan Chase is next up at bat. The nation's biggest bank is expected to turn in a profit of $5.40 per share on an adjusted basis. Revenue is projected to top $48.5 billion. The Street's expecting to see strength in investment banking and trading activity. We will also get a window into how consumers are holding up based on credit quality. Coming into today, shares of JPM were down 3% year to date. The pressure on Goldman casting a little bit of a shadow. Still, JP Morgan Chase up more than 30% year over year. All right, time now for the tug of war on the nation's biggest bank. For that, let's welcome back in our co-hosts Tom White and Kevin Hinks. It is bull versus bear time. So before we get to your example trades, got to talk about your thoughts on JP Morgan Chase. Kevin, I'll start with you. Your take.
Jamie Dimon, one of the top CEOs in the country. JP Morgan, one of the largest banks in the world. They seem to be good at everything they do. There is some concerns, though. The FICC, fixed income, currencies, commodities, if it's at Goldman, is it going to be the same, or is that a weak sector at JP Morgan? That is probably why there's a little hesitation here. Stock's had a pretty good run. It's sitting just above, after backing off from recent highs of 337, it's sitting just above the 50 and 200-day moving average. Right now, the 200-day moving average is 303, so it's back above there. That in itself is pretty bullish, but these banks don't move in big ways on earnings. And there's, private credit, is that going to be a problem in some of these banks? Consumer credit, you just mentioned, credit card balances and delinquencies. So I think the overall market might have some fears. Jamie Dimon, sometimes when he speaks, he plays a little risk manager, and he brings out all the potential issues. So I think they're going to put up good numbers. They're going to probably beat on earnings per share and revenue. I don't know if the stock's going to go up based on that, Diane and Tom.
That's a good point, because listen, often off the back of its results, you see some pressure on JP Morgan Chase. So we'll see. And also, Jamie's he seems a little sour when he talks, and even if you have strong results. But Tom, your take.
He's a risk manager, Diane. He's supposed to be saying that kind of stuff. But you look at, Goldman's results, and you can kind of parlay that into maybe what we should expect from JP Morgan. Investment banking, that's supposed to be up pretty significantly. Net interest income is supposed to be up 10% versus year-ago levels. That's going to be a bonus for this company. The trading activity is probably going to be pretty robust. We'll have to wait and see on maybe the loan activity. One of the caveats we didn't really hit on with Goldman Sachs that might impact JP Morgan also is those provisions for credit losses. If those get hiked up at all, I think it was the biggest since 2020 for Goldman Sachs this past quarter. So that might be a current concern. And then also Kevin mentioned the FICC numbers, if those come in a little bit lower than anticipated. But you know what? They're at the forefront of what the consumer's doing. The first couple months of the year, we saw a lot of consumer activity and business activity starting to pick up. Now, what will they say as far as guidance goes? Are they going to give something a little bit lighter, maybe like Goldman Sachs CEO did a little bit, where maybe things are getting stressed here a little bit in the economy? and that might be a headwind. The stock's up over 30% over the last 12 months, hit all-time highs at the beginning of January, but we pulled back here a little bit. So, yeah, I think there's a bunch of different segments that you're going to have to focus on. But as we just saw from Goldman Sachs, it only takes maybe one, maybe two areas to kind of push this stock lower.
That's a good point. All right, let's get into the example trades. Kevin, we'll start out with yours. What's the approach you're taking today?
So mine is something more in the complex paper money trade where we combine two spreads to create a complex spread. So if this is range bound, I looked at something in the neutral to bearish case. So I looked at the expected move, about $9.50. That's only 3%. Not a big expected move from these banks because, frankly, they don't move very much historically on earnings. So what I looked at about $9.50, $10 higher, sold the 320, 330 call vertical, and then used that credit to purchase the 1 week, the April 17th, April 24th, 300 put calendar. Combine those together, and the total package trades for about 25-cent credit. It's maybe a little higher than that now, up near 35-cent credit. But trading this for a credit means if nothing happens and the stock just sits range bound, you're profitable because you've done this for a credit. If it moves down towards 300, you're profitable on the short call vertical, and you're profitable on the put calendar. Now, the risk is the fact that you're short a $10 wide call vertical above the market, Tom. The whole package is about 25, maybe 35-cent credit, Tom. The risk, the difference in those $10 strikes, and whatever credit you take in.
Yeah, let's break this down because it's directional, right? You can see here from the risk profile that Kevin brought us on this example trade, you want it to go at or near $300, right? The option market pricing in only a plus. This is a high price stock, right? Only a plus or minus $9.40 either way on a $310 stock. So as Kevin mentioned, historically we don't see really big outsized expected moves in the banking sector. That doesn't mean that they can't move, but Kevin's example here, neutral to slightly bearish on this one, that 300 strike where he's buying the 1 week wide put calendar is where you want the stock to go, but because you collected a credit, anything below $320.25 is going to be profitability. But let's break this one down. In the April 17th monthly options that expire in 4 days, sell the 320 call and buy the 330 call. So there's that short $10 wide call vertical that helps finance the purchase of the 1 week wide 300 put calendar where you're buying the April 24th 300 put, selling that same 300 put in the April 17th options that expire in 4 days. 25-cent credit, the risk, $975, but that's all the way above the 330 level, all-time high, 337 in January. So this is a directionally bearish type of trade, lining up with that one standard deviation at or near that 300 strike. But at the same time, as Kevin mentioned, if the stock does nothing and kind of sits here, you're still going to be profitable on it. What you don't want to happen is maybe that one standard deviation move or more to the upside where you start getting into losses on that above $320.25. Now, Kevin, you mentioned the fact that historically sometimes these banks don't move that much, and that's why their one-day standard deviation moves are relatively muted. But I looked at a strategy that takes advantage of maybe an outsized move where it moves more than 3%, 4% in either direction on this one. So I looked at a long iron condor here, Kevin. I went out to that April 17th monthly options that expire in 4 days. And I'm going to buy, and out of the vertical, I'm going to buy the 317.5 strike call, sell the 322.5 strike call, and then on the downside, buy the 300 put, sell the 295 put. So a $5 wide long iron condor, you're going to pay roughly about a $2.10 debit on it, trading closer to $2 right now, so you can get a little cheaper. But the debit you pay on this strategy is going to be your risk, $210 per spread. It takes your break-evens on this one to the downside where you don't want it to go below 297.90, or where you do want it to go below 297.90. And on the upside, Kevin, 319.60 to the upside. So while we've got muted implied volatility, you got 4 days in this position. So even if you don't get the move initially, you've got a little bit of duration, Kevin, but this is definitely a bull bear type of trade in one, right?
Exactly right, Tom. These trades couldn't be more opposite of each other except on the bearish side, right? You're playing for some type of move, and you, frankly, you don't care which direction. You'd like one of these $5 verticals to go to $5. You're paying about $2.10, so you'd make about almost 150% on your money if you get that move. I'm looking for lack of a move or slightly bearish. You're looking for a move in either way. Bearish is okay there too. So a move to 300 would, well, it wouldn't help Tom, but it would definitely help me. And Tom would do better on a move through 300 toward 295, Diane.
That is, I like the way you contextualize that there. So one of you wants to move towards 300. One wants something different than that. All right, that's a true bull v bear debate there. We've got cash tags coming up, guys. Investors are not buying Best Buy after a double downgrade today. Keep it right here on Schwab Network. Fast Market.
Order filled.
After this break.
I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market here on the Schwab Network. I'm Diane King Hall alongside Tom White in our Chicago studio. Time now for our Cash Tag segment. For that, let's bring in our next guest, and that is Andy Swan, co-founder of Likefolio. Taking a look at Best Buy today. So investors are not in love with this one today. Those shares are under some pressure after a double downgrade. You've got the latest look at sentiment right now. Walk us through how Best Buy compares to some others in the retail space, Andy, and good to see you.
Yes, you too. Happy Monday. Best Buy is underperforming peers on all of the metrics that Likefolio tracks, especially if we look at web visits on a year-over-year basis. You've got Target up pretty big, Walmart up pretty big, Costco doing okay, and then Best Buy in fourth position among peers. And that's off of what I would call fairly muted levels to begin with. And I think the big problem Best Buy has is it's kind of, they did a good job of reinventing themselves. They used to be, considered kind of a showroom for what you could buy online elsewhere. And I think consumers are just getting back to that behavior. The way that I approach Best Buy personally, I think is the way a lot of people do. And You like to go in there if you're going to buy a product or an appliance or a computer, you're not sure what to get, a TV, you look around, you can interact with those devices, and then you can go on your phone and you can generally find a better price elsewhere, whether it's Costco, Amazon, or even direct through Apple. So I think back to the old problems Best Buy had before it reinvented itself, and now they're going to have to do something different again because consumers just aren't loyal to the Best Buy experience. They see it as increasingly a showroom again for the products that they think they might want. But unless Best Buy has the pricing to match and the delivery to match the online competitors that they're going up against, consumers simply take their dollars elsewhere after getting the benefit of the showroom and the tour and the interaction with the devices. So Best Buy's definitely in trouble here. We agree with the downgrades. We think they were a little late in coming to the downgrade conclusion. Like Folio's been bearish on this for a little bit now, and we don't see that changing anytime soon. There's no real catalyst out there that we see that's going to turn this company around in the near future.
Yeah, Andy, competition in this space is pretty rampant. Last quarter, comparable sales fell 0.8%. They're usually shareholder friendly with buybacks and their dividend. Historically, that's kind of supported the stock here a little bit. But you make a good point. When consumers get into a mindset where, hey, I used to like to go to Best Buy because I wanted to kind of see it and in action, and maybe you'd have to do that. Is that part of the reason that we've seen the stock slide so much, is the fact that, hey, people are comfortable buying things online, going to Costco and just picking it up when you make your Costco run, Amazon. They don't care about their margins as much as Best Buy needs to because they're brick and mortar at this point. So is that going to be the continued pressure where, hey, as a consumer, everybody's getting more comfortable. If I just order something online, it's here in a day, hey, I'm fine with it.
Yeah, I think that's the big story here is the competition. And it's not just Amazon. If we would have talked about this 4 or 5 years ago, Amazon was that primary competitor where, you'd go into Best Buy and maybe you'd check Amazon and, maybe I want it today, so I'll go ahead and buy it from Best Buy. Well, now Amazon can get it to you a lot of times in the same day. But more important than that, I think, is the competence of all the other competitors. Walmart has dramatically improved the online shopping experience. Costco has dramatically improved their online shopping experience, as has Target. So everybody is now doing what Amazon used to do, and that hurts Best Buy even more than it hurts everyone else. And so I don't think Best Buy has the greatest online shopping experience, and that's hurting them. And they are held back by the fact that they have to maintain these stores and that overhead and that space that essentially acts as a showroom for their competitors. And so we're back to that story with Best Buy, and Wall Street, for good reason, doesn't like it.
Andy, let me ask you this. Now, the one thing I notice in this chart is Target's at the top of your leaderboard. Is something about that also just because of easier comps year over year for Target?
Yeah. We can kind of throw Target out of there. I think, the real number for Target, they're coming off of very low comps. They had a devastating period there for a little while. So they're coming off of very low comps. I would put them more in the same category as a Walmart if I'm looking at this from a peer-to-peer perspective. But they are competent competitors to Best Buy at this point. So is Walmart. Now, Amazon has gotten into the appliances business very quietly, but very effectively, taking another shot at the kneecaps in terms of why people go into that store. So now you go into Best Buy, you're looking at a refrigerator or something, or a washer and dryer, and now you can check Amazon against that even. So, what Best Buy had as moats are quickly disappearing with more and more competitors able to traverse those. So very difficult situation for Best Buy. And I think, the financial engineering, the shareholder-friendly buybacks, dividends, et cetera, that only goes so far. You have to see growth in a company You have to see light at the end of the tunnel when you don't see growth, and right now we don't have either one.
Hey, Andy, if you look at the valuations, it seems like the 60 level is going to become a line in the sand over the last couple of weeks. Do you guys have an earnings score on this going into the report? Because it does pay a big dividend if they continue to pay that, and they are shareholder friendly, and that's kind of helped them. Do you guys have a decent earnings score going into this? Or are you guys?
No, we're sellers. I think we're bearish on this. The risk is clearly still to the downside. There are some things that Best Buy could do. I think they'll lean in on some of the AI PC contracts that they have and those partnerships that they have with Microsoft and Apple, and they're going to be the showroom of choice for those, which is great. So they've got a decent story to tell, and like you said, they could throw something out there to make the company even more shareholder friendly. But over the long term, I think they have real problems, and it's going to be tough to put a Band-Aid on those in the conference call that follows the earnings report.
All right, thank you, Andy. That's Andy Swan, co-founder of Likefolio, with the latest look at Best Buy and the competitive landscape around those retailers. Now, for the trading perspective on all things Best Buy, let's bring Kevin back into the fold. Tom, you got some insights from the Likefolio team. He said, listen, they've been essentially bearish before these analysts seem to have caught up to what they're seeing. What's your thought before you guys get into the example trade?
Yeah, you look at a couple of their charts. They have that seasonality around the holidays every year, but it's continuing to drain. I mentioned that $60 level. We're getting there right now, and this has been an area of support over the last month and a half or so. Does it crack that to the downside? Remember those April lows from last year when the whole market sold off. The stock got down to just below 55 bucks a share. But Kevin, you look at this name, the valuation's pretty low. Trailing PE about 12. The forward PE on the stock is now below 10 times next year's earnings. But I mentioned that dividend yield's climbing up there, 6.34% if they continue to pay that, Kevin. And the option market's only pricing in $1.25 move either way in this stock over the next maybe one day, but it does have a market even though earnings are a few weeks off.
Yeah, earnings, I don't have earnings till the end of May, but this is a company. Let me take a little bit of the other side of some of this argument. This is a very well-run company. That said, they have struggles going forward. It might be like a Carvana CarMax situation where they just have too much brick and mortar. They can't get down to the prices that other people can. So, but they do a great job of buying back stock and controlling their head count and doing all the things that management can do to maximize what they do. But boy, Likefolio's data is not great. But you also, Tom, can't ignore a 6.3% dividend yield. As long as they can keep that. No, we don't know. We have no idea if they keep that or not. What I looked at is something, because if you look up at a 3-year chart, Tom, 60 bucks or slightly below 60 bucks is a pretty long-term low in this name. So I looked at something because of that dividend. I looked at something in a simple covered call strategy. I went out not 4 days, but 11 days. I bought the stock, sold the April 24th 63 call. The net debit on that is about $59.90, $59.80, something in there. So if you think 60 is a key level, you're net buying the stock below 60, but you're collecting theta on a daily basis, and you still get to capture that dividend. So, if you think neutral or bullish in a stock like Best Buy, if you think the management can navigate these tricky waters, then you've got a 6% dividend and you're collecting theta on a weekly basis. So sometimes, Tom, that dividend just tells you to do the covered call.
Yeah. Let's break this one down. For every 100 shares of stock you buy, you sell an out of the money call in Best Buy. Kevin used the April 24th weekly options that expire in just about a week and a half. The 63 strike call, so about $2.50 above the current share price in there. We've got 59.60. That's where it was trading earlier. Actually trading a lot lower than that earlier, but now up to 59.90. But the debit you pay is also going to be your break even. So you're buying the shares at a discount It's a capital-intensive type of strategy on this one, but it creates yields on two fronts, right? You create that yield on the 6.3% dividend because you own the shares, and then also selling an out-of-the-money call. So while it's a bullish, slightly bullish trade, it's also a neutral strategy. As you get closer to expiration over the next 11 days, you'll have that opportunity or potential to roll that short option. That should create, that'll increase potential profitability, lower your break-even point. But you want to be a shareholder on a strategy like this where you can collect that dividend yield. But that's why it's capital intensive, right? You got about $5,990 in risk, $5,960 in risk if the stock were to somehow go to zero. So keep that in mind on a strategy like this. While it's a longer term one where, hey, if the stock just kind of consolidates at the 60 level, which has been an area of support, you can start trade management skills on this where you can start to collect credits. You've got some assignment risk on that short option over the next 11 days. So you might get your stock taken away if you don't adjust it to a higher level if the stock does rebound. But yeah, Diane, setting up, not really with what Folio's data says, but you got some time until earnings and maybe this stock on basically 12-month lows might find some support, but the dividend comes into play here.
Point that you made, especially about that $60 level, because it's really, kind of just continue to kind of come back around that level over the past year. And year to date, it's certainly been an underperformer compared to the S&P 500 and its sector. All right, good stuff, guys. We've got the breakdown coming up. We're going back to the bank with a look at Citigroup ahead of its quarterly results tomorrow morning. We've got more Fast Market after this break.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. Tips and tricks to help navigate schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall, live on the floor of the big board. Before we get to the breakdown, let me give you a check of where the markets stand as we get closer to the bottom of the lunch hour. Here's your scorecard. We are on the plus side for the S&P 500, better by about 1/3%. Dow still a little lower, but it's been gradually inching higher throughout this hour. We're off by less than 1%. NASDAQ 100 is better by a little bit more than 1/3%, and the Russell 2000 is higher by 0.8% as investors continue to operate with, or as optimism, I should say, increases about the U.S. and Iran negotiations. Going back to the bank, though, Citigroup has been one of the few outperformers in the sector. Year to date, that stock is up more than 6% and more than 90% on a year-over-year basis. It has a test in front of it with earnings due tomorrow. Analysts are projecting revenue will top $23.7 billion, which would be up from the same time a year ago. CEO Jane Fraser has turned Wall Street into believers, bringing in top talent and, to use her words, quote, competing for the full wallet. Time now for the breakdown. For that, let's welcome in Kevin Green, senior markets correspondent, taking a look at Citigroup today. All right, this is the big focus on the banks this week. We got Goldman out this morning. We've got JP Morgan Chase coming up. We've got Citigroup coming up tomorrow. Walk us through expectations, KG.
So when you're kind of looking at Citigroup, kind of think about this company as more of a retail banking focus or consumer banking focus. They have really divested themselves away from a lot of the international exposure, especially when you're looking at South America and really focusing on the basic lending as well as taking in deposits. That business has been their bread and butter here, and trying to trim the fat is what Jane Fraser has been kind of focusing on. And it has been paying off for them. And actually, if you're looking at it from a technical standpoint, we are seeing a kind of a pullback and kind of a testing of a neckline before a breakout right before the earnings announcement. Now, we are expecting around a 3% move to the upside or downside if you back out some of the theta decay over the remainder of this week. But as you talked about, the revenue expectation coming in at $23.7 billion, a lot of that may be driven by the net interest income, which is going to be the estimate right now, sitting around $15.5 billion. And then the revenue expectation sitting at around $6.9 billion was actually very interesting. We had Goldman Sachs earnings today as well, and they did come up a little bit light when it came to the fixed income, currency, and commodity trading portion of their business. Citigroup doesn't have that much of an exposure compared to their overall revenue mix. So if you are concerned that maybe they'll miss on that particular metric, they may be able to make it out elsewhere within their business. Now, the last thing that I think we have to be mindful of, and I bring this up every quarter, when you're looking at their consumer banking segment, it still is writing down a fair amount of assets or their losses. If you're looking at their assets, they continue to write down a pretty significant amount compared to others within this space, which is why we are seeing it trade at around a 12.5 forward multiple here with a growth rate of around 30% year over year when you're looking at EPS growth. Now, compared to their peers, they've been actually holding up pretty well when it comes to the price action, but they still have a very long way to go if you're looking at trying to get this stock back to all-time highs that we saw pre 2000 financial crisis.
For the banks, how much does net interest income matter this time around?
It's going to be a factor, and actually that's probably going to be the bright spot because we have seen the curve itself, the yield curve, actually widen out during the quarter that's being reported. So as we see that yield curve widening out, just meaning that the longer durations paying a little bit more of a higher interest rate than what we are seeing on the shorter duration, that's where the banks make money. They basically borrow on the short end, and then they lend on the longer end. Now, the longer end really is only about 7 years or 10 years. But that actually does expand profitability, which is why I also kind of mentioned that it could offset maybe some of the weakness that you're seeing in the fixed income trading, as well as the currency and commodity trading portion of their business. So it's going to be a big deal. Now, unfortunately, when you get to the latter half of this quarter, what we did see is that spread kind of coming back in to the fold because of the uncertainty that we have seen when it comes to this geopolitical risk, as well as what the Fed's going to do moving forward. So kind of a double-edged sword here. But Citigroup is kind of positioning in a little bit of that sweet spot where it has investment banking exposure, it has traditional consumer banking exposure, some commercial banking and commercial real estate, and it's pretty much a 25-30% blend for each of those business units.
And then KG, when you think about its performance so far this year, it's been outperforming the S&P 500, it's outperforming other peers in the sector. Is the bar higher for Citi given its outperformance year to date?
I don't think so. I mean, the bar has been really low for this company for the last couple of years. We have that chart up here right now that kind of just shows you where we were at before the financial crisis and where the stock is trading right now. We have to remember there was a significant reverse split for this name in order for it to kind of get back on its heels. So it still actually has a long way to go to get back to all-time highs. If you compare this to a Wells Fargo or JP Morgan Chase, for that matter, a lot of those stocks are actually trading at relative all-time highs or new all-time highs at the moment here. So still a long way to go, but this company has really transformed over the last 10 to 15 years, where it had their hands in pretty much every type of business, especially overseas, especially if you're looking at South America. But they had to cut a lot of those businesses out because they provided a lot of risk, a significant amount of risk that, once again, Jane Fraser is just not really willing to take. Trying to get back to the basics of lending, that's where they've been able to thrive in. And technically speaking, 125 is actually that breakout level to the upside, where if they have a good earnings report, it might actually have more room to run to the upside here over the next couple of weeks or months. And you're going to target that 140-ish area as your next area of major resistance.
One to watch out for from 125 to potentially 140. Thank you, KG. That's Kevin Green, our senior markets correspondent, with the breakdown on Citigroup. So let's get Tom and Kevin back in here for example trade purposes. Shout out to Jane Fraser. I love it. You know, just this is more the a female at the top of the banking system there. So hats off to her. But let's get into it. Tom, what's your approach?
Yeah, divesting money-losing portions of the business, kind of tightening their belt around, being more domestically based. Now they're trying to get into the M&A activity, that a lot of the investment banks, J.P. Morgan, some of the bigger ones have a stranglehold on. That's probably going to be good. But the exposure to the consumer might be a little bit greater here. Net interest income is supposed to grow. Trading activity is supposed to grow. Now, are they going to have to set aside more provisions for credit losses for those loans? That might be a concern moving forward. We saw that with Goldman Sachs earnings. So you have to look at different segments within their business that might drag down their entire earnings, even if they're good results on the upside, because for the first 2 months out of the year, their activity was really robust for a lot of these money center and investment banks. So I looked at a strategy. The stocks hit 17-year highs here today, guys, in today's session. The RSI is at the 70 level right now, so overbought on a technical basis at this point. So I looked at a strategy that takes advantage of vol dispersion. If you think maybe this trades like Goldman Sachs does, where it's a good report and it goes down because of the gains that we've seen. This stock is up 103% over the last 12 months. So I looked at a bearish put diagonal here, Kev. I went out to the April 24th, really short-term positioning. April 24th weekly options. Buy the 125 strike put that's basically at the money, and then against it in the near term, April 17th, monthly options that expire in 4 days, sell the 120 put. It aligns about with that one standard deviation move that the option market's pricing in. $5 wide bearish put diagonal, Kev, paying roughly, we've got 270 debit here. That's your risk. It's probably trading closer to 240 right now because the stock has moved higher as the market is now hitting session highs as we speak. But the debit you pay is going to be a risk. So a $5 wide bearish put diagonal, Kev, only paying roughly about 250, 270 on this. There's your risk. So anything below maybe 124 is going to be profitability on this one. And on a percentage basis, you don't need a big move to the downside.
I think the Goldman Sachs price move today has got everyone on the defense when it comes to these banks, that even good news might not be enough to make the stock go higher. Remember, good news or bad news, we're betting, you're saying that the stock can't hold these levels or may not hold these levels. And so I think this is one of those, we do a lot of diagonals on this show. This is the put side, so a bearish diagonal, Tom, about $5 wide, 1 week, only spending $2.70, $2.50. If it's less than that, that is the risk on this trade, guys.
Yeah, and the vol dispersion lowers that entry point price. So anything below about 124 is going to be profitability on this one because you're buying about 40% implied volatility on aggregate in that April 24th 125 put, selling about a 48% implied volatility on aggregate in that near-term April 17th on the 120 put. But definitely a bearish trade here, Diane, on this example, looking for maybe a Goldman Sachs type of move that we saw after a good report.
All right, we shall certainly see. And as you mentioned, sitting at the highs of the session, we had President Trump posting on Truth Social saying 34 ships went through the Strait of Hormuz yesterday. So it seems like we're seeing progress on that front. We'll continue to monitor the latest on between the U.S. That's going to do it for us today on Fast Market. I'm Diane King Hall alongside Tom White and Kevin Higgins. Download the Schwab Network app. It is available in the App Store. Tune in 24/7 on schwabnetwork.com. You got Next in Investing coming up.
So what is unique about Schwab Coaching is the community.
There's a lot of energy, like-minded people are learning with you.
You can just see and feel all the excitement around getting to learn a new topic.
Some of you want to get everything face-to-face with you and 400 or 500 of your closest friends.
Some clients like to be in the privacy of their own home on an online workshop, but still having that live interaction with the coach.
As I'm talking, questions are coming in from that live audience, and they help me fill in those gaps as an educator.
People learn differently, but all those ways we actually teach it all come back to the point of making a difference and helping you make progress.
And so that means not just giving you theory, it means giving you the implementation using our platforms.
So we want it to be fun, we want it to be informative, and most of all, we want you to walk away with a skill set and independently be successful in achieving your goals.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. schwabnetwork.com. For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at @NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it. To leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey, and we have seen a bit of a recovery here in the overall markets as the session has gone on, of course, to start off this week. After seeing some of that pessimism trickle in on Friday, still close out a winning week, but does seem like the tone is getting a bit more upbeat as investors are clearly hoping for an eventual resolution with Iran. Did not see that priced into futures this morning, but again, a nice recovery here we're seeing intraday.
How much better does an up 30-day feel when you open down 60 Sunday night? And so, hey, whatever's going on, this sort of 1 step forward, 2 steps back, 2 steps forward, whatever it is, seems to be working. The market seems to like it.
Yeah, and the market only continuing to improve here in real time with that strength led by the Russell 2000.
Before we move on, I mean, we're now within like what, 2% of all-time closing high, like the spike high for the S&P 500, which like just eclipsed 7,000. Like, it's not unreasonable that we could be there by the end of the week with a couple good earnings and maybe some couple good updates for the S&P 500. So, you know, all this talk and chatter of the last 2 months now, or 1.5 months of, hey, war and weakness and uncertainty. I mean, this is the best crash I've ever seen.
I mean, yeah, when you look at the month-to-date performances, and I know we're still very early into the month of April, but like considering there is this massive geopolitical uncertainty that is still an overhang in the market, we're up almost 5% in the S&P 500 so far this month. I mean, to speak to that. And like today, seeing again this real appetite for some of the dip buying we saw overnight.
And I'll add to it, and it's the exact same point I just made, though. It's not like in the tariff situation last year where you rapidly repriced like 15, 20%, and then you started to see the market stabilize and bounce back. You might have during COVID, you had 5-10% days several times, and you could make the case of, hey, this is just a volatile trade. There's a bounce back effect, a snapback effect. We're not starting from a low point. We're starting from a point of elevated valuation. So you could already say, not even just the fact that it was at all-time highs, but those all-time highs were expensive, all-time high to all-time high. And we're basically all the way back there already, and there hasn't even been the resolution yet. If anything, you saw escalation.
Yeah, I mean, 2.2% off of all-time highs in the S&P 500, which I know is not a small move, but I mean, like, it's considerable that, again, there's still...
That's a day.
Yeah, that is a day, especially given some of the activity we saw just last week. Of course, last week closing out a really strong week for all 4 of our major averages. But as always on this show, we'll kick things off with several of these key stock movers to keep on your Monday radar. We'll also preview Johnson & Johnson and CarMax, both ahead of their earnings reports due out tomorrow morning. And for FOMO, we'll dive deeper into a downgrade call on Nike, with HSBC saying its turnaround is now a show-me story with no short-term catalysts. We'll also break down why Evercore is turning a bit more optimistic on the very beaten-down home builder stocks. And we will discuss the loneliness epidemic, its $400 billion economic impact, and the rise of this IRL economy. So, wide variety of conversations today, but to start things off, we have lots of analyst calls as we, of course, reset for this week, reset for the geopolitical headlines, and also reset for earnings. And I think that we're seeing a lot of this updated coverage as we now go into a full other earnings season. But starting off with CoreWeave, as we did see Macquarie upgrade CoreWeave shares to outperform from neutral. Price target also raised to 125 from 90, saying that their recent announcements with Meta and Anthropic, of course, that we got last week, suggest that its ecosystem role is becoming structural, and they believe CoreWeave will increasingly become a structural player into the next decade as opposed to a stoppage on balance sheet financing or GPU risk. So they did say they have near-term capacity to shore up their compute needs relative to these in-house deployments, and that recent headlines validate this differentiated platform that CoreWeave is trying to establish. And so CoreWeave has been definitely in the headlines and definitely of note as of late, because we are now up just 44% so far this month and now up 56% on the year. I mean, this name has been in a rally.
Yeah, and we've made the case that we've watched, and at least I've made the case for sure, that we've watched this infrastructure of a service kind of subset of the economy in the market, where these names like a CoreWeave, like an Applied Digital, and some of the Bitcoin miners, for example, and even some of the cloud players that have been able to show their role. NVIDIA, of course, can fit into this as well. But we've watched them almost take the role of the Adobes, the Salesforces, and sort of the SaaS subset of stocks within portfolios, because what have they been able to provide? Strong growth consistently, and also kind of consistent cash flow through a subscription-based model. So while they're selling capacity, while they're selling hardware, while they're selling maybe rented out space for data centers, whatever it may be, it's annuitized almost in its structure through that subscription-based model. And that's essentially what Adobe and Salesforce have been able to do for the last 5-10 years that the market absolutely loved until it didn't.
It's true, until it didn't. And we also did get some reports from the Wall Street Journal that CoreWeave did hike its prices by more than 20% through the end of last year. Also now asking some of these smaller companies to sign more long-term, like 3-year contracts, up from prior commitments of just 1 year. So also interesting because, again, taking a note from the business model that the street tends to like, and that's more consistency, reliability, and long-term contracts. I mean, plus, again, inking like $21 billion deals last week definitely helped provide a catalyst. We rose 3.5% Thursday, another 9% on, or excuse me, 11% on Friday, and now we're up another 9.5% today. So this name's last 3 sessions have been really impressive. And again, it's finding these winners and losers with the broader AI trade instead of like, you know, the broad-based strength we saw throughout most of 2025. But next name today here is Starbucks. Starbucks with actually some positive analyst news as Jefferies did upgrade shares to hold from underperform. Price target raised to 92 from 86. Citing the company's less international exposure now that China is franchised and a stabilizing U.S. business is also a bright spot. They did say visibility into their execution really of this turnaround has also improved, and added, however, though, that Starbucks continues to trade at a relatively large premium, which is unwarranted at these current conditions and current levels. Starbucks up modestly today, but has seen a degree of skepticism really in regards to, of course, new leadership and actually being able to continue to be as competitive in a fairly difficult market to right now like dominate. But Starbucks still obviously a huge force and actually has looked pretty strong, up still 15% on the year.
Yeah, this is a little bit odd because there's a lot of things that are laid out that sound positive, and then at the end it's sort of a, oh, but it's expensive. So it's an industry leader. It's one of the most, we're going to talk about Nike later on with Marley, and despite Nike's kind of stumbling that it's had apparently in terms of stock price, it's still one of the most recognizable brands. It's absolutely a top 10 logo. I put Starbucks on the short list of similar. It's one of the most recognizable brands, certainly a recognizable logo, and it really, it's positioned itself to capitalize on routine. And so again, we talked about infrastructure as a service for CoreWeave. Starbucks is certainly not a service in the sense of a subscription-based model, but it is a service in the sense of you consistently go back because it's preying on that, hey, I need my coffee in the morning, I need breakfast on the way into work, and that's what the market loves.
It's true, and the market does like that, and especially right now in a discretionary environment that has not been very even either, actually. To speak to the comparisons of like, you know, AI versus discretionary, totally different, but definitely confirming this is more of that stock pickers market, it seems. And next name today fits that broader tech theme to HPE with actually a downgrade from Raymond James to outperform from strong buy with a price target that was, I mean, modestly reduced, $29 from down from $30. They do still see significant upside to shares and consider it an attractive value stock, but they did cite less certainty around growth and catalysts behind this downgrade, saying that their choice to focus on AI profits over market share makes sense as this strategy impacts growth but does protect their margins. And so again, interesting that this is a downgrade because most of the commentary from this note was pretty positive for a name that's been able to hold on to an 82% climb over the last year or so.
Yeah, and this is an analyst shop that provides kind of 5 ratings. So this would be like going to a 4 out of 5 instead of a 5 out of 5. It would still be on most industry compiled lists considered a buy. And so it is absolutely a bullish note. It's just incrementally less bullish than it was before.
Yeah, and a name that is actually, and frankly, impressive given all of the fear of like the SaaS apocalypse. We're only about 5% from these highs, at least recently in this name. So last name today here is Best Buy. Best Buy is down about 2.6%. So our real lone red name of the group today, but received a double downgrade to a sell rating, with a Goldman Sachs analyst team writing that sales could falter as rising memory costs push up laptop and computer prices. So this team, again, downgrading shares to a sell designation, also trimming their price to 59 from 76, which represents about 9% downside from where we closed on Friday. They did say that Best Buy could see a benefit to same-store sales from a pull forward of PC demand and higher tax refunds in the first quarter, but they also do see a risk to sales on the horizon this year, saying that these higher costs for computer memory and data storage will start to work their way into the prices of these laptops and computers. And so they believe this could lead to margin compression as consumers look towards more of these lower priced units, and could also result in volume declines as manufacturers prioritize fewer consumer electronic shipments. And so obviously, the memory boom has benefited names like SanDisk, Micron. I mean, the list just goes on. But that does not mean, again, that this memory demand is going to be a boom for the entire tech trade. And I think that we're starting to, again, realize some of these underperformers and these names that could see like long-term impacts of these rising memory costs.
Yeah, I talked with Mara 360 on this particular note, and when you look at this stock, I think it's disappointing in a few ways. One, you do have those dynamics that you described, which is sort of product mix weakness, the memory shortage and how that's influencing, the focus of some manufacturers, the trade down effect of consumers, but also kind of a skewed first quarter based on some of the support of pull forward demand around PCs and higher tax refunds. But what really kind of alarmed me as I dug into Best Buy a little bit further, I looked at some of the second measure data. So think kind of observed sales by a Bloomberg, or we've had Placer AI on before. They'll do foot traffic. SimilarWeb will track sort of, hey, website visits, things like that. All of them not only were disappointing, but in some cases significantly disappointing relative to the industry. So for example, observed sales is compiled by Bloomberg as of March 31st, were down 8.5% year over year, but for the industry, they were seen up 4.6%. And so that's not only a meaningful divergence, that's like a crater between those two. One's going one way, one's going the other. Foot traffic was down 1.1%, and then even web traffic growing 2.7% year over year, lagged industry growth, but that was closer to 6%. So any way you slice it, not a super promising second measure data for Best Buy going into this first quarter earnings whenever we get them.
Yeah, and I will say a name that has been a weak spot for this year, and I mean, is lower this year, lower today, has fallen about 10% year to date. So it's not like it's seen a huge contraction, but I do think an interesting call, especially because they also have that exposure to like appliances, some of these big ticket items you purchase for your home, which we've also seen a bit of a slowdown in that regard. So unfortunately exposed to some areas of pricing pressures, it seems, and that's called out today by this Goldman analyst with a double downgrade. And so we'll leave it there for the top of our show today. But coming up next, time to discuss two names with earnings still ahead, those coming this week, at least tomorrow morning. Johnson & Johnson, which is lower on the session, and CarMax actually up about 4.5% into its earnings again out tomorrow morning.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Intern, this place is incredible. It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab, they can do everything. Invest, trade, get full-service wealth management, and anything in between. Think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. It's time for our Chart Master segment, a little bit of chart and trade action here. We got Rick Ducat, lead market technician, here with me. I'm Alex Coffey, of course, and nothing says Next Gen Investing like Johnson & Johnson, Rick. So let's talk about this ahead of earnings.
Hey, you know what? It's a big market cap company. It's had some interesting moves here. So sometimes opportunities are found in places you might not always be looking at the start. So like I said, up almost 59% on the year. Here's on the past.
It's like a
250.
snake we got going here.
Well, exactly, yeah. So I mean, it's really been a pretty nice, consistent channel that we saw for a lot of the past year or so. Now we can see that things have kind of moderated a little bit here. 251.71 is where we hit our highs. From there, you could draw a downward sloping trend line connecting these subsequent highs. You could also draw an accompanying trend line going across these lows. So kind of a triangular shape here. Kind of funny that you say a snake, because it's also called a cobra type pattern sometimes because it can resemble that figure. So these low volatility periods can often be a precursor to higher volatility, especially when you have earnings on the horizon here. So some notable horizontal levels, obviously our old highs first, 251.71, our set of relative highs here at 247, and then a low point here, 232 would be kind of a breakdown point to watch out for, and then 225 potentially. So if we were to think about our moving averages that we follow here, we can see that we have seen much more of a sideways drift over the past couple months or so. You can see that our dark blue 5-day, our teal 21-day, our weekly and monthly exponential moving averages right around 239, 240 roughly here. To the downside, our gold quarterly 63-day EMA comes in just below 234. So an easy short-term downside boundary stands out here because it lines up roughly with our relative lows as well as our trend line that you could draw here. RSI, our measure of momentum, trending lower, green trend line broken, downward sloping trend line in play, but a pretty common situation heading into earnings is for momentum to drift. So I don't think I would make too terribly much of that at this point. Finally, our volume profile study shows that we have some pretty distinct nodes that you could be on the lookout for. The most notable one closer to current price activity between about 238 to 246. Then to the downside, a pretty small pocket here, but still one that kind of stands out as a bit more of a blip on our overall picture here, near about 230 roughly. Then down here, near about 220.
So if we were to summarize here, maybe short-term kind of lost in the price action here a little bit, consolidating, but certainly this longer-term trend seems to be intact. Moving averages sort of illustrated that as well, but can't ignore that breakdown in momentum. It has been notable, but certainly you mentioned it's not uncommon around earnings. Speaking of earnings, looking at an example now in Johnson & Johnson ahead of those results. Now, for this example, I elected to skip this Friday's expiration, go to next. So it gives it a little bit more duration than we would typically say a traditional earnings trade would have. So for this example, acknowledging sort of the lower volatility element that is kind of synonymous with the Johnson & Johnson, I went out a little bit more in time to get a little bit more premium with these options. So it's the 230, 227 and a half, April 24th. So skipping, again, next week's expiration, or this week's expiration to next week's, and looking to collect 50 cents. So that 50 cents would be 1/5 the width of the strikes, Rick. So it's creating a situation where you're risking 4 to make 1, or in this case, we're using real numbers for this example, 200 per spread with a chance to make 50. Break even at 229.50 is below that kind of pocket of volume, below some of those moving averages, and of course, below some of those support levels that you talked about. So it's a risk-defined, neutral to bullish, a little bit over a week and a half or so long trade till expiration, certainly going to be influenced by those earnings results. All right, not the only name with earnings pre-market tomorrow. We're also looking at CarMax. Stock ticker is KMX. In this case, Rick, also screams next gen as the next gen upgrades their cars. Maybe they go to the lot, the CarMax, kind of the old school way of going about it.
Yeah, so this one, quite a different picture than our last chart here, down about 26.5% during the past trading year, 251 days here. But we are up pretty notably as well from the lows, up 61.5% from this low point that we established here near 30.26. Much more of a sideways drift once again during this past quarter here, with some big swings interspersed between that area. A low point that we established here near 38, but really this was much more of a consistent bottom area near 40. Our high that we saw here near about 49 or so, that's about where we find ourselves today heading into this earnings event. So kind of staying within the boundaries of our established range here, but very much more toward the upside here. If we were to, oh, go ahead.
Well, I was going to say what really stands out to me is clearly disappointment longer term, but we're actually percentage-wise much closer to those highs than we are to the lows. So it's had a really significant rally, but just so much damage was done.
Yeah, exactly here. And it was seeming to be based on earnings. You can see our white line here, vertical line representing our earnings area there that we saw. So also, too, consider this low point here and this pre-gap downward low point here gives us a resistance zone of around 54.50 to about 56.50 or so. That could be an important area to watch out for if we do break above these old highs that we established here. So when we look at our moving averages here, we have crossed above all three of our shorter term moving averages in pretty quick succession here. Our 5-day comes in near about 46 in dark blue, lining up roughly with our trend line here. Meanwhile, our gold and teal are 63 and 21 day respectively, both align right near 43. To the upside, 51.19, our long-term 251 day yearly EMA in orange, that stands out as well. Entering into the overbought area as well today, actually, kind of the opposite of what I was saying. You often see momentum slow. In this case, we're seeing a push above our old relative highs and a push into the overbought area. So an interesting setup if you had a more bullish outlook in this name. Finally, our volume profile shows that we are entering this very thinly traded area that we have here. Everything kind of dried up here. You can see it's because we had those big gaps. So not much sense can be made of any heavy trading areas around here until we start to get around 59, 60 or so to the upside, and then more like 47 to the downside. Point of control comes in around 41.50.
Yeah, second in as many days, I feel like, where we've had that significant price gap on these charts. But Rick, really a story of two different CarMaxes as you're kind of in this CarMax 2.0 the last 6 or so months, and then all that price action here really skewing that look. But an interesting stock, especially as it approaches that level, as earnings, as Rick pointed out, was certainly a catalyst and has the potential to move really, really dramatically. Appreciate that, Rick. Before you go, though, quick look at an example trade in CarMax into earnings. Now, this is a stock that only has monthly option cycles. So you were forced to make a decision. Do you want to extend time, or do you want that true earnings trade? In this case, I kind of found the middle ground. I went out to May, so it's the second furthest or closest dated option cycle, but it does give this trade a little bit more time than just the true earnings expiring at the end of this week. And I couldn't get out of my head sort of that new price range that had established itself over the last quarter or so, Rick. And this is an iron condor, a neutral or range-bound look for a strategy, looking for that range to hold. And there's, of course, momentum building. If it does break out, it has that pocket where it could really hit potentially escape velocity, and that's why risk definition is so important. So it's a $5 wide iron condor, selling the 50 strike, 55, and then selling the 40-35 put vertical, looking for $1.75. So really, this is probably going to be leaning a little bit more bearish than neutral, just because we're closer to that 50 strike, but looking for that longer-term moving average, the upper bound of that particular price range to hold, and a chance to make 175 on 325 in risk. Break evens, of course, 38.25 to the downside and 51.75 over the next month and a week or so as we go out to that May 15th cycle. Appreciate it to Rick Ducat for the help, as always, lead market technician here for the Schwab Network. Coming up next, we'll be joined by Marley Caden here in studio as we discuss Nike, our FOMO stock of the day, a stock that just can't seemingly catch a break, downgraded to hold at HSBC and really trending near its lows of the last decade. We'll talk more about that right after this.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at @NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Pop. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Welcome back to Next Gen Investing. It's time for FOMO, and today's discussion, of course, will be Nike. Joining us here in studio to discuss the stock is Marley Caden, host here across the Schwab Network. Market on close, Trading 360. So we talked Best Buy earlier on Trading 360. We're talking Nike now. You know, it's hard not to see the Nike logo. I've made the case. It's one of the most recognizable. We've talked to those who survey, like Piper Sandler, who survey consumer trends. It consistently rates across generations, one of the most popular brands. You look at the stock and you don't see that. But you turn on the Masters. Here it comes down the 18th fairway. You got Rory McIlroy for the second year in a row, basically stepping up for a putt to win the Masters. You got the guy he's going to have to play if he doesn't make the putt, who also dons the Nike swoosh. Two best players in the world, 4 of the last 5 Masters won by those two guys. They seemingly are dominating in the culture, but not in stock price. What's going on, Marley?
It's such an interesting observation because obviously if you watched any, if you watch any sports, not even just the Masters, but particularly the Masters this weekend, because so many people on the leaderboard have Nike sponsorships. I mean, Rory has been with Nike for more than a decade, I think. But the swoosh is so identifiable. I mean, it's a culture phenom really at this point. I mean, people have tattoos of the Nike swoosh. But the turnaround story is just not happening fast enough. And I think that's where we're at right now. I think they got so diversified across different places. Now they've got Elliott Hill in place since October of 24. And he's really trying to target in on getting things back to being profitable and being the Nike that I think people think of when they see the pop culture thought of Nike, not necessarily the investor version of Nike, trying restructuring, shifting people, restructuring the business, trying to offload some of their heavy inventory numbers. But the analyst consensus is that it's just simply not happening fast enough, Alex. That seems to be what I'm reading overwhelmingly. It's also showing up in the numbers. The latest one's coming from HSBC. HSBC putting out a note. They downgraded Nike to a hold from a buy. So, I mean, they're not at a sell, but they are at a more neutral stance now. They have a target now of $48. Now, it's a pretty significant drop-off from the $90 that they had before. And they cited some visibility issues. They don't think there's a lot of visibility in that recovery plan. They said the turnaround thesis, what they say, has shifted from a not if but when, which is where everybody thought they were, that Elliott Hill would right the ship, it would get better. Now they're saying it's a show-me story with no short-term catalysts. And that's a direct quote from the note. Elliott Hill's been doing everything he can, I think, but still seeing weakness in the last report. In converse, the numbers were bad there. China and Europe, the Middle East, Africa, not moving along fast enough. That sportswear athleisure segment, which is so popular with the younger demographic and very important to any company in this space's success, not doing well either. So HSBC then went farther. They cut their fiscal EBIT targets for 26 to 28 by about 35% overall. So pretty massive trim there. I mean, a third. Right now, they're trading pretty close to 52-week lows. We're just cents off of them at this point. We're, about about 100% downgrade from where we were in our 52-week highs. I mean, it really is not been the year for Nike. Just year to date, as we take a look at some of their performance, they're down almost 33%. And Piper Sandler also weighed in on Friday. They gave a pretty negative note. They downgraded to neutral from overweight. So again, we're not into sell territory, but a lot of the bullish sentiment is really waning here on this name, moving into skepticism. Piper Sandler, they really cited that sportswear athleisure segment as their reason for dropping their price target to $50 from $60, also saying they think the turnaround's too slow, and particularly referencing Greater China revenue. They're also a little bit worried about margin compression because of tariffs, and also their weakening direct and digital channels. I mean, overall, it just wasn't a great report from them, and now the market's responding.
Yeah, I think we're circling the target now in the sense of how can seemingly two things be true at once, which is objectively the recognition, the power of the brand, and the popularity of the brand lead to a stock chart that looks like this in what's objectively been a bull market for the better part of the last 20 years now, post, or I guess 15, post the GFC. And the reasoning might be twofold. Well, one is, while you were talking, I looked up NFL, NBA, just objectively not niche sports. Both Nike, partnerships on those two sports. Carlos Alcaraz, a little bit more niche in tennis, is a big Nike player. But you look at the brand recognition, it's objective, it's strong, and it's worldwide. But we are sometimes, I think, prisoners of our own bubble and our own reality. It's actually doing okay in North America. I noticed you didn't mention North American weakness. 4% constant currency growth 3 quarters ago, 9%, 3%, trending towards 3% again. But Europe, Middle East, Africa, struggling. China, absolutely struggling. And then, of course, it comes down to this is a dollar and cents story, and the execution has been hampered by tariffs. And so they do so much stuff overseas in terms of their manufacturing, getting their product. Thin margins, big business, little impacts go a long ways.
Yeah, I mean, their fiscal third quarter margins were at 40.2%, I think was where they fell. I mean, it's a decrease of 130 basis points from the year prior. That's not what the market wants to see. They've got regional pressures. I think I read a note from B of A mentioning that earlier. They've also had some departures, which is another issue. We never see any response that's generally positive when a company isn't doing well. When we see the departures, their chief innovation officer leaving less than a year in that role. Also, it's the third such departure in under 3 years. So I think that there's just a lot of things weighing here. And Elliott Hill's been straightforward, saying, we're moving as fast as we can. It's not as fast as we wanted. And you did mention North America performed well. That was one of the places they were focused. Those numbers are holding, but China was another place they were focused, and those numbers didn't hold at all.
Do you think it's also possible, too, that I'm trying to figure out a way to phrase this, and I'll use an example. Under Armour was very popular in sort of the 2010 timeframe, and they tried to double down and they expanded into footwear, and it was just a miss. Has Nike overestimated its power and tried to step into regions of this marketplace, notably athleisure, where it just didn't compete very successfully against a Lululemon and some of these other direct-to-consumer brands, and maybe that was just a misstep?
There's a possibility that's true. I think whenever you step into a fashion segment as opposed to sports apparel, which I would argue is sort of a separate sect than athleisure.
Or just footwear.
Yeah,
that's their bread and butter.
It puts, and fashion is cyclical. Trends are cyclical. Lululemon was the only thing anybody wore 5 years ago. Now I'd argue that's aloe, at least in major cities in America. So they're cyclical trends. But Nike Dunks are still on everybody's feet. Air Force Ones are still on everybody's feet. So you bring up a good point. Sneakers will always be their bread and butter, not Converse. Converse is not performing well. But their signature swoosh shoes are doing well. But you bring up a good point. Perhaps they just over-broadened their market. Yes, and if athleisure is not their space, they have to offload that inventory and focus on what does sell for them, which I mean, I was in the airport yesterday, certainly in 2 different heavily traveled international airports, and there were Nike shoes, I would say, on probably 20% of the people I saw.
And sometimes, hey, you just got to be refocused. And we're watching that happen at a company like Starbucks that maybe just saw their offering expand too much. They're honing it back in. Maybe that's what Nike will do too, as they focus on getting things back in order. We appreciate it, Marley Caden, with the update. Before we go to break, though, a quick look at an example trade in Nike. Say you think that it's finally time for Nike to make a turnaround. We got a bullish example here for FOMO, and it's risk defined, most importantly, in case it continues on its downward spiral. But looking at a call diagonal spread, it goes out to June to give this stock just a little bit of time to work its way back up, and it, of course, sells a May option against it, creating that call diagonal spread. It's the 40-45. Really just looking for stabilization and upside from here. Shares, 325 debit means you have $325 in risk on this bullish call diagonal spread. Best case scenario, move towards 45 or so by mid-May. With that, we'll take our next break here as we shift towards social trends in the real world. We'll talk about how that intersects with the market and the economy coming up next.
She's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
And Schwab helps me generate retirement income.
All this Schwab as everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Welcome back to Next Gen Investing. I'm Alex Coffey, now joined by Sam Vadas, of course, host across Schwab Network, host Market on Close, of course, with Marley, as well as Morning Trade Live every morning here on Schwab Network. Good afternoon to you, Sam. Evercore ISI has home builders on their mind. Talk to us about what they have to say.
Yeah, so they've had 3 upgrades here across the space, not just home builders per se, Alex, but also the of supplying them as well. So let me run you through the key names here, which they've turned more bullish on. So you've got Masco to an outperform with an unchanged price target of $78. Of course, not a home builder per se, as I mentioned, but building products used inside homes, more of a supplier type. You've got also Evercore upgrading PulteGroup to outperform from inline as well. Price target now up to 146 from 143. So just a slight tad up there. Evercore also upgrading Toll Brothers to outperform from inline 2. Price target now of 176 from 174. So the latter two, PulteGroup and also Toll Brothers, also trading near recent lows, which really caught the attention of Evercore here. PulteGroup actually currently trades at a PE ratio I was looking at about 11 times, which is below most of its peers. But what Evercore ISI is saying here behind this call is that they are relatively more resilient than peers to the current industry challenges. So it's interesting because across these three particular names, all in the business of home building, obviously. Toll Brothers, as we know, more in the luxury side of the business. PulteGroup, not so much. It's more of a sort of broad strokes type of builder here, but have both successfully, I was reading about, targeted the so-called move up buyers, so those that are looking for a bigger, more expensive home, and also the retirees, where this market is actually seeing more of the demand in a pretty subdued home market out there, or housing market, I should say. So Evercore ISI says the market has already priced in much of the bad news for these builders stocks, and the group may actually lack a near-term catalyst, but downside from here, they say, may be manageable. So it's very interesting framing coming from the analysts over at Evercore ISI, which feels like more of a measured assessment of things right now. Interesting that they said that there's no sort of near-term catalyst, particularly because we continue to get this data. We got more out this morning, the existing home sales, that was at a 9-month low. It doesn't show any signs of improvement just yet, certainly not the turnaround that everyone was hoping for the housing market. Another interesting line from this note is that they say that the home builders hit their historic buy signal last week when the median small cap builder traded below 0.8 times tangible book value. So essentially what they're getting at here is that this is how the company is valued, or what it's worth if you take out the intangible assets, and then also, of course, if you liquidate the balance sheet. So there are signals that the market is pricing in distress here, and typically more than the fundamentals show. But that's the angle that Evercore is very much highlighting right now with some of these names, Alex.
Really appreciate it with Sam Bottas with the update. And with that, we'll say goodbye to Sam. We'll welcome in our next guest. That's Fabio Bin, the co-founder and CMO at WeRoad. And first off, Fabio, really fascinated to have this conversation with you because you've dubbed this kind of part of the market the IRL economy, and it's seeking to solve what you've also dubbed, but I've heard it elsewhere, the loneliness epidemic. So let's start there. What is this loneliness epidemic, and how do we get here?
Okay, first of all, thanks for having me. I think that we are seeing like this emerging trend. Actually, it has been a few years seeing that, coming especially after all the digitalization that we went through in the last decade. So after the emerging of social media, people tended to say on social, on screen, because everything has been optimized for the screen, for screen engagement. And so after the pandemic, we saw the explosion of the, let's say, dating apps, but also the rise, but also the fall of dating apps, because people now, they tend to be quite overwhelmed by the interaction they are having online, and the lack of a real meaningful interaction in real life. That's the point. There's plenty of articles out there and research out there that are basically underlining the fact that all the dopamine stuff that we are having in the online interaction are not turning into something real, so real connection. So that's the point, is bringing back people in real life and start to try to make a business out of it.
Yeah, this makes a lot of sense. And I imagine some of those trends were already kind of snowballing down the hill, and then they just fell off the cliff once the pandemic kind of forced us into those kind of buckets. That said, we're past that, or at least we've reopened, we've returned to IRL, and we've tried to fill that void, or at least many have. And Fabio, you and your business are seeking to provide experiences, is my understanding, to help people who are experiencing that loneliness and wanting to re-engage. Talk to us a little bit about that IRL economy and the opportunities that you and your business are seeking to, find consumers at.
Yeah, look, we started because we have a problem and was like to find someone to travel with, for example, doing trips, long-haul trips, and is meant to target people in their 30s and 40s. The point is, you just moved to a new city, you have a new job, and it's very, very difficult to rebuild your network of friends. Or maybe your friends are like, they are married, they are children, so it's very, very difficult to travel with them. So the idea when we started in 2017 was, okay, I have to find someone to travel with. And we started, of course, providing itineraries like on-the-road tours, like 10, 15 days long. But what we immediately understood is that the real need that we were fulfilling wasn't about providing a nice itinerary, but it was providing a context to make new connection, meaningful connection. So this trip were meant for people that they didn't know each other before the trip, and they got to be friends during the trip, and they stayed friends after the trip. So we understood that the real deal was about connecting people, not about making them traveling, It's something slightly different, because we took care of the context, but the real need was about connection. In fact, people started to come back and get in touch with new people again. Then we did it with travel, but travel is just one of the channels, one of the means that you can use to do that. Now there's like a plethora of new startups working in real life. There are people organizing dinners for strangers. There are small groups organizing, again, running clubs. Or there are people using Strava, for example, to meet new people. So the point is that people are getting back to real, but not because they are just tired of swiping on the online side, but because they are looking for real connection. That's the point. And to get real connection, you need time and you need a proper context.
Yeah, this is really, really interesting. And so, Fabio, I know that this show is primarily targeting viewers that are self-directed, retail investors. But as an entrepreneur who's operating and building a business within this space, I'm sure you got visibility into the kind of demand for this type of opportunity for consumers who are seeking this. Is the demand kind of following the inverse to what we saw kind of pre-pandemic, the other way, where it was like slowly we're becoming more online? Is it we're slowly going back to IRL, and hopefully we'll hit some sort of escape velocity here soon?
I believe so. Look, I believe that the peak for the dating apps and, let's say, the online engagement has been soon after the pandemic. We were all about connecting in digitally, and then we started growing the need, or at least we started to appreciate this comeback of real life in multiple forms. As I said, it's not just trip or traveling, can be dining out. Dining out is a very, very big industry. Still, what is changed is not the size per se of the industry, which of course is going back to real good numbers. But the point is the objective. So what is changing is the consumer behavior. So people are still going out and dine out. The point is they want to pair this experience with meeting new people, with getting new, we get to know new people. That's the main deal here. It's not just about the size and the volume of the, let's say, experience economy. Experience economy, of course, it went much better after the pandemic, and even being hit by COVID, and everything in travel that happened, he get back to the previous pandemic levels and even better. The point is, what is changing is the driver for people to travel, or the driver for people for going out. This is the biggest thing. And from my observatory, what I can tell you is the future is not about like releasing the next big app, changing the world, or getting customers, but it's just about intercepting in the right way, in the smartest way, the consumer needs. And that's why, for example, in the real economy, there's not just one dominant app or one dominant player. There are many, many players. Most of them are very local, they're very tiny, they are using very low code technology, still they are generating business. So what I'm seeing here is a huge space for everyone, and also the opportunity for small communities, local communities, just even using low code or vibe code technology to start their own follower base and their own customer base, because people are ready. That's another very important part. People are ready to pay for that. They are ready to pay in form of subscription or just in form of, like, let's say, adding an amount to the dinner, whatever. But they are ready to pay for. They're not ready. They're already paying for that.
Really, really appreciate you taking the time, Fabio. It's been a pleasure, a great conversation, and I look forward to the growth of your business and this trend continuing. That's Fabio Bin, the co-founder of WeRoad. As we shift gears, we'll welcome in our next and final guest of the program. That's Brian C., the founding partner of the Capital Stewards. We're going to take a step back. We're going to talk some macro markets. Nice little start to the week here for the broader indexes. Brian, I want to get your thoughts on how things stand so far in your eyes.
Yeah, Alex, thanks for having me on this afternoon. The market has been moving sharply in both directions to start the year, right? And that's exactly why long-term investing perspective matters. It would have been really easy to go into this weekend and say, man, they didn't get a deal done, so the market's going to go down today, so I should sell. And that would have been the wrong thing to do. Trading day-to-day based on the headlines is a low probability path to success. And so what we've been telling our clients is that investors that put money to work in 2008 before the financial crisis, in late January of 2020 before COVID, in 2022, again, before the tech correction, and even for folks that put money to work right before the Iran conflict that we're seeing now, those people are all happy investors today.
All right.
And so,
sorry, Brian, I was going to say, I got a quick question for you. I've been starting to make the case that the market's starting to look through this conflict. Do you think that there's evidence that that's the case, or is it too early to tell?
I think the market is absolutely expecting this conflict to come to a resolution in the next couple of weeks. If you look right now in the Middle East, the barrel of oil is trading at $140, and we don't see that in Brent prices. We don't see that in U.S. energy prices yet. And so the market is definitely pricing some sort of faster resolution to the conflict over the next couple of weeks. But there's certainly risk to that, right? Our view on the conflict is really that we expect them to get to something in the next 7 to 10 days, and if they don't, then we're going to be in a different place.
All right, Brian, this is called Next Gen Investing after all, and while we have viewers of all demos, catering to a younger demo or maybe just someone who's embarking upon their investing journey for the first time. Not everybody's got a decade or two experience like yourself, and they want to be a good capital steward of their own investments. Talk to us about some of the things that you've learned in your career, experiencing all sorts of markets, and where this one maybe fits within that framework.
Yeah, so I think the first thing for younger investors to understand is that asset allocation and investing in the market in a broad basket of different assets is the most important investment decision that they're going to make. It's really easy to get sucked into what's really cool today, what's fancy. Maybe it's Bitcoin, maybe it's gold, maybe it's certain kinds of technology stocks. But at the end of the day, the thing that's really going to matter over the long term is getting invested in different kinds of assets, stocks, real estate, all different kinds of things, and then doing that over the long term. And that sounds really boring, right? Everybody's like, man, I don't want to hear that. I want to do something that's cool and nifty. But what we see over time is that that's what drives the highest probability of success for folks. in the long term. And so if you want to be successful, if you want to make money investing, the best way to do that is to take sort of a disciplined approach over the long term. And I've seen that. I've been in this business since 2008. I saw the financial crisis, and so I've seen that be successful now for really coming up on a couple of decades.
Seemingly more important than ever with this sort of K-shaped economy that we've started to see develop over the last 5 years. Even if that's always been there, it seems very pronounced right now. What's your kind of longer-term view, I guess, with all the disruption of AI that's sort of looming large over the tech sector at the moment?
Yeah, I think this is a structural reality that we're going to have to live with for a while, right? The parts of the U.S. economy that are performing well are those that are linked to the AI investment cycle. It's businesses that are investing heavily in AI and technology infrastructure. That's going to drive future profitability down the road, but that's really where the business spending is at today. And the consumers that have investments, I talked about this, just a minute ago for younger investors, right? Being invested is really important. And for consumers that have investments, they're continuing to spend because they're looking at their portfolios and saying, man, I have more money than I ever expected to have at this point in my life. And so, I think for folks, regardless of where you sit sort of on that K-shape, whether you're sort of earlier in your career, whether you're sort of trying to grow your investments, or whether you've got capital and you're sort of sitting at the top of it, it's really important to be disciplined, continue to invest over time. I don't think that's going to change, right? AI is only going to drive returns to be sort of even more bifurcated in the economy. And so getting in is the right thing to do.
Well said. Brian C., the founding partner of the Capital Stewards. Appreciate it. We'll love to have you back soon, talk more. And that's going to do it for us here on Next Gen Investing. Thanks as always for tuning in. We've got the watch list up next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, great ideas, minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it. To leave everything behind, literally come across the entire world, I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com. Good afternoon. Welcome to the new watch list right here on Schwab Network. I'm Nicole Petalides. It's 2 p.m. Eastern Time. We're live at the New York Stock Exchange, and we have a great show coming up for you. In our tech spotlight, we'll take a closer look at NVIDIA. The stock is just above the unchanged line for this year, 2026. Are there any major catalysts on the horizon to push this one higher? And our watch list panel will take a closer look at the impact of the oil shock that it's having on the larger market and what we can expect in the energy sector as the conflict in Iran continues and hits some of our names. But we have a lot to talk about there. And in our Big Move segment, Alex Coffey's standing by. He's highlighting some of the outside options trades for names such as Microsoft, Alphabet, Intel. We have so much for you in this show. We're looking at the memory stocks, the Goldman Sachs Rule of 10, and a slew of other names, Palantir, etc. In the meantime, and Intel too. Take a look at the markets here. Look at this turnaround, right? You remember this morning where we had so much red and now it's all back in the green. The S&P is now up almost 0.5% at 68.47. As of Friday's close, about 2% off the real highs. And so you'll take that after 2 weeks of gains, right? That was up 3.5% last week. The Nasdaq was up 4.5% last week, and it's up 0.5% today at 25,248. The Dow Jones Industrial Average gained 3% last week and is up today, right now 29 points. And the Russell also gaining. All of this, obviously, on now that we're hearing that Iran may be interested in coming back to the table to talk. And we have a lot to take a look at. Look at this. So you're seeing a lot of green now. In the morning, you didn't see that. Now it's tech, energy, financials helping to lead the way. You have a lot of moves, which we'll go over. NVIDIA has had some great moves. You've seen Palantir with great moves. And a lot of positive comments that go along with it. A name like Palantir that Kathy Wood has been buying into. We have other names, the memory stocks with up arrows. And right now, as I look at the heat map, you see Walmart is down, even though that actually got some positive comments. We did see some upgrades today on some of the housing stocks, Pulte Home and Toll Brothers. Williams-Sonoma got an upgrade. And so that's a name to watch. CoreWeave has been killing it. Microsoft is unbelievable. Microsoft is a name that a lot of people are looking at. We're going to talk more about that this hour and next hour too. And here's a look at the futures right now. We're looking at gold down $32 at the moment. It's at $47.55 a troy ounce. Oil is higher. Look, it's well off the highs of the day. Had been up over $100. Both West Texas and Brent crude had been above $100. So this is a nice move here.
and now it's at 98.85 the barrel. The 10-year bond yield comes down. There's still a lot of bets that the 10-year bond yield will continue to come down lower. And the U.S. dollar is at 98.33, and the Bitcoin trade right now is down 1.6%. So that's worth noting. But we've heard some positive comments from Morgan Stanley today, JP Morgan, Goldman Sachs, on why you should be buying into the big picture. And so we're 2 hours away from the closing bell. As I just mentioned, some of those big names that are saying they're turning cautiously bullish. For example, that's what Morgan Stanley said. Let's take a closer look at today's market moves. Joining me right now, Diane King Hall is with me, and that first story here this morning, we woke up early and then we heard from Goldman Sachs, which kicked off the bank earnings this morning. I love this kind of week. It is trading a little lower, but there was a lot of excitement around the name.
There was, and listen, banks take center stage this week. Goldman was first up at bat, and this one gives you kind of a temperature check on how the banks are doing. And to be fair, you know, some of the banks have been underperformers so far this year, especially in the context of the outperformance last year. Now, Goldman actually did do better than expected. They had one weak point within their quarterly results. The CEO was a little bit more cautious with regard to the macro picture. Of course, we know there's geopolitical headwinds that have been surrounding and slowed some activity. But they did beat expectations on the top and bottom line. You saw a profit coming in at $17.55 per share. That was better than expected, up 19% on a year-over-year basis. Revenue topping $17.2 billion. We're looking at a lot of the strength. Global banking and markets up 19%. Asset and wealth management higher. Investment banking, huge surge there, almost 50% there. The CEO, David Solomon, saying companies are looking to scale and consolidate here, even with the geopolitical tensions. The hesitation, though, is the uncertainty tied to the Middle East. We know we're continuing to have those conversations. The peace talks ended without a resolution this weekend, coming into this week. So we've seen some escalation of rhetoric, but it looks like investors are looking beyond that, especially when you look at the price action throughout today's session. Yes, Goldman is still under pressure, but as you mentioned, Nicole, big picture, quite the recovery that we've seen from this morning there. Now, the question is, can Wall Street keep up the momentum? We've got more banks reporting this week. We've got JP Morgan Chase up next at bat. We've got Citigroup as well at bat. And Citigroup's been a huge outperformer so far this year. Hats off to Jane Fraser for all the work that she's done. The momentum it's had both on a year-to-date basis and a year-over-year basis, especially given the weakness. For instance, if you look at the KBW index, it will be interesting to see how they perform.
You know, I'm just going to add one quick thought, and that is on Goldman Sachs here. I mean, obviously, you heard David Solomon. He talked about, he really was pretty confident about how they were positioned, talked about the geopolitical landscape being really complex, but that the IPO market conditions will stabilize. They saw a lot of good things going forward, record quarterly, IB and trading. So there was a lot of good things. But the one thing I wanted to add was private credit. And Bank of America saying it's good to see how maybe these banks have less exposure to private credit than they did in past years. And so that can set the tone, too, for the rest of the week, because you don't want to have too much exposure to private credit, which has been beaten down.
Absolutely.
So we'll talk about Rule of 10 here. And this is something that we don't necessarily hit, but Goldman Sachs has its own way of looking at stocks, and maybe stocks that really have some growth potential going forward and have been beaten down, right?
Some of these on the list now were high flyers once upon a time. So you get these emails from Goldman every now and then that kind of takes an assessment of how they look at the market, whether it's on the economic front or the equity front. So there's something they have that's called the Rule of 10. And you put this in the context of what had been your high growth names. Think of like an NVIDIA or Meta or Amazon. But they've been lagging badly here. So the Rule of 10, to kind of keep it simple, is companies growing revenue at least 10% consistently. So that's one of the metrics there. And it's not just past growth, but the expectation from here, right? What does the future cast look like? Are they expected to continue to grow on this level? So it's kind of a quality growth screening mechanism here. Goldman says we've seen a major derating of secular growth. So these stocks, like, as I mentioned, the NVIDIA, the Metas, the Amazons of of the world, still significantly below their highs, even with the S&P 500 near records, because even with the pullback that we saw is not as dramatic as one might have expected. So Goldman says a comeback is coming. The macro backdrop could be flipping in their favor. So, the setup looks good for this. Rates are the swing factor from the point of view for Goldman Sachs with regard to this. They expect the 10-year to fall to around 4.1%. I know you've been honing in on that, Nicole. So lower rates equals higher valuations for these growth stocks. So again, the AI overhang is something that has been hitting these companies, which they acknowledge that, and they think that that's still a risk. But they say that, the uncertainty there needs to be resolved, but the proof has to come in terms of AI helping and not hurting. So that is something to watch. Who's in the comeback trade? Again, they think AMD, Broadcom, NVIDIA's been on this list, Alphabet, Netflix, Uber.
I love this list. I was going through it, and it obviously talks about the last 10 years. The last 2 years each with 10% growth, and then the next 3 years with 10% growth, the projections, right? And I thought this list was really cool. I mean, I was looking up some of the names too. Uber, which had a $94 target today. Netflix, which is expecting ad revenue of $3 billion. We also saw some positive comments on Netflix as well. Meta, which actually has an AI version of Mark Zuckerberg.
I know,
You can
that's
talk to
wild.
your AI boss. I mean, I can't get over it. It's going to have his mannerisms and all these things, in addition to being a
very
digital
meta.
advertising space and maybe unseating Google for the top spot, and some of the others that you mentioned, Aristanet, AMD, NVIDIA. So I think this list was really cool, and I'm glad that we had a chance to take a look at that. Last but not least, we look at the memory stocks, and let's take a look, because they have been some outperformers, and we've seen a lot of buys and good news on them, right?
Yeah, I mean, huge move on memory today. SanDisk rallying more than 8%. The gains just keep going right now for this one. Citigroup is bullish on the sector, on memory and storage. So we're talking SanDisk, we're talking Western Digital, we're talking Seagate. They're doubling down on this trade, raising their targets across the space. The core thesis here is that AI is driving an explosion in data, and that data needs to be stored. SanDisk, their price target, they're upping that to 980, so getting close to 1,000 there. They've got a buy rating there. Seagate raising that to 595, also a buy rating there. That's up from approaching 500. You got Western Digital increasing that price target to 405 from 335. So in other words, even the huge outperformance that we saw last year and the explosive gains that these memory stocks have had, they see still more upside to come from here, Nicole.
All right. There are a lot of opportunities, folks, especially if something's sold off. These price targets, many of which are higher than where we are now.
Yeah.
Diane King Hall, thank you. A good look at a lot of the top stories there and some of the stock movers as well. Coming up, we'll spotlight some more tech for you. NVIDIA in particular. The NVIDIA shares are up nearly 10% so far here in April. We want to take a closer look at what lies ahead for that chip giant. And still to come, big moves. Alex Coffey is standing by and will join us with real options trades for Microsoft, Alphabet, and Intel, which is at 5-year highs. We're going to take a look at Intel. So much more when this new watch list returns right here on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our Investing Webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back. We're here, the watch list. We're watching Intel, which is rallying in Monday's trading, hitting new 5-year highs after analysts are both Jefferies and also Northland raising the price targets. Jefferies now has a $60 price target on the stock and maintained its hold rating. And then Northland has a bit more bullish call there with a $92 price target and an outperform rating. Intel is up more than 40% so far in April. When you weren't watching, Intel was soaring to 5-year highs. And here's a full screen right now. Take a look at these chip stocks. And some of these with up arrows, AMD and Broadcom and Intel. NVIDIA is pulling back a little bit, and we're going to be talking about NVIDIA. In fact, we'll go further into that in just a moment. But Intel's at 64.74 here today. So let's go deeper in on those chip stocks in our tech spotlight. Joining me right now are Ray Wang, CEO of Constellation Research and author of Everybody Wants to Rule the World. So you are feeling bullish and bullish on NVIDIA in particular. So tell me about NVIDIA. You know, it's been a bit of a laggard. We know it was the darling of Wall Street over and over again. Is NVIDIA going to rule again? Why?
They're going to come back. The demand is real. All these SaaS apocalypse, AI apocalypse, all the different kind of scenarios are basically being re-looked at, especially given the context of where we are on the geopolitical stage and the AI demand that people see that's real, that's physical, from data center development to energy and power plants that are being built to orders for chips. It's there. Let's be honest, the stock is barely up 1.2% for the year. It's down 2% for the past 6 months. And there look like it's $178 to $180 support level on the back end. And on the top end, there seems to be immediate resistance at a 190 to 192. But once it breaks past 192, you're going to see something different. And it's not because these are made up numbers. I mean, they're real revenues. I mean, you saw 78 to 79 billion. You see Jensen talking about a $1 trillion in sales from Vera Rubin and Blackwell through 2027. These are real numbers. And it's a year over year increase of 77 to 80%. You still can't deny that. And so when we look at the reset that's going to happen after this Iran conflict, you're going to see something different. You're going to see people coming back with tech as a flight back to safety. And more importantly, you're looking at tech as the only growth driver because it's the only unregulated industry out there. And chips are the heart of it. And NVIDIA is at the heart of that AI boom.
And, you know, so many guests who come on say how NVIDIA is such a, you know, enclosed network that it does a little bit of everything. It's not just, you know, the chip sector or just, you know, what a big picture it is. And that's what really differentiates it from its competitors. Would you agree to that?
Nicole, you're absolutely right. I mean, what they've done is they've gone from chip all the way to software, all the way up to agents. And they have not only invested in companies that are in the future, they've not only invested in the rest of the market, they've taken the entire ecosystem with them, not just through the CUDA software, not just through simulation, through the Omniverse. There are still, we're only seeing 10% of the roadmap that's imagined in Jensen's head. And if you just look at market share, they have 94% of the add-in board market, 80% of the AI chip market, 80% of the AI data center market, and 95% of the gaming GPU market. And because they're investing and partnering all the way up the stack, they have the entire AI factory. This is compute, data, pathways, orchestration, and that's what's giving them leg up. And so they're now in software, they're now in connectivity. And that recent deal with Marvell shows that this glue moves across chipsets, optimizing power, latency, and they're basically building an OS for a single platform. And what they want to be is that one-stop shop where you access tokens, and tokens are the currency for AI. And they plan to be in every piece of that business.
Yeah, I mean, Marvell is hitting record highs, right? I mean, you don't see that every day. In fact, over 1 year, it's up 113%. Year to date, it's up 53%. And one of the articles said how it's getting a boost from Amazon, as well as from the optical business that it has. And we know there was actually an optical trade show recently. That was a big deal, too. It wasn't just the GTC show for NVIDIA. That following that was that optics show, which had a lot of the big names, too. So Marvell getting a nice boost here.
Yeah, and this is just the beginning. We haven't talked about physical AI. We haven't talked about sovereign AI. Every country now wants to have their own AI so they can get the scales that the companies in their country are protected, their cultures, their values are being delivered in the right capacity. And the physical AI with the robots is coming 3 to 5 years out. It looks great now, but it's going to take 3 years for it to get commercialized. So sovereign physical AI, then the next set of chips. And the inference that they're doing now that we're moving out of training to inference is really shifting. So, but there are constraints. There are headwinds too that are in this space.
You know, Ray, I can't tell you how many people come on and they talk about AI strength, how many people come on and talk about surging global demand and the AI revolution, and that we're still in the early stages. How does this Iran war factor in for tech investors overall? What would you say to them? Is this a great opportunity on the pullback? Because you have a lot of great names that are down, 20% off their highs right now, right?
Yeah, there is. Here's the thing. If the Iran war continues for 3 months, we're going to run out of sulfuric acid. We're going to run out of supply chains. You saw today, it's kind of funny, it shows up on your terminals. It said Toto not shipping any toilets because their supply chain is completely cut, right? So that's going to continue in the chip sector and in the AI sector if we're past 3 months out. If we're before 3 months out, which is where the traders are at this moment, they're betting the fact that this will be over in 3 months, then things are going to be okay. But what we're missing is sulfuric acid. That's what you need to etch chips on. You're missing all the components that are passing through the Strait of Hormuz. You're missing all the components that you need, not just the chemicals, but also the capabilities in terms of moving chips to one area and then back to the other area, back to Taiwan and then back out. So that's really what's holding things up. And so those are some risks that are out there that you think. But if you look at the sentiment of everybody on the street, this war would be over in 3 months, which is why you see the hedging in the different direction.
Well, it's good to see you. Ray Wong, thank you, of Constellation Research. Appreciate it. Well, some of the latest AI updates from Oracle have that stock up 11%. We'll dive into the technicals for Palantir and NVIDIA. A lot more to come. We'll look at the energy sector as oil prices still hovering around $100. What's next there? The watch list. We'll be right back.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time.
Welcome back to the watch list. We're watching Oracle. Oracle is rallying today, up 11% after the company unveiled AI-focused updates to its utility software suite at its Customer Edge Summit. Now, the company also announced that its Acon X platform has been updated with new capabilities to improve project transparency and control. And even after today's move, Oracle shares, well, they're down more than 55% from the September all-time highs. And here is a look at how the rest of the group is doing. So you see Oracle there, but look at the rest of the names. Software stocks, looking at Salesforce and also Palo Alto and ServiceNow and Fortinet and Adobe. You know what I see? And Intuit, green, green, green. Microsoft, green. Synopsys green, Intuit green, CrowdStrike green, etc. So that's what you're getting there today. Wow, right? You're going to see a lot there. And Palantir has been an incredible story, too. I mean, Kathy Wood just bought up about almost $11 million worth. Let's get some technicals for all of this. So now it's time for Charts to Watch. And joining me right now, Rachel Deschelle. Oh, my goodness, it's great to see you. Senior Manager of Trading Services at Charles Schwab. And Rachel, I know you've been watching a lot of these stocks that have been on the move. The geopolitical story day in, the headlines, they can sometimes really move this market around and can weigh on the market. You're watching the S&P chart. We're not that far off the record highs, but we had 5 weeks of selling, 2 weeks of gains. What are you watching there?
Yeah, Nicole, great to join you for this one. And yeah, I will say the headlines have been loud, but the trends are even louder. So as far as the S&P 500, we are trading up nearly 8% from the lows, and that's occurring on improving breadth as well. And now, believe it or not, we're just over 2% from all-time highs. So we are really close to making our way back to those levels. Now, a couple major levels of support here in the near term. The first one is definitely going to be that 50-day moving average at 67.60 or so. And honestly, I would not be surprised if we saw a little bit of a retest there, because some of this rally is actually occurring on a little bit lighter volume. Then below that, if we do retest the 50 and for some reason don't end up holding it, the next long-term level of support really is going to be that entire gap from the 8th last week. And that gap is pretty large. It's 66.20 to 66.70. We see the 200 period moving average falling right in the middle of that gap as well, right around 66.70. Now, if we kind of take a look down below, breadth-wise, that advanced decline line has been improving with trend, and you have now more than 50% of stocks now trading above their 200-day moving average. So the trend is your friend, and we have improving breadth, so that's a good sign.
Yeah, and you know, the headlines, as we just mentioned, geopolitics and how things are moving around. And today we've been getting, even just moments ago, we've gotten that there's continued engagement in the U.S. and Iran, forward motion to try to get to an agreement. It was reported by Israel that there may be another round of negotiations. And there was talk that the U.S. was asking Iran to freeze the enrichment for 20 years, and Iran came back with a shorter single-digit period. But the facts that they're really talking a lot, I think that's bringing optimism to the market that we're not going in to hit Iran again, and so maybe there's some good news there. And I'll leave you with the last thought when it comes to this, and then I want to get to Palantir. The Pakistani official that's involved said that they've intensified their diplomatic approach to attempt to bring the U.S. and Iran back to the negotiating table, according to CBS. So there is some, you know, the fact that they're talking, Rachel, and there's a lot of back and forth, and 20%, and, you know, that shows that it's in the works and not dead in the water, you know, and so that's a good sign. Let's turn our attention over to Palantir. I mentioned, for example, that Wood of Arc went in and bought, 85,000 shares recently, about $11 million worth. So she's hot on Palantir. What are you seeing when you see this name, which is the software sector is also down 25%. So what do you think?
Yeah, I had to bring this one up because we know software and semis, tech in general, has been in the headlines quite a bit. And Palantir has really been on the watch list for bottom fishing. Now, to first kind of give the backdrop on software, we know software over the last few months has really been dragging the tech sector down with it. But software right now is actually looking like a little bit of a false breakdown. It had a break, a support break, and a new yearly low that it put in yesterday. And then it's having this close above the high of the low day possibly today, which would give that first confirmation of a support bounce. And the reason I mention that first is because you're seeing that same exact price action here in Palantir as well. It printed a candle right on and below that long-term support line yesterday, signaling that possible reversal coming. And then today we are just getting that follow through with, I know the market's not closed yet, but in an hour and a half or so, you're seeing that possible close above the high of that low day. So that gives bullish traders or investors confirmation that, hey, we are seeing a support bounce from this level. And even so, even with that low that we put in on Friday, we were seeing momentum has diverged very positively, which is usually the first sign of a possible reversal. And then you see that trend, that price kick into high gear. So it gives a favorable risk to reward setup for traders here. You have support in your risk down at that long-term level of support. And then you have really resistance at those anchored VWAP highs from those all-time highs right around 160 or so, Nicole.
Thank you for that. All right. And then before, I know you have to go, you're a busy lady, but I want to pick your brain on NVIDIA because it's been stuck a little bit around the levels. Lately, it got a little pop, right? So just for this month of April, it's moved higher by about 7.8%. Ray Wong was just on with us a moment ago. He said he liked this name, but at 188 today, and the high was 212. So obviously we're off the highs that was last October. Your thoughts on this chart?
Yeah, I would definitely have to agree with your previous guest here on his view here. So semiconductors have really been that area of the market that really didn't miss a beat, ripping to new all-time highs. And as far as NVIDIA really being the supposable leader in that space, for most of the last 6 months, it's really been stuck in this range between 195 and 170 or so. We saw, similar to the last chart with the recent lows being made, we saw momentum diverge, pricing in or printing a higher low, so giving that bullish momentum divergence, which is that first sign of that possible bottom taking place. So looks like we had that false breakdown at support. We know that failed breakdowns or failed moves really turn into fast moves in the opposite direction, and that's what we've seen here. So I will say NVIDIA does have short-term support right in the middle of this range, right at that 200-day moving average, right around 180 or so. And then resistance, long-term resistance is going to be up ahead at 195 from that range. But on shorter time frames, you can see bottoming formations like a cup and handle pattern. You see that momentum has actually shifted into a bullish regime on the shorter time frame. So I will say if NVIDIA can make its way up to and out of this range, they could be looking at a much larger measured move to the upside past those all-time highs around 220.
All right. Rachel Duchelle, thank you. It's great to see you, Senior Manager of Trading Services at Charles Schwab. Thank you, Rachel. Coming up, our panel is standing by. We're going to look at the surge that we've seen in oil prices. You saw 117, 119. Okay, right now, we're seeing it at 98 bucks. But better rub your eyes because they're moving around a lot. Conflict in Iran continues, and what could happen next? We'll be right back.
Intern, this place is incredible. It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab, they can do everything. Invest, trade, get full service wealth management, and anything in between. Think I'm gonna be sick. We have to buy that now. Schwab.
Invest with Schwab. Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me me on LinkedIn or Instagram for more.
Welcome back to the watch list. We want to take a closer look at oil, the energy sector. Now, some of these names have been soaring. Oil has been soaring, but it's a lot of back and forth. And we're going to have a back and forth with Andrew Graham, Managing Partner, Jackson Square Capital, and Ben Cook, Portfolio Manager at Hennessy Energy Transition Fund. We also heard from OPEC and lowering the global outlook. And we know that the production from Iran and Saudi Arabia and UAE has all come down a bit. So, Andrew, I'll start with you. Some of your thoughts here as we take a look at the big picture. Andrew, go ahead.
Well, I think the price of Brent crude that sort of spooks equity markets is usually something above $120 a barrel. So we're beneath that now. If the conflict ended tomorrow, I would think that prices go back to something in the low 80s, high 70s, something like that. We had a structurally oversupplied market prior to the conflict, and I don't see any reason why we wouldn't return to that, right after the conflict ends. But it'll take a while, and I see structurally higher oil prices for 3 months, probably in that $80, $70 range for about 3 months.
Yeah, I had a guest who said 65, 70 for oil. The front contracts are coming down, so they do think it's coming down. Ben, your thoughts? You think that the crude oil supply disruption is really unprecedented. What say you?
Yeah, as we've said, we think the magnitude and the duration of the outage ultimately will determine where pricing goes. And what we've seen to date is a pretty significant disruption in global supply last month on the order of 7 million barrels a day. This current week may be off our high of 13 million barrels a day, but significant impact to global inventories. And the reality is that the market will price off the day's forward cover of demand, and as long as this outage persists, that's just going to require more time over the next several quarters, through the end of the year to support volumes back into the pricing that will incentivize volumes back into the market. So, we could see some softness if we do see, peace start to break out, if you will. But for now, our view is that the disruption is going to have a meaningful impact on supplies and pricing.
Austin Goolsbee of the Fed also was just talking about consumer sentiment souring. We saw the Michigan sentiment number came in at a record low there at 47.6. This is gasoline prices are higher, and the expectations for inflation could move higher, right, Andrew? I mean, what are you thinking about that? Are you worried about that?
So headline inflation is definitely moving higher, right? That's food and fuel is like the big component of headline inflation. But the core rate, I think, is what the Fed cares most about. And Fed policy is very important in terms of determining, what growth looks like, what earnings growth looks like going forward. We still have 2 rate cuts priced in for this year, one in September and one in December, because core inflation, the key drivers of core inflation being housing, shelter prices, and wages, those are all in disinflationary mode. And we just proved it today with existing home sales for March down 3.something%, month over month. So no, we don't think inflation's going to be the big issue here. The core inflation rate we see is well contained and something close enough to 2.5%. And you can see that in the inflation break-even yields that have been well anchored. Anything beyond 3-year inflation yields have been well anchored.
So what's the biggest energy story, Ben, outside of the Strait of Hormuz? What are you going to be watching? I know you look at a lot of the stocks, the energy equities, the other stories.
So
Yeah, we
for
continue.
us, I'm sorry, go ahead.
That's for Ben.
Sure. We continue to look at the disruption in refined product inventories as well. The Strait has actually seen, obviously, a very significant volume of crude oil disconnected from the global market, but we've also seen significant volumes of refined products as well, on the order of 3 million barrels a day, as well as natural gas. We think, obviously, those commodities are ones that are maintained in storage around markets that are dependent upon imports, and to the extent we see supply impacts there, we'll, just as with oil, we'll see elevated pricing in refined products as well as natural gas. Now, obviously, we're during the shoulder period in the Northern Hemisphere when we have generally weaker demand than we do throughout the year. But if this conflict continues and the duration, as I mentioned, continues, to extend into the future. That's going to have important implications for obviously refined product prices like jet fuel, gasoline, as well as natural gas going forward.
Yeah, understood. And a final quick thought here, Andrew, a lot of your stock picks that came in today had nothing to do with energy. Do you own any energy stocks? And if you do or did, what did you do with them?
We've got just two positions. They're sort of idiosyncratic positions. One's California Resources, symbol CRC, which is, there's a, believe it or not, in California, there's an improving regulation kind of environment that's going on, a little bit of a deregulation that's going on, and that's going to help California Resources. And then on the other side, we have TC Energy in Canada. That is a vertically integrated natural gas producer. So those are our two names. We're not big because we believe that the oil market is going to be oversupplied again once this situation resolves itself. And that was originally a function of trying to force Russia to the negotiating table with regards to Ukraine, and that hasn't changed at all. So again, we expect oversupply, but it's going to take a long time, or 3 months probably max, for this sort of physical supply issue to resolve itself. So yeah, structurally higher oil prices in the $80 range, high 70 range. And I don't see that becoming a big problem for U.S. growth.
Yes. Andrew Graham and Ben Cook, thank you both so much. A great look there at the oil energy stocks, where oil could be headed, nat gas, and more, all about that. Thank you so much. Now we'll continue to take a look at some of the sectors that are on the move in today's session and examine a new ETF that focuses on crypto overnight. It's after the close. You want to hear more about this? The watch list will be right back.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights.
Welcome back to the watch list. I'm Nicole Petalides. We're coming to you live on the floor of the New York Stock Exchange, the corner of Wall and Broad, looking at the sectors on the move, making the markets, stories, the big ones. And Kevin Hanks is joining me now, and you're looking at today's overall trading. I saw some up arrows in some cool sectors. Some of your thoughts today?
Yeah, hey, Nicole, it's basically as we get close to the 2 o'clock hour in Chicago, it is 5 up, 5 down, and 1 unchanged in the S&P 500 sectors. Why is the market up then with a mixed market? Because information technology, communication services, and consumer discretionary are all 3 of the main leaders on the upside, and they're such a big fraction of the overall S&P 500 that it's leading the market higher. Crude oil, that is such in focus right now, was up overnight. It was up early this morning. It's still up, but it has worked its way down the rest of the trading day today. So that's not up as much as it was. The overall market is feeling a little different. I'm looking at the VIX. That's barely positive on the day. Despite the market being up, it's still positive. So I think when you look at it, it's a relatively mixed day in terms of the sectors. However, the leadership within information technology, the software stocks, all higher today. A big bounce back in that software sector that, as you know, has been so heavy, Nicole.
5 up, 5 down, 1 around town. I like how you said that, because the truth is this morning you only had energy higher and the other 10 were lower on the sector. So what a day it's been so far, and it's not over yet, folks. Kevin Hanks, thanks. Let's look at the ETF space. It's time for the ETF watch list. Joining me right now, David Nicholas, CEO and founder of X Funds by Nicholas Wealth, and taking a look here at night, NGHT. Tell us about this one, a little overnight exposure for folks?
Well, really excited to talk about this fund. It's the first of its kind overnight Bitcoin ETF. So yeah, essentially what we're doing is we are buying Bitcoin at the close. So we buy it at the close, we hold it overnight, and we sell it right at the open. Because it's really interesting if you look at the numbers, Nicole, since IBIT was started in 2024, it's pretty fascinating. If you look at all the performance from IBIT have come in the overnight hours. So if you just held it in the overnight hours, you were up 200%. If you just held IBIT during the intraday hours, you're actually negative 50%. So all of the returns, 100% of the returns since January 24 can be accounted for the overnight hours. Our fund attempts to really hopefully give that arbitrage, give investors the ability to really own that arbitrage and have exposure in just the overnight hours and then own treasuries during the day. So first of its kind and totally unique, Nicole.
Look, 200% up or minus 50%. Which one do I want? It's really obvious that the overnight in this case from January that you did the summation. But what's interesting though, did that come from 50% of the time it was higher, or was it big moves that really accounted for that? Did you have to hold it the whole time? Obviously you had to hold it the whole time to get the return. Is it more than half of the percent of the time that it is higher overnight?
Yeah, so it is interesting. We have been in a bull market for Bitcoin during that time period. And so what we do see is that the overnight hours, the majority of the up moves for Bitcoin happen in the overnight hours. So that benefits the strategy. But again, to give it some contrast, year to date, right, we've been in somewhat of a bear market for Bitcoin. And so how does the performance look? So if you look at the numbers just year to date, it's actually, if you were to do the overnight trade is down 14%. The intraday is down 9%. So we actually see it work against us in a bear market, but regardless, and this is what I think is the big takeaway here, regardless of whether it's a bull market or bear market, you're still better than buy and hold. So the buy and hold for year to date, you're down, this is as of March 31st, you're down 22%. So it's still, the overnight hours still outperform the buy and hold, but depending on a bull market or bear market, whether or not just the intraday versus the is actually better, but overall still better than buy and hold.
So the actively managed part, you have Bitcoin overnight and you hold treasuries during the day. And I know it's actively managed because you're making moves every day on this. Let's talk about the different way to diversify, because that's what you're doing here. People don't have this kind of exposure. This is sort of a way to hedge to a certain extent.
Yeah, I think it's a good way to look at it. So we think of diversification traditionally as asset class diversification, right? We may have equities, we may have bonds, we may have commodities. But I actually think as 24-hour trading, it might become a thing with tokenization. We really have to start thinking about time diversification. So we actually think this is a really unique way. If you already have exposure to Bitcoin, but you're a buy and hold investor, why not give you some time diversification? Only have exposure to part of your Bitcoin exposure just in the overnight hours. We actually think as a prudent investor, this is a new way to think about investing as different type of diversification being time versus just asset class diversification. We think this fund, and also just from a tax standpoint, if you were to replicate this, Nicole, just you're going to buy Bitcoin at the close, sell at the open, you would get killed in taxes. ETFs under the tax code have a very unique wrapping where we do not have to pass on those capital gains to investors. So we can do this in a very tax-friendly way because it's sheltered inside an ETF, where if you're just a retail investor trying to mimic that trade, it'd be tough to win with the taxes you'd have to pay.
And I like that you're talking about tax efficiency, right? That is great. People love that, especially because they're 2 days away from April 15th. David Nicholas, you probably gave people some cardiac arrest. They're probably saying, oh, I didn't get that into my accountant. David Nicholas, thank you, CEO and founder of X Funds. But in this case, you don't have to do that with Night ETF by Nicholas Wealth. Okay, coming up, we're going to take a closer look at the outside trades that we're looking in, the outsized trades that we're looking in the market. See, Alex Coffey has been all over this, and he has been looking very closely at some key names, Alphabet and Intel. The watch list will be right back.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Welcome back to the watch list. Time for the big moves in the day, and where we are looking and highlighting outsized options trades from today's trading activity. Joining me right now is Alex Coffey, and he has found 3 bullish trades in the tech sector today that you're going to share with us. So we're looking at Microsoft. This one is up first. It did struggle to start the year. It's down more than 20% this year. It has some new features that, we talk about agentic AI. It's up today. I did see an up arrow today, right now up 3%. And you found a trade that you're going to share with us, a bullish trade.
Yeah, this is a very bullish trade, and it's a very large trade, Nicole. Even by Microsoft standards, 10,000 of the August 21st of 2026 450 strike calls traded for an 890 debit this morning. So I'll do the math for you. That was $8.9 million worth of options premium on a trade that not only needs upside, of which it has unlimited profit potential if this stock really does move to the upside, but it needs a significant rally of a move to 458.90 just to break even by that August expiration date. So nearly $9 million in options premium, Nicole, for a stock that needs to move over $70 just to break even. Now, so just for context, if we were to go to the 460 call in that same expiration, that August expiration, which sort of represents our break-even point, there's a probability that it would be touched over this life cycle of the trade, 130 days expiration, of about 32%. So let's call it 35% chance that this stock, or 33%, 1/3 chance that this stock gets to 460 by that time. But for it to be there at the expiration date, only about a 16% chance. So we're looking at about 1/6. So 1 in 6 times it breaks even basically at expiration based off current option prices. But if you're bullish, unlimited profit potential of this stock were to make a huge run.
All right, 8.9 million. That's huge, as you said, even by the Microsoft standards. So we are watching for that, and it has been down 30% from all-time highs. Let's get to here to Google. A bullish trade. It's up on the year, up more than 105% in the last 12 months. Let's check it out.
Yeah, similar trade structure here, Nicole, except in this case, a little bit smaller in size. And by smaller in size, it's only $3.6 million premium. Trader bought 3,180. A little bit shorter dated calls here in this case. The June 18th, 2026, 335 call for an 1130 debit. Break even on this trade would be 346.30. Right now, Google trades at about in those Google L shares trades for $320, so it needs about $26 worth of a rally just to get to that break-even point. So if we use the 345 call as a similar metric, 60% probability of touch, about a 30% probability of finishing in the money. So on this one, Nicole, higher probability of success, a little bit smaller trade, though certainly less units.
And the exciting part of Intel today, I mean, what a run it has had, and then hits 5-year highs today. I mean, no one was really expecting that. There was a time it was so beaten down. Let's talk about the bullish trade you found.
Yeah, we're almost running out of strikes here, Nicole. That's how rapidly things have repriced in the case of Intel. This is a much shorter dated trade. This is a trader who's looking for a move to happen this week. It is the April 17th 70 strike call. Earlier today, they bought these for 68 cents. In real time, they're trading closer to 55 cents. So right now, a little bit underwater. That theta really moves a little bit quicker as we're only 4 days to the expiration date. Smaller trade, but so short dated, out of the money options premium. In many ways, this is almost a bigger trade given how quickly this could be worth zero if it doesn't get a move quick. 9,996 of the 70 calls expiring Friday. Needs a move to about 70.68 to break even. Looking for more upside. Can't believe we're looking at $65 in Intel. What a last couple months it's been.
It really has been incredible. And when you think about how the NASDAQ has been moving here, last week we saw the NASDAQ up 4.5%. And year to date, the NASDAQ now is just down. It was like 0.3%. I mean, is it almost positive year to date? Just turned positive. The NDX is now positive today with this move. I mean, and you just talked about 3 tech names. It's pretty incredible, right?
No doubt about it. And call buying returning. Microsoft certainly leading the charge as one of the most highly active call bought stocks today and one of the market's generals. So we'd love to see, if you're a market bull, a recovery of Microsoft leading the Mag 7, which of course leads the market.
Yeah. Thank you so much, Alex Coffey. Great look there at Microsoft, Alphabet, and Intel. Alex Coffey, thank you. And thank you, friends, for joining me here today on the new watch list, where now we are seeing the S&P 500 and the NASDAQ positive for 2026. I'm Nicole Petalides. Download our Schwab Network app. It's available in the Apple App Store. 24/7, schwabnetwork.com. Market on Close is next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. schwabnetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it. To leave everything behind, literally come across the entire world, I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caden, coming to you live from our Chicago headquarters.
Hello, Marley. I'm Sam Bartis, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show. The Paramount Skydance takeover of Warner Brothers Discovery is facing some new challenges. So what does the deal mean for overall entertainment space? We'll discuss that. We'll also get some stock picks in tech and cybersecurity and why utilities and fossil fuel energy companies may actually be overvalued after the recent rally. And today's closing bell ringers here at the New York Stock Exchange, Diversified Energy. They're going to stop by the set to discuss their change, the listing to the New York Stock Exchange, and how they're feeling about the Middle East war currently going on. But Marley, take us through what you've been watching in the mixed markets today.
Oh, Sam, you know I'm excited to talk about that P-Sky Warner Brothers deal. But as far as what I've been watching today, Goldman Sachs, of course, top of mind, moving lower despite posting a beat on both the top and the bottom lines. The big bank reported record quarterly equities trading revenue in the first quarter, but shares still dropped after its fixed income number significantly missed expectations. Intel stock is higher today, though, and on track for its 9th straight day in the green after getting a price target hike over at Jefferies. The firm maintained its hold rating, but says that increasing CPU demand and favorable pricing conditions will benefit the chip maker. But Best Buy falling after getting a double downgrade from Goldman. Analysts lowered the price target all the way down to $59 with a new sell rating, as it sees potential risk to the company's sales going forward, as it has to deal with higher memory costs as they start to work their way into the prices of electronics. Lots to talk about there, but first let's check in with the markets, see how things are shaping up as we head into the end of this Monday trading day. We are holding on to green across the board. The S&P trading about 0.6 higher at 68.57 right now. The Nasdaq about 0.7 higher, 25,285. The Dow was weighed down heavily by those Goldman earnings. Goldman clawing some of that back, still in negative territory, but the Dow overall up about 0.25%, adding 104 points at 48,022.91 right now. And the Russell 2K trading more than 1% higher at 2661.83. Taking a look at the 10-year, we're falling just slightly. We're down to 430 right now. The dollar at 98.18. For gold, we're down about 0.5% at 4761.80 a troy ounce. Crude oil has dipped below $100 a barrel. We were up north of 102 earlier this morning, just a few hours ago. And Bitcoin also falling just ever so slightly, but still pretty range bound, down about 1% at 72,620. I do want to check back in with Sam, though, and see what top stories caught her eye today, or what sectors on the move. Sam, what's sticking out to you?
Well, it really took a few hours, didn't it, Marley, for stocks to warm up this morning on these Iran headlines. But we got there in the end. Software's absolutely ripping after last week's absolute beatdown. I'm taking a look at the IGV, up 5% right now. Workday up over 6%. ServiceNow doing a similar thing as well. So some really nice gains today. Oracle, one of the best names on the S&P 500 ahead of the product event tomorrow here in New York City. You've got Microsoft that's having a very good day as well, putting on over 3%. So the clear winner across the Mag 7 today as well. Now, chips, interestingly, are also gathering steam because obviously we've seen this game of ping pong happening between the hardwares and the softwares. But today we've got the SOX on pace for its 9th day higher as well. I'm just looking across the memory space. You've got SanDisk up 11%. Of course, this is going to be interesting because it's going to join the NASDAQ 100. It's giving a software company the boot. So that just goes to show what's going on in that space. You have names like Intel higher 4.5%. We're going to be running through a couple of those names later in the program. But NVIDIA is just on the line at the moment. But Intel and Marvell both getting price target boosts as well. So no doubt all of that is helping put the wind in the sails of our semiconductor stocks today. We're getting airlines hit today. Oil obviously was back in triple digits. We've come off that now. We're at 97 on WTI as we have seen these easing tensions, particularly around the headlines. But that has very much still, as those energy prices stay elevated, helped out some of the names in that patch, particularly when you look at those in the business of oil. Home builders having a good day after Evercore ISI also upgraded Pulte Group and Toll Brothers. They're basically saying the worst is perhaps behind them as far as the market bearishness is concerned. But markets really, Marley, at the mercy of Iran headlines right now. We're in 5 hours into the U.S. blockade of Iranian ships in the Strait of Hormuz now. So we continue to track these headlines. But suffice to say, things are holding up pretty well at the session's high as we speak. So I'm joined here by Nicole Petalides to break down some of the stories that I just mentioned. And Nicole, obviously software is front and center. We saw this nice rally out of the gate, even before the major indices actually managed to get going on some of these Iran headlines. I mean, I'm looking at the IGV, as I mentioned, up 5%. I love numbers. And it looks like we could be on the longest losing stretch for the IGV in 4 years, even with this gain today. Intel, a 9-day winning streak. If it closes higher tomorrow, it'll actually be the longest winning streak in 20 years since 2005. So I thought that was fascinating. But just talk us through some of the stories and catalysts which might be behind this today as far as what you've been seeing.
Yeah, I mean, probably when some of the other big names like Duran Duran or something were really popular. You know, you make a good point, and you mentioned Intel, and today with this run that we're seeing, and today a 5-year high on that stock, which I know you know. But it really is exciting because Intel was sort of left behind for a little while, had some tough PR headlines, was sold off, and people didn't love Intel for a while, and look at it now, an incredible long-term run and new 5-year highs. I think about the SaaS apocalypse, hundreds of billions of dollars in software market cap erased. And now what? I mean, you can't say that AI agents are going to eat into the whole group and nothing is worthwhile. This is the typical, Sam, baby out with the bathwater.
That's right.
It's too much. Even our own friend Dan Ives has said the carnage is overdone, arguing that the market has really underestimated what AI can really bring to the table, expand in the world of software. And in fact, he leaned in and he re-added ServiceNow and Salesforce to his top AI ideas list. So, he said it, he framed it with this, and he said a generational buy. You know, that instead of it's a terminal decline and oh my goodness, it's over, it's the opposite. It's your big opportunity and a generational buy to get into some of these names after hundreds of billions of dollars have been lost in software market cap.
And look, they're on sale, aren't they? I mean, we have seen those valuations come off considerably. And I mean, he makes that point as well in his notes, doesn't he? I mean, while we're seeing another turbulent week here, I mean, these tech winners are on sale. And he's been beating that drum for a while that this whole SaaS apocalypse thing has been a little bit overblown. I know there's been that short-term money where we've seen swift rotation, quite aggressive moves in and out of the softwares and the hardwares. We've been watching that semi-verse software spread quite closely over the last year or so. So it's a really interesting move today while you have chips up as well as the softwares too. So it seems like a bit of everything rally across the space today, even though some of the Mag 7 are lagging. But we also finally are getting back to fundamentals and getting some corporate reads on what is going on right now, something to chew on, some meat on the bone. So we got Goldman today. It's been an interesting reaction. It was down, what, like 3 or 4% earlier today. It was really weighing on the Dow, but it's up like 100 points now, and it's coming off the lows. So what happened there?
Yeah, you know, with Goldman, I think it was some of the buy on the rumor, sell on the news. I mean, the weakness was actually in the fixed income and commodities part of the story. The stock had a beat on the top and bottom line and actually saw investment banking, trading revenue surging and really set the tone for the rest of the week. Also, the fact that these names, how much private credit are these bank stocks exposure to? So I think that's another great point, that you don't have to worry. After the financial crisis, these banks won't have as much exposure to this kind of volatility. You mentioned Palantir, and I thought Palantir was a great part of our story. I just wanted to add one little quick thing, because, you know, as our friend Jim Cramer, he called it the software empire strikes back. And so what we saw there was that software empire strikes back, and he really talked about some of these names coming back. But when I was looking at Palantir today, do you know that Kathy Wood of ARK bought 85,000 shares like about a week ago, $10 million worth, and that this is a name that's also fast catching up. So I will leave you with the final thought here, and that is that many of our guests tell us how Bitcoin and software can sell off and sometimes move in tandem. And when it's risk on, people get back in because they won't throw them out. They still love them. They're just not the first choice. And so when it's risk on, you might see some of these names back higher once again.
Yeah, that's a fascinating point that you make. And then obviously sticking with this whole AI theme, I mean, CoreWeave, you and I were discussing this earlier. I mean, we've seen throughout the course of the session today as well. I mean, adding to that, what, 30% rally it saw in just 5 trading sessions last week as well. I mean, it looks like there's a little bit more conviction that this is here to stay. It's not sort of a temporary fix right now.
Yeah, and now CoreWeave is getting into the conversation as a top-tier player, right? It was sort of a secondary player, but has made so many deals. It is now moving, and it's been sort of claiming a top spot with the surge that it's had in its AI deals. And as you noted, a big run-up overall. With all that's been going on in the AI strength and surging global demand, data center revenue, the cyclical spending, AI is not stopping anytime soon. Every guest who comes on here and picks something AI related. And CoreWeave, as you know, was a pick, and you talked earlier today about the analyst calls as well on CoreWeave. You mentioned I think you talked about the Macquarie call.
Yeah.
And I also saw Bank of America. Macquarie had a 125 target. Bank of America had a 120 target. You know, everybody's in. It's all in on a name like CoreWeave and some of these AI-related stocks. So really good news here, and and becoming a structural player. You see, so I said it's becoming a top player. It is no longer in the background.
Yeah, it certainly seems like it. It's fascinating, isn't it? Because you still have some of the risks around concentration, and then also I mentioned earlier, I've been reading about how some view this as one that is so closely tied to NVIDIA as well, that if NVIDIA sneezes, CoreWeave could catch a cold. But I think, obviously a really positive and much more sort of bullish perspectives and more conviction coming from the street around this one. Yeah.
That I know you saw this, but the Anthropic Mythos really crushed everything because its capabilities to find, imperfections. And so it really hit the market, cybersecurity and some of the software stocks and all that. But there really is now, they're really working on, and once again said, we are not releasing Mythos out. It is not going out. So don't worry about it. It is not going out to, sort of rule the world and ruin the world. That's not happening.
Well, to think it was so powerful that they had to all get in a room together in DC last week, Bessent, Powell, and some of the bank CEOs. You just wonder. So, yeah, interesting times. But obviously, we've got this partnership with CoreWeave too. Nicole, thanks so much for joining us today and running us through some of these top stories for us. I'll send things back over to Marley in Chicago for now.
Thanks so much to Sam and Nicole. Coming up, we're going to turn our focus to the entertainment space, talk about the latest with the Paramount Skydance takeover, our Warner Brothers Discovery. What will the deal go through it all? What does it mean for streaming and the movie business? What's the latest? We've got it for you next.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth.
big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series covers different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to Market on Close. I'm Sam Bartis on the floor of the New York Stock Exchange alongside Marley Caden over in Chicago. Let's check in with these markets. We've got about 45 minutes left in this session, and obviously it took a little time to warm up for stocks this morning, which looked a little bit directionless as this U.S. blockade of Iranian ships over in the Strait of Hormuz kicked in at 10 a.m. Eastern. But then we hit some intraday highs, particularly off the back of some of President Trump's commentary around Iran agreeing on a nuclear issue that is as per the White House, and of course calling Iran this morning that they do want a deal. So we continue to watch these markets and this sort of shadow boxing match between oil and stocks right now, as oil came off the triple digits, which had sent stocks lower, remembering regionally speaking as well across Asia and Europe. And right now we've got it at about $97 a barrel or so. So it was trading up around 103 earlier today. So we've come off the highs and then we've come off the lows on stock. So that is the relationship inversely that we are working with and looking at right now, as oil is clearly driving the bus. Even the US dollar has come off a bit. Some of that strength coming through this morning had been putting pressure on some of those other major regional currencies. Bitcoin has been taking a breather today. Interestingly, we have some risk on in these stocks, and then the 10-year yield, which is holding pretty steady there at 4.31. Obviously, we've got some more inflation data to chew on later this week, but we're back to fundamentals, back to some corporate guidance, which is good news for these markets as we look for some direction, particularly from the banks this week. But I'll send things back over to Marley in Chicago for now.
Thanks so much, Sam. To take a closer look at this Paramount Skydance takeover of Warner Brothers Discovery and the evolving media landscape, joining us now, Seth Schachner, the managing director at Strat Americas and host of Breaking Down the Biz podcast. Seth, great to have you with us. It's a poorly kept secret that this is my favorite story in the markets right now. You know, the latest update is we got a lot of these big Hollywood names signing this open letter saying it's the worst possible time for this deal to go through. They don't support it. Does that move the needle at all? Does the deal still go through?
It could. You know, this is there's going to be a shareholder vote in 10 days on it, and I personally, expect that the vote will go through. But, it's a really problematic merger from a lot of perspectives. Netflix, dropped out and didn't win, and you've got kind of the Noah's Ark thing, if you will, of two, studios. They're not identical, coming together, and a lot of it was predicated on cost cuts, meaning layoffs, and whatever is said, I probably still of the school that there'll be production cuts in terms of the number of things that are financed and released. And what it means for everyone in the town, both the business and the creative community, which is what the news is about today. And there's a long list of everyone from Lin-Manuel to Ben Stiller and Jane Fonda. It means that we're losing a studio, and we're probably losing a buyer of creative talent, whether it's scripts or directors or actors. And legacy studio. It's not just some run-of-the-mill studio. It's Warner Brothers. So, for sure, there's going to be a lot of outcry on it. It's very, very legitimate from the perspective of losing a buyer. I think the concept is
Hey everyone, good afternoon. Gosh darn, I have had quite a day. Is anyone still with me? Devin, I think you just made a post there. Brilliant day. I feel like I'm learning something really helpful. Gex Vex decks are game changing. They absolutely are. They are game changing. And please understand, I obviously did not come up with Gex, Vex, and decks. I didn't make this stuff up. They are legal requirements for market makers, and it is all mathematics based. Literally mathematics based. I'm not making that up either. And it literally defines what the market has to do. Now, you got to take that with a grain of salt because there's so many things happening. Like we talked earlier about, I think it was you that wanted to short at some point. It's like, well, you could short because when we're in positive gamma, you buy the dips and you short the rips. However, you got to see what's happening above price. Like I'm watching this call wall just grew again. This call wall just grew also. So when you see call walls growing above spot price, not staying static, don't short the rips. Just buy the dips. You got to be cognizant of everything that's happening. Now, I'm not a genius. Like, obviously, none of this works 100% of the time. Who is the weatherman that says 80% of the time it works 60% of the time? I don't know what that quote is. I know people like it and it's funny. I'm not cool or good on pop culture trivia. But what I'm trying to bring to people and to traders is a way to visualize this and conceptualize this. And if I can help people enunciate words better than me, then we'd all be better off because obviously I can't talk to save my life. But anyway, I think seeing this on NinjaTrader helps out a ton, more so than having to go to someone's website and look at the website, look at your chart, look at the website, look at your chart. I'm also developing some other tools on the side to help visualize this and help measure this. The other one of them is I showed you this earlier. I hope I'm live right now and you guys can hear me. If not, this is going to be embarrassing. But this is my, I don't even know what I'm going to call this yet, but this is my pure Z0 DTE GEX HUD. I'm working on it still. Got some code to tighten up. But this is using, because we know what GEX is, right? I've defined that in a video. It is GEX equals your strike times 100 times the open interest times the spot price. Pure math. But open interest does not update during the day. It is static as of the prior day. So tonight at 5 p.m. when the markets close, and all the options positions get sorted out. That all gets uploaded and documented. And then it should all be done, sometime around 7 or 8 p.m. If you really want to play it safe, don't pull your data till the next day, till after midnight. But everything's predicated for GEX and DEX off open interest. And it's hard when you got to realize that, hey, volume is growing or shrinking. I shouldn't say shrinking, but that open interest is changing when the market opens. Like someone said something earlier today, and forgive me, I can't remember because I've been working on a couple projects for my job. Like we closed Friday, I can't remember at what price, but significantly farther away than where we opened today. So that makes a big difference on what's going to happen about where the net delta exposure is, the net gamma exposure is, and then what market makers have to do as far as your overarching solidified static put walls and call walls. Price may not reach those put walls and call walls. So that's why I'm building this this other visualization tool that has real-time math going into it that is a pure zero DTE play that uses synthetic GEX walls and has the massive call walls and put walls, but also some minor ones as well. And I also define the weight of those walls because not all walls are created equal. So if you've got a GEX wall that only represents 2% of the overarching GEX weight, and then there are 99 other walls that have less than 1% of the weight, well, that 2% weight isn't gonna carry anything. But if you got one that's got 25% of the GEX weight, ooh-wee, we rocking and rolling then. So that's what I'm trying to show with this super zero DTE GEX weight. And you know, I watch this during the day and I'm working on the code when I can. I'll have this available as soon as my vendor license gets approved. But this thing is spot on. Spot on. I absolutely love it. So I'm looking forward to making that available to everybody as soon as possible. Let me answer some questions in the chat. Back to the regular HUD. Raising Cane. Raising Cane, that's a restaurant, right? That serves chicken tenders and chicken. I saw one down the street the other day. I still want to try it because I'm a huge fan of chicken tenders. Now, if your username has nothing to do with that, I apologize. I'm a huge fan of chicken tenders. Can't get enough of them, even though I've sworn off fried food. Raising Cane. Okay, what method do you use to convert SPX to ES? The delta of the spot price. That simple. So ES itself does not have gamma. The options chain, the options have gamma, but SPX is the most liquid index out there, and most things are derived from the SPX gamma exposure. So I calculate the gamma exposure for SPX, and then all that's mapped here with my custom scripts for C+ and a couple other coding styles that goes into NinjaTrader here. And I've got these are two different indicators that go on, and it's just the delta between ES and SPX, because every day that we march toward the contract expiration for the ES future, which is the June expiration, that spot price changes. Now, there are other things that go into it, like I mentioned earlier this morning, the risk-free rate of return, interest rates, a whole bunch of other stuff go into it, but just check that out, the difference every day, and then type it in here. Now, at some point when I get some time, I'm going to redo the code so that it updates automatically, because that's what I've done with this code here. So bad with the mouse. So bad with computers. You see how this says basis 38.3? That's the spot basis between ES and SPX. Now it says 38. See how that changed? And that automatically calculates the difference between SPX and ES, and then updates those walls for ES on the chart automatically. And it's super easy to do that. I just haven't done it in this code yet, because my biggest fear is I'll update the code and then I'll screw everything up and then break it. And then he also asked, and how often are you updating your levels throughout the day? Yes, I'm glad you asked this question. So, Raising Cane, think you're new to the channel. Welcome. It's good to have you. Nothing to do with the chicken. I've had the nickname 20 years. Okay, well, you got to tell us the story of that nickname now, if you want to. If you're uncomfortable sharing that, no problem at all. Treat everybody with dignity and respect. If you don't want to share how you got that name, no problem. And sorry if it's a sore subject for you. But how often do my levels update? Okay, awesome. So, we got a little squeeze action going at the end of the day. 350. Squeezing. Holy cow, did you guys see that? We just had a massive pop squeeze off a minor wall right there. We're above the call wall, so you know we're in squeeze territory. You know we are. Oh, and that wall just moved too. Right as I clicked the button, and we dipped to the custom Tactical Data Desk LLC operational moving average, which you can't find anywhere else but here, and then rolled back up. And the tactical advice is dealer long gamma suppresses volatility, buy the dips. This is a great trading day. Anyway, let me answer your question. How often do my levels throughout the update throughout the day? So long story short, real time. So as SPX and ES is ticking, these levels are updating real time. So my data is pulled twice per second. And the file for look at it go up again. The file for NinjaTrader is read twice per second, and it updates real time. And I say that because this stream obviously is free, and I'm just delighted to help enable traders by giving it to you for free. And I've seen you cannot, there's very few providers that have this stuff on your chart, because there's very few charting platforms that are open box like NinjaTrader. You can't do this in Thinkorswim real time. You have to copy and paste something into it repeatedly. Can't do it in TradingView. Can't do it in E-Trade if you use that. I don't really use E-Trade for any type of actual things except, like long-term swing type tradings, etc. But one vendor, and I'm not criticizing any vendors or any businesses out there. Everyone's providing great value to the community, and we're all in this together. But I saw one vendor that charges well over a couple $100 a month. They just got done with a sale that was $70 a month, that they utilize a API feed into NinjaTrader for gamma levels, and it only updates once an hour. But once an hour's, you might as well go to bed. That's no good. Unless you're a super long-term trader, but I wouldn't hold any 0 DTE positions, or I wouldn't trade futures if you're getting that hour-old data. That's just my opinion only. Shouldn't have said that. Like I said, we're all here together. So, Ibo Munich, if I'm pronouncing that wrong, I apologize. And you have this script for NinjaTrader? Absolutely. I've applied for a NinjaTrader vendor license, and once that gets approved, it's a lengthy process. They don't let just anyone do it. They'll let anyone that applies, but there's a whole bunch of things that come along with the application. I've had to change a lot of the things I posted, a lot of the things I do. I've had to change my website a couple times. I've had to complete a couple different background checks, believe it or not. Yeah, which is great. And once that vendor license gets approved, then I will start uploading all this stuff to my website to offer it for sale. It'll be very inexpensive, because this is not my day job. This is not my full-time job. This is a hobby. The only thing I want to make money for, and this is going to sound bad, is in June, my home internet contract is going to be up, and I want to upgrade to unlimited internet. And I think that's $150 a month. And right now I don't know what my internet bill is. It's less than that, I know, but gosh, I want to have the unlimited one, and I want to have like the gigabyte super fast one, so that I can keep delivering these awesome tools and these live streams to you. Because also the other reason why I want unlimited internet, look at this squeeze, guys. I hope you are long. I hope someone is long. The other reason why I want unlimited internet is because I want to set up multiple live streams, because I know a lot of you trade NQ. So I have this for NQ and RTY, the Russell. Did you see that call wall grow? Man, real time, that call wall right as price was on it just grew. Probably one of the biggest jumps I've seen, this green bar. So that's institutions buying calls, market makers selling calls. When market makers sell SPX calls, they are short delta. They're not allowed to be short delta, so they have to buy something to be delta neutral, whether it be SPX underlying or ES futures, and typically it's ES futures. And as you can see, that wall just grew and futures shot up. I wish I could do sound effects. That would be awesome. I just gave you a gamma exposure in a nutshell. Okay, Raising Cane. I played online poker for many years. My middle name is Cane. I was selectively aggressive player, so Raising Cane just fit. I love it, because you'd say raise in poker. That's awesome for a nickname. Raising Cane, welcome to the channel, man. I love it. And see, you're perfect for trading futures, and you're perfect, which I'm sure you make a killing doing. This is great because, like, this is, poker's mathematics, right? It's a game of probabilities and odds, and every second, every time a card is turned or exposed or becomes known, the probabilities change immediately, and you've got to calculate those on the fly. So you're probably super smart. welcome to the channel. We're glad to have you. Man, this is awesome, though. Isn't this exciting? I'm having a great time. Now, if I started a thought and didn't finish it, someone remind me in the chat, because I'm terrible at that, especially as I get older. Exactly. Yeah, you're on it. So I got a couple things in the works besides some visualization tools for everyone and indicators for everyone. I'm working on a DEX briefing, delta exposure, which is actually a dollar equivalent exposure briefing, dollar equivalent index, which I think is going to be pretty good. And then I'm working on a pretty awesome VWAP, volume weighted average price briefing. I think a lot of you are probably like, oh, I know VWAP, blah, 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 blah. You probably do. I'm going to put a little bit different spin on it. Just so everyone kind of on a level playing field. And then I'm looking forward to debuting my tactical data desk Sentinel Overwatch. Look at the delta meter, guys. Oh, and the call wall's growing. We are at 357. This is crazy. 357. We are rocking. What a great day. And another wall forming. So busy day at work. I had a meeting. I had a 1 hour meeting that went 2 hours, and then had to update a bunch of PowerPoint charts, and then got hit with a hot tasker that I had to stop everything for and do, which is fine. I love my job, love supporting the team, love supporting the leadership, love getting things done. That's what pays the bills. That's what helps the warfighter. Has nothing to do with trading. I'm talking about my other job now. I just it's fun. Love to do it. Look at the delta speedometer up there all over the place. It's hard to trade beginning of the day and end of the day. All right, 2 minutes till close, and we can wrap up today's live stream and get ready for tomorrow. And I think let me do this poll. I'm going to do this poll for my VWAP video. I'm going to put in this poll here. When I do my VWAP video, would you want me to record it live in a live stream with you guys on there and you can ask questions, or not? Would that get in the way of you watching the gamma exposure? Now, I've never done a poll in the chat before. This is the first time. What I see is just something that says yes, and then there's bars around it moving, little dashes around it moving. I have no idea how that works. Now you see this white line that just skyrocketed forward. So that marks the end of the trading day, and that marks the end of the aggregation for my tactical data desk operational moving average. So while we're here, let's just real quick zoom out, because it's 4 o'clock, so the trading day is over. Let's zoom out and let's see. Today's tactical advice said positive regime, dealer long net gamma, buy the dips. And so we had 1, 2, 3, 4. I don't want to count that one. Could call that 5, 6, 7, 8 great dips identified by the tactical data desk operational moving average that we could have traded. Hopefully some people did profit off that. Great trading day for gamma exposure and delta exposure. To summarize, we started the day negative gamma with a negative shift and ended it positive gamma at 327 million. This is the net gamma exposure with a shift of 300 million at the 9:30 shift. And then we ended the day with $42 billion of positive delta exposure. And then we ended the day with negative $4 billion in Vega exposure. So volatility got crushed. And we all know what happens when volatility get crushed. It's another feedback mechanism. So you know how the option chain works. If you have high volatility, your delta expands across the strike price. And then when volatility shrinks, your delta shrinks. And when your delta shrinks, the market maker hedging requirement has to go with it. And then our Vanna was negative 40 million. What a great day to trade gamma exposure. All right, guys. It is 4 o'clock. I actually got to get on a meeting for my other job that started 2 minutes ago. And I'm going to sign off, and I will see everyone tomorrow. Raising Cane, good to have you here today. Absolutely fantastic. I just messed something up. But all right, everyone. Thanks for joining myself for Tactical Data Desk LLC. It was absolutely great having everyone today. The live stream had a great amount of people in it, and it's just fun to connect with people across the world, from Australia to Vienna, to the United States, and to some professional poker players, and everyone else that's part of the team.